Before we start this video, do like and subscribe to our channel and not miss on any updates.
Good evening, everyone. So let's start off. Let me just share my screen. So today we will be taking up few more case studies from the latest case study digest or the study material what institute has released. I have already shared the case studies in the group. Okay. So this is case study number 6 that we'll be taking up today. 6, 7, 8, and 10. 9 we have already done in the first demo session. That again we will be uploading it as a part of the course where you can access it from. Right now, coming to case study 6, it is about a company which is engaged in the manufacture of solar plants. Okay, and they have given the vision to provide the most compelling value in solar energy industry. So what the company does that they have given, then what is the vision of the company to be a world-class leader in the business, that is what they have given. So this is the company background, and as usual we will come to the background if at all there is a question related to that particular background, right? During the financial year 23-24, government gave the following grants. So what is given? Grants has been given for the business of solar panel. Okay. They have given 30 lakhs. They have given 5 lakhs for purchase of machinery. Useful life of machinery is so much. 3 acres of land. Government grant of 20 lakhs to be placed. So basically, government grants have been given. Right. Then they have also mentioned that partnership firm B.R. Sridharan and Associates are statutory auditors of the company. Then during the financial year under consideration, board of directors of the company passed a resolution to sell one of the company's undertaking. Okay, so that is one thing. So as I told you in the previous class, by looking at the first line and the last line of the paragraph, we get to know what is there in the given paragraph. Mr. Ramesh stays in Delhi with his wife. With respect to one of his immovable house properties, he took professional services of consulting engineer so and so, based in Chennai. So we'll see if there is any impact of this. Then Mr. Ramesh took his family to an amusement park in Gurgaon. Ramesh bought 3 tickets for the amusement park. They have various attractions such as rides, games, and all of those things. So this is something which might be linked to, let us say, place of supply in terms of GST. Okay, so when Shivteja sir takes it, he will handle that. Then they received services from a legal attorney in Dubai. Then the company has 10 directors on board. This is related to law-related matter. Mr. Baldev is one of the directors of the company. During the financial year, the company paid him setting fees. So provisions related to maybe Companies Act or provision related to whether GST is applicable or not. Then the company has its retail showrooms in Patiala and Delhi. The company manufactured 1.5 lakh units of solar panels. Management decided to transfer half of the units to one of the retail showrooms in Patiala. And so this is something similar example you would have done in GST, okay, where they transfer from one unit to another unit. How is the GST angle in this? Now here also in this particular case study, if you see, though they have given multiple paragraphs, each paragraph is an independent paragraph or independent question in itself. So as we have been doing earlier, we will see the question and then we'll come back to the specific part of the solution. So MCQ, if you see, is understanding of Mr. Ramesh for obtaining prior consent for selling one of the undertakings of the company correct? So this is something to do with your law related angle, that they want to sell an undertaking. If they want to sell an undertaking, do they need to take prior consent? So this you will understand when law is being discussed. Then what is the place of supply related to GST? What is the place of supply again related to GST? Very unlikely that you will get same question like place of supply question itself 2 times in the same thing. Which of the following is correct statement with respect to GST liability? Sitting fees is 35,000. Which of the following statement is most appropriate? Income taxable under other sources, etc. So only income tax and law related thing. Now, again, we have a question on directors. This is again to do with the law. Solar panel to company's retail showroom, etc. in view of GST law, again related to indirect tax. For financial reporting, they have one question. How should Luminous Limited recognize the government grants in its books of accounts for the financial year 23-24? Now, when you see this question, when you go back to the case, there was a specific paragraph on government grants, right? So you have government grants of, the government gave the following grants to Luminous Limited: 30 lakhs for past research, 5 lakhs for purchase of machinery, useful life of the machinery is 5 years, 3 acres of land to set up a plant, fair value of the land is 20 lakhs, government grant of 20 lakhs to defray expenses for environmental protection, expected cost is 6 lakhs per annum for the next 5 years. Now, this is with respect to government grant. Which standard deals with government grant? Which standard deals with government grant? Which index deals with government grants? Anyone? Which standard deals with government grants? Index 20 deals with government grant and government assistance. Okay. Now, so few aspects of government grant and government assistance. Again, over a period of next 7 to 8 days, you will receive concise notes of relevant subject, chapter by subject by subject. We'll be releasing with you to you, which you can refer when it comes to examination. So Index 20, just let me open it for you. Government grants. Now here, if you look at the question has given multiple types of grant. Okay. And we don't need to have a detailed understanding of what is the scope, what is included, what is not included. What we need to understand is, when do we recognize the grant? We will recognize the grant that when there is a reasonable assurance that the entity will comply with the conditions attached to the grants and the grants will be received. So this is the recognition criteria. Then, if past conditions has been set there, now in one of the case, in one of the instances, there is a past condition, past research. There, we should have an assurance that we have already completed the past conditions, so we don't need further assurance. We just need to receive the grant. If it is future conditions, there must be assurance that conditions will be satisfied. Now, how do we account for grant? We do not follow the capital approach. That is, we do not treat it as an equity in the balance sheet. We follow the income approach by setting up a deferred grant account. So government grants are recognized by setting up a deferred grant account. When it comes to grant related to depreciable assets, either we will treat it as a deferred income, or we will reduce it from the cost of asset. Either deferred income or reduced from the cost of asset. Then, if we receive a non-monetary government grant means government has not given us money. They have not given us cash or cash equivalent. They have given us non-monetary grants, means they have given us other than money. They have given us some kind of asset. If non-monetary grant is received, we have two choices. Please keep this in mind. This is very, very important. We have first alternative, to value the grant at fair value, or value the asset at fair value, or value the asset at nominal value. One of these two options can be chosen. If we value the asset at fair value, we will debit property, plant and equipment, or land in this case, by fair value, and we will credit government grant by fair value. Okay, so the thing that you have to keep in mind is, one, in case of non-monetary asset, this is the treatment. If it is a income related grant, then we will credit it to a deferred grant account. Then if it is a grant related to a fixed asset, there we will follow one of these two approach. Either we will treat it as deferred income, or we will reduce it from the cost of asset. This is a simple summary recap of how do we treat the government grant. Now coming back to our specific question, it is a descriptive question which says, how should the company recognize the government grant in its books for the financial year 23-24? So we will let us see one by one how it is to be done, or what is to be done in the given scenario. First, 30 lakhs for past research. 30 lakhs for past research of technology related to solar system. There is no condition attached to the grant. So if there is no condition attached to the grant, is there a need to fulfill any condition? No. So can we recognize this grant immediately? Can we recognize this grant immediately? The first grant that you can see, 30 lakhs. Can we recognize this grant immediately? Yes, because we have received the grant and there is no past condition. So for the first one, what you will say, entire grant of 30 lakhs, entire grant of 30 lakhs will be recognized in P&L because there is no condition to be met. Okay. Second one, 5 lakhs towards the purchase of machinery of 15 lakhs. Useful life is 5 years. Now, what is this? This is a grant related to a PPE. For grant related to PPE, first option is we can reduce the grant from value of PPE, and PPE will be recognized at 15 lakhs minus 5 lakhs, that is 10 lakhs, and depreciation can be charged over it. That is first thing. Second option is this grant of 5 lakhs, we can show it as deferred income. We can show it as deferred income and systematically transfer the deferred income to P&L. Now here systematically means 5 lakhs over a period of 5 years. So 5 lakh divided by 5 years, 1 lakh every year we will transfer to P&L. So both the options we have to give, that they can account for it using the deferred grant approach, or they can reduce it from the income. So they can reduce it from the fixed asset. Okay, that is the second part. Third, 3 acres of land to set up a plant. The fair value of the land is 20 lakhs. Now, as far as non-monetary grants are concerned, then you can recognize the land. So you can recognize land at fair value of 20 lakhs, and you will credit deferred grant by 20 lakhs. This is the first option. Second option is to show it at nominal value. Nominal value means which value? Nominal value means maybe 1 rupee, 10 rupee, 100 rupees. At nominal value, you can disclose. Lastly, government grant of 20 lakhs to defray. Defray means incur. Expenses for environmental protection. Expected cost to be incurred is 6 lakhs per annum for the next 5 years. Now here what has happened? They have given us a grant. They have given us a grant of how much? 20 lakhs. And that 20 lakhs will be required to incur expenditure of 6 lakhs per annum for the next 5 years. So here what you can do is 20 lakhs will be credited to deferred grant account, and every year 6 lakhs for how many years? For 5 years. So this 20 lakhs divided by 5 years, that is 4 lakh per annum will be transferred to income statement. Okay. So there are 4 bits or five type of treatment that is there. That has to be considered. So it will be a 5 marks question. If you describe it properly, you will be able to score the marks. Okay. Now this 4 lakhs also, you can either show it as other income or you can reduce it from the expenses. Okay. A simple question, nothing complicated as far as the a financial reporting treatment is concerned. Right. So this was a direct, I would say a direct question rather related to Ind AS 20. Then let us move to the next case.
So today we'll be covering 5 case studies, hopefully 5, as many as we can cover in 1 hour regarding company law. And we'll be taking up the case studies from our study material. So in our study material, we have case study 1 to 15, which are given. So we'll be taking up 5 out of them today. And we'll be covering only the company law portion from them. Okay. And how are you all doing? How is your preparation going? Let's chat a little bit for 2 minutes. And then we'll start the session. So you all are preparing for this exam, the May exam, is it? Or Group 2, yes. Okay. Okay. Anyone who's giving both the groups? No? Okay, one person is giving both the groups. Okay. It must be very stressful for both of you all, like someone who's giving one group and especially for someone who's giving both the groups. Okay. So you're done with one reading of the full course? One reading is done? Yes? Okay, good. Like ideally by now you should be done with at least one reading. Then you can cover up the syllabus one more time with exam papers in the remaining time. All right, so we are going to start the session now. Okay, so first of all, we're taking case study number 6. All right, so now this particular case study has got 2 company law questions which we are going to be taking. One is a multiple choice question. So let's first address that. So our structure is going to be just like before. We are first going to read the question. Based on the question, whatever facts we need, we are going to jump into the case study and we are going to search the relevant facts. We'll read those facts if required. Sometimes, you just need to read the question and the options and you're going to get the answer. Okay, so based on that, if suppose we need to see a provision, we are going to see a provision. I'll make you understand the provision and then you are going to answer. You are going to answer one of the options, whichever you find is correct. Okay, so let's go about it. Okay, so the first question. Now we don't know the case, but we are directly jumping into the question. Okay, all right. So is the understanding of Mr. Ramesh for obtaining prior consent for selling one of the undertakings of the company correct, considering that that Luminous Limited is not a private company? So here we are talking about some Mr. Ramesh is selling one of the undertakings of the company. Okay, so there is a specific section relating to selling of undertakings of the company. Okay, we are going to refer to that, but let's just go into the case study to see what is the case study specifically saying. So I've highlighted this part. See, here specifically we are talking about Mr. D. Okay, Mr. Ramesh, right? So you're going to have to find Mr. Ramesh's name and accordingly you will find the facts that here we are referring to. Okay, so here Mr. Ramesh's point specifically, let's read it out to understand what this case is saying. So during the financial year under consideration, the board of directors of the company, they passed a board resolution to sell one of the company's undertaking out of multiple undertakings of the company. Now, one of the directors of the company, Mr. Ramesh, okay, so Mr. Ramesh is a director, is of the view that board can exercise the power with the consent of the shareholders by way of ordinary resolution, and passing a board resolution would not be sufficient. So what is happening here? See, this company has many undertakings, many parts of the business. One of the undertaking, the company is selling it off. So the board of directors, they have passed a board resolution. So a board meeting was held and board resolution is passed, right? But we have got a director, Mr. Ramesh. Mr. Ramesh is saying, listen, board resolution is not enough. I think there is a misunderstanding. You should check the Companies Act, and I think ordinary resolution is required. Board resolution is not sufficient. Please check. I don't think you are doing right. So this is what Mr. Ramesh is saying. Okay. Now, additional facts are that the investment of the company in the said undertaking, which has been proposed, is 22% of the net worth as per the latest balance sheet. So this is important fact for us. This is important detail for us. Okay. So I hope you've understood the facts of the case. Okay. So here we have to check, is the understanding of Mr. Ramesh correct or not? So for that, you need to know the company law provision. So what is the provision? We have to refer to section number 180. Section 180 directly just talks about selling companies' undertakings. Okay. So can you see my screen? Like, can you see the word file? Tell me yes or no. Yes, very good. Great. Okay. So we are going to just look at the provisions, and based on the provisions, you'll have to let me know what do you think. Okay. So the provision says, see, simply the provision here we are talking about is restriction of the power of the board. Now in this particular section, Okay, so section 180 talks about a lot of different powers of the board of directors. This particular section is not applicable on the private companies. Now, one of the specific points that this section talks about is selling any undertaking. The board of directors, they have got the power that if they want, they can sell off the whole of one of the undertakings, or they can sell off a majority chunk of the undertaking of a company. Okay, so when I'm saying undertaking, it means a major part of the company. Okay, now see, undertaking word has been defined also, but this section basically says that the selling of whole or substantially the whole of the undertaking of the company can be done only with the consent of the company by way of special resolution. So if the company wants to sell off the undertaking, the company cannot just do it by board resolution. They will have to hold a general meeting. They will have to pass a special resolution. Only after that, they can sell, lease, or otherwise dispose of whole or substantially the whole of the undertaking of the company. All right. Now, what is an undertaking? Is it defined? Yes, it is defined. When we say undertaking, it means any part of the company, could be a product, could be a segment, okay? Any part of the company in which the company has invested more than 20% of its net worth. Now, here the facts of the case, as we had discussed, they are relevant. We had discussed that just now when we were reading the question, it said that the undertaking has got 22% of the net worth as per the latest audited balance sheet, right? So, can we say that that undertaking is classified in this section number 180? Is it undertaking as per section number 180? See, section number 180 also says that undertaking is basically where the company has invested more than 20% of the net worth. So is that question talking about exactly this same undertaking? Yes. All right. Alternatively, undertaking also means a segment of the company which generates 20% or more of the total income of the company. Okay, so that is what an undertaking means. Okay, now the company can sell off whole of the undertaking or substantially the whole of the undertaking. Either the entire undertaking, that means more than 20% of the net worth holding undertaking can be sold, or substantially, it can be sold. Substantially means more than 20% of that undertaking. All right. So I hope you're understanding. Okay, so now when we move on to this question, let's read the question again and let's try to understand. See, in this question, what had happened? Mr. Ramesh says that ordinary resolution is required to sell off the undertaking. However, the board of directors, they have sold off with just board resolution. Is Mr. Ramesh correct? What do you think? Is Mr. Ramesh correct? See, section 180 says that a special resolution is required. So first, just tell me in the chat, do you think Mr. Ramesh is correct? Yes or no? Yes or no? Sikandar says no, correct? Okay. So we are going to look at the options and we'll select the correct option. Okay. So first option says no, as only board resolution is required. In this case, which has been duly passed. Is this correct? No, this is wrong. We need a special resolution. No, as a board can exercise the power with the consent of shareholder by special resolution and not on its own simply by passing ordinary resolution. This seems like the right answer. Okay, let's still read the other two options. C option says yes, his understanding is correct. That's wrong. Mr. Ramesh is not right here. Partly correct, as the board shall exercise the powers with the consent of the company by ordinary resolution and not only by board resolution. Further, prior approval of registrar of the company is required. There is no such provision. So again, this is also wrong. So here our correct answer is going to be B. Okay. Let's move on to the next question. So now in this case study, we have got one descriptive question also that we have to solve. We are going to quickly read this. This is also a very simple question. If you know the chapter relating to directors, you will be able to easily answer this question. Just a second. Okay, so let's read the question first. Okay, so I'm talking about question number 6. Okay, first part, whether the, okay, now we are going to read the question here. Then we are going to jump onto the question, the case study. We'll select the relevant facts and see. Okay, whether the retiring director shall be deemed to be reappointed at the adjourned meeting. Now, even if you do not read the question, this should ring a bell. Okay, here we are talking about retiring director, whether they are going to be deemed reappointed in the adjourned meeting. Okay, let's read the question further. Maybe it is talking about the rotation of directors. Maybe. Okay, let's see. Second question reads, what will be your answer in case in the adjourned meeting, the resolution for reappointment of these directors is lost? Okay. Whether such directors can continue in case the directors do not call an AGM. Okay. So here we are talking about appointment of directors. So let's go into the case study and see. So I have already highlighted the part, but otherwise also it will be very easy. If you try, no, you will be able to find out the relevant part. One second. So what does the question say about directors and its reappointment? Let's read. The company has got 10 directors on its board. 3 of these directors have retired by rotation in the annual general meeting conducted recently. The place of retiring directors is not filled, and the meeting has also not expressly resolved not to fill the vacancy. Okay, so what has happened? The company held an annual general meeting. Okay, now total number of directors were 10. Out of these, 3 have retired by rotation. Okay, and now because these 3 directors have retired in the AGM, someone has to replace them. We have to appoint a new director in place of these retiring directors. But what has happened is that no new so there is no new director has been reappointed here in the annual general meeting. Okay, so another option that the company can do is company can pass a resolution that we are not going to fill out this vacancy. These 3 have retired, so let them be. We'll stay with 7 directors. But no such resolution is also passed. Basically, they have not done anything in the same annual general meeting regarding this. Okay, now what happens? Now, since the AGM could not complete the said business, it was adjourned. So, because in the AGM this particular matter was not closed, we have adjourned the meeting. Adjourned meeting to the next week, same day, at the same time and place. Okay. Now, in this adjourned meeting also, the place of retiring directors could not be filled up. Okay, and also the meeting has not expressly resolved not to fill the vacancy. Again, in the adjourned meeting also, no new reappointment is done. Neither have they resolved to not fill this vacancy. So now what is going to happen? Okay, so someone had mentioned in the chat, section 152 here is our relevant section. So let's try to understand section number 152. Then we are going to come back to this question and try to solve this question. Okay. All right. So let's try to understand what section number 152 talks about. So section 152 talks about appointment of directors. I'll give you a brief idea of this section. Based on that, you only have to decide what is going to happen in the question. Okay. So see, this basically says that in a public company specifically, the directors are either rotational directors or non-rotational directors. Rotational directors, that means in every annual general meeting, some of those rotational directors will retire and either reappointed or someone else will be reappointed. Basically, the board of directors should keep on fluctuating, keep on moving, keep on changing, so that there is no stagnancy in the board of directors. Okay, so some of the directors are rotational directors, right? Now, some of the directors are permanent or non-rotational directors. They do not retire every annual general meeting. Okay, so that is the broad idea of what is rotational director, what is non-rotational director. Now, what this section says is that, see, the article of association can specifically mention that all the directors are going to be rotational. It can say so. But if suppose the article of association are silent, in that case, the Companies Act says that at least 2/3 of the total number of directors are going to be rotational directors. Okay, so that means if the articles are silent, then if let's say total number of directors are 10, then 2/3 will be this rotational directors. All right. Now, out of these 2/3 rotational directors, all of them will not rotate every annual general meeting. All of them will not retire every annual general meeting. 1/3 of these are going to be retiring in every annual general meeting. Okay. So that means, see, 2/3 of the total number of directors, let's hypothetically think that, let's say we have got 10 total number of directors. 2/3 of 10 is what? We are going to round it off. to 1 if there is a fraction. So that means 7 of the directors have to be rotational directors. Now, out of 7, 1/3 will have to retire in every annual general meeting. Okay. So that means 2 are going to retire in every annual general meeting. Am I correct or am I wrong? Tell me in the chat box. What do you think? Can you do the calculation? 3, correct. So 3 are going to retire in every annual general meeting. Okay, now this retirement in every single annual general meeting has to happen on FIFO method. That means basically the director which has the longest period, who has stayed the longest, will be retiring first. All right. Now see, in the annual general meeting, every single annual general meeting, these directors, they retire, and reappointment, either they are reappointed as directors, or in place of them a new director is appointed, or the company can also expressly resolve that they don't want to fill out this vacancy. Okay, this can happen in the annual general meeting. But now in our given case, what has happened is that in the annual general meeting, retirement has happened, but there is no reappointment, there is no new appointment, and there is also no express resolution that the vacancy is not going to be filled. So what has happened? The meeting has adjourned. Now what happens in the adjourned meeting? See, section 152 says that in the adjourned meeting, again, it is the duty of the company that they should either reappoint this person, or they should appoint a new director, or they should expressly resolve that this vacancy will not be filled out. Okay, but let's say in the in the adjourned meeting also nothing like that happens. There is no decision taking. Then the section 152 says that it will be deemed reappointment of those retiring directors. Those retiring directors will be deemed to have been reappointed if in the adjourned meeting no decision is made. Now there are some exceptions to this. The exception is, let's say that director himself says that, listen, I don't want to be a director. He is not willing to be a director. He's given in writing. Okay. Or let's say a resolution is put that let's appoint Mr. A, Mr. B, whoever is this director, but that resolution is failed. Resolution is not passed. Ordinary resolution is not received. Okay, so if a resolution is put to reappoint a director, but it fails, then also that director will not be reappointed. Maybe that director is disqualified, then also he will not be reappointed. Maybe the act requires some other provision, maybe some special resolution or ordinary resolution to appoint that person, then also he will not be reappointed. So I hope you've understood the provisions here. Understood the provision? Is my video clear? I hope my audio and video is clear. It's clear? Okay, good. Okay, you've understood the provision. Now let's go back to the question and see. So in our given case, what had happened was that in the adjourned meeting also, there is no decision that is taken. So first question reads, whether the retiring directors shall be deemed to be reappointed at the adjourned meeting. What do you think? Should we deem them reappointed in the adjourned meeting? Yes or no? Yes or no? Yes, correct. Very good. Good job. So this is a yes. Yes, they'll be deemed reappointed. Second question, what will be your answer in case at the adjourned meeting, the resolution for reappointment of the directors is lost? That means we put a resolution that let's reappoint this person, but the ordinary resolution is not passed. It has failed. In that case, do you think he should be reappointed? Yes or no? No reappointment? No reappointment? Correct. Very good. No reappointment. So here, no reappointment will be made because it falls in that exception that we had discussed. Resolution fails. Third question. Now, this is something which requires you to think a little bit. It's not directly related to the provision. Whether such directors can continue in case the directors do not call the annual general meeting. So they are saying, basically, let's say the annual general meeting itself is not held. Then can we say that there will be no retirement? No, even rotational directors will not be retiring. Nobody will retire. They'll continue their term till, the annual general meeting is held. What do you say? Yes or no? Can they continue as directors? Can they continue as directors? Randomly, just give the answer. It doesn't matter if it's right or wrong. Okay. No, they cannot continue. Perfect answer. Perfect answer. So say here you will have to explain. Here you will have to give some sort of reasoning. Why? Why do you think? Because see, the section is not saying anything. You will have to come up with the reason. So see, if the company has some rotational directors and non-rotational directors, then those rotational directors will have to retire. 1/3 of them will have to retire. Okay. And by the way, it's not possible that the company does not hold an annual general meeting. The company will compulsorily have to hold an annual general meeting. Where is it written? It is written in section number 96. You can quote section 96 here and say that annual general meeting is compulsory, even if it is not held. There is a time limit within which it has to be held. Even if it is not held, then also the rotational directors will be deemed to retire on the last date. All right. Why? Because see, annual general meeting, holding the annual general meeting, whose duty is it? It's the duty of the directors to ensure that they hold an annual general meeting. Okay. Now, if the directors are not fulfilling their duty, if they're not holding an annual general meeting, just so that their tenure is extended, it will not work, right? They cannot get the benefit of doing a wrong provision, or they're not following their duties and they are getting the benefit of it. That will not work. So you will have to mention those details here, and you'll have to basically say that if there are rotational directors, they will be deemed to have been retired even if an annual general meeting is not held. All right. So if you want, you can read the detailed answer that is given for this particular case study. Here we are talking about case study number 6. Okay. Okay. So see, this part of the case study, I'll just read out a few points from here. The directors will retire as soon as the AGM is held on its due date. Further, section 96 says that compulsorily it is necessary for the company to hold an AGM where the director is liable to retire by rotation, shall retire. So this particular point, you can read it out. As calling of the AGM is a duty and responsibility of the directors, they, by omitting to call the AGM on the due date, cannot take advantage of their own fault, and they cannot extend the continuation of their office. All right. All right. So we are going to be moving on to the next case study.
So friends, now that in last couple of lectures, you have learned a lot of interesting elements about financial reporting, and also a lot of interesting elements about corporate laws and economic laws and different laws involved with respect to various case studies. Now it's time to learn about a lot of interesting provisions related to direct and indirect tax laws with respect to 3-4 interesting case studies, which we are going to talk today. Are we ready, my dear students? So first, looking at case study number 6. Now that you already seen this case studies, couple of days, couple of lectures, you have seen this already with respect to financial reporting and also with respect to law. I'm sure it will not take much time for us to go through the case study, but it takes some time to understand the taxation related provisions. See the concept, guys. Luminous Limited is a company which is engaged in manufacture of solar panels. Vision of the company is to provide the most compelling value in solar energy industry. By value, the company means designing and installing the highest quality solar panels on a timely basis with proper safety standards and at lowest cost. Company aims at providing the country with clean, abundant, low-cost, distributed and renewable energy. It is one of the largest vertical integrated solar company that offers services across the spectrum of photovoltaics manufacturing. Company offers and produces high-efficiency solar panels with higher performance and enhanced reliability. And the company has following mission: to be a world-class leader in the business that contribute to nations in building infrastructure through sustainable value creation. So whatever they told till now is all the background about what this company is all about. The only thing you have to extract is that company is in manufacturing of solar panels, and they have got high vision to ensure that they will develop infrastructure in India. They have got high vision that they want to develop infrastructure in India, and they are producing and offering high efficiency solar panels, my dear friends. See next slide. Luminous Limited has always been a standard for all the manufacturing companies for product quality. Company has multiple quality checks during its solar module production. This helps to ensure flawless production of solar panels and hence attain utmost customer satisfaction. Very good. Company believes that in resource-scarce developing countries, identifying and targeting R&D policies in critical areas such as energy is particularly important to maximize benefits derived from limited funds and skilled manpower. So this is all story. In the first lecture itself, I clearly told you that you should be able to identify what is the story in the case study, which you should not spend too much of time on, so that you will save your time. Next. Energy R&D policy analysis and formulation in a developing country should not be carried out in isolation. It must be consistent with overall technology policy as well as national energy policy. Management of the companies of the view that ultimately energy R&D policies and priorities must support the goals of national socio-economic development. Full story. Therefore, these priorities must be determined on the basis of analytical framework that recognizes and addresses national development objectives. What level of story is given? Company's R&D department is working hard to come out with solar panels with the least possible cost, so as to compete with foreign manufacturers of solar panels. See, now comes the real content. Wherever number starts, there onwards, the real content of the story will begin. See that. During the financial year 23-24, government gave the following grants. They have given grants. So they're definitely going to talk about financial reporting part related to grants. 30 lakh for past research of technology related to solar system. There is no condition attached. 5 lakh towards purchase of machinery of 15 lakhs. Useful life of machinery is 5 years. And depreciation is to be charged on straight line basis. In accounts, you can do whatever you want. But in taxation, my dear friends, let me tell you, you can charge depreciation only on WDV basis, that too based on block of assets. And the beautiful point, let me also tell you, is that in case of assessee who are engaged in generation of power or generation and distribution of power, they can follow something called SLM. Or else, generally what is supposed to be followed is always WDV. Next slide. 3 acres of land to set up a plant. Fair value of the land is 20 lakh. Government grant of 20 lakh to defray expenses for environmental protection. And expected cost to be incurred is 6 lakhs per annum for the next 5 years. So this is a story related to the grants what they have got. Not much of significance from taxation perspective. Same. BR Sridhar and Associates are the statutory auditors of the company for 23-24. And the said chartered accountant firm has a robust team of skilled and proficient chartered accountants who can handle all financial services relating to accounting, auditing, income tax, GST, company matters, foreign exchange matters. Next, this all part I'll not talk at all, because it's all related to directors, director is providing consent, that is all related to law matter, company law related issue. Yes, good. Now see, Mr. Ramesh stays in Delhi with his wife. I repeat again, Mr. Ramesh stays in Delhi with his wife. With respect to one of his immovable house properties in USC, he took professional services of a consulting engineer, Mr. George, who is based in Chennai. So George is giving consulting service with respect to immovable property in USC. And George is in Chennai, Ramesh is in Delhi, property is in USC. George has high engineering qualifications, specialized background, and wide experience, and can plan, design, and supervise, and help in undertaking maintenance of any type of structure according to needs of the client. That's all story. On 31st May, Mr. Ramesh took his family to an amusement park located in Gurugram, Haryana. This particular amusement park has various attractions such as rides and games, as well as other events for entertainment purpose. For such visit, son of Mr. Ramesh, who stays in Jaipur for his studies, he also came to Delhi. And Ramesh brought 3 tickets for amusement park. And where is the park, by the way? Park is in Gurugram, which is in Haryana. Next. Luminous Limited is based in Delhi primarily. And during financial year 23-24, company receives legal services from an attorney in Dubai. So they have taken legal services from a person outside India in relation to registration of company's trademark in Dubai. And the company paid AED, that is dirhams, 10,000 for the same to attorney in Dubai. So basically, if you observe, it is very clearly a attorney legal services, and supplier of India is outside India, recipient of service is in India. And moreover, the important point to be noted in this context is something like this, my dear friends. That is, let me make you recall the interesting concept of supply. Section 7. In that, there is something called Section 7(1)(b), which talks about import of services for a consideration, whether or not in the course of furtherance of business, it is definitely regarded as supply. Here, if you observe carefully, it is an import of service for a consideration. So this transaction is very clearly a supply. And once the transaction is supply, my dear friends, without any second thought, GST will apply. Because as per provisions of GST law, GST will apply only if the transaction is a supply. If it is not a supply, GST will not apply. Next. Company has directors on board. 3 directors are retired. That's all company law related matter. I will not spend time on it. Yeah. Mr. Baldev is one of the directors of the company. And during financial under consideration, company paid him sitting fees amounted to 35,000 for the month of December. My dear friends, let me ask you, what is sitting fees? Sitting fees is nothing but the remuneration which is paid to the directors for attending board meetings. That is technically called sitting fees. And the moment you read that word sitting fees, 2 concepts should strike your brain. Point number 1. When company is paying sitting fees to director, what is going to happen is, point number 1, TDS will come under one brilliant section called 194J. Fantastic. Some students have already replied. Good. That is one direct tax impact. Second impact is, under GST law, this 35,000 will be taxable under reverse charge mechanism, because services by director to a body corporate is covered under RCM. Next point. Company has retail showrooms in Patiala and Delhi, and also a factory at Ludhiana. Where is Ludhiana? Punjab. During 23-24, company has manufactured 150,000 units of solar panels at factory at Ludhiana, Punjab. Management decided to transfer half of the units manufactured to one of the showroom in Patiala and second half to showroom in Devi. The factory and showrooms are registered under GST, because logic is very simple. Under GST law, for separate state, separate registration is mandatory. So following that provision for separate state, they have taken separate registration. Very good. Further, company has obtained separate registration for Ludhiana factory and also Patiala showroom. Management of the company understands that such transfer shall not be considered as supply under GST, as the transfers are without any consideration. My dear friends, I want to hear from you, is this transaction of sending the stock from the factory to the showroom, is it a supply? Will the GST apply? 100% answer is yes. Because for the branch transfers, GST will apply because they are regarded as distinct persons. In case of distinct persons, GST will apply. And distinct person means GST number is different, but the PAN is same. And moreover, the interesting point is Section 7(1)(c), read with Schedule 1, clearly talks about transactions which are regarded as supply, even though there is no consideration. In that, there is one second point, supplies between distinct or related persons in the course or furtherance of business. And that is regarded as supply, even though there is no consideration. So in this particular scenario, even though there is no consideration, still the transaction is regarded as supply. And the moment we conclude that the transaction is supply, then without any second thought, GST will apply. That's the story of this beautiful point. Are we clear? Can I proceed? Good. Student asking, sir, I have a doubt. Will they actually pay GST? 100% answer is yes. And the value of goods transfer via bank. So practically the point is that practically they pay GST, but practically they don't do a bank transfer because ultimately it is same PAN, right? They'll consolidate in the books of accounts. Only for GST purpose, they should separately pay GST. So for example, let us say in our example, what is happening is Ludhiana GST number will pay output tax to the government. That output tax will become input tax credit for Patiala GST number. It is only GST impact, but not for the purpose of income tax. And if you would have done your articleship in GST, if you remember in GSTR 9, there is one format in which there is a column called deemed supply under Schedule 1. There we report this figure in order to match our turnover as per books and turnover as per GST. Got it, my dear friend? It's a long time doubt whether they actually transfer or not. They don't make a transfer because it's the same bank account and same entity, right? They don't do a transfer. But GST purpose, they pay GST. Yeah, done. Come on, let's see the multiple choice questions. First one is understanding or obtaining prior consent. Law. Good, next point. Before that, I have a question which student is asking. Sir, any trick for remembering sections? See, there is no specific trick as such. It just comes only by practice. I'll also give you one summary kind of material for income tax and GST so that you can go through the important provisions easily. The only trick and the logic is that when you're preparing for your direct tax and indirect tax paper of 100 marks, the summary is what you have prepared. That will only help you out for your integrated business solutions also. That's the only trick, nothing else. Yeah. What is the place of supply with respect to professional service rendered by Mr. George to Mr. Ramesh? Wow. Let me answer this. See here very clearly, guys. Mr. George has provided service to Mr. Ramesh in relation to immovable property. And what provision says is that if location of supplier and location of recipient is in India, then place of supply will be determined as per section 12. And my dear friends, let me tell you, section 12.3 specifically says POS in case of service in relation to immovable property shall be the place where property is located or intended to be located. However, if property is located outside India, then POS shall be location of recipient. POS shall be what? Location of recipient. Let me get back to the case now. What is that they have asked here? What is the place of supply with respect to professional service rendered by Mr. George to Mr. Ramesh? Get back to the question. Where is George? Come on, where is George? Where is George, my dear friends? Come on, tell me. Where is George? George is based in Chennai. And where is Ramesh? Ramesh is based in Delhi. Where is the property? Property is in USA. If property would have been in India, wherever the property is in India, that would have become place of supply. But here, if you observe, property is outside India. If property is outside India, what is the answer for place of supply, my dear friends? Place of supply will be location of recipient. So in this particular question, what will be the place of supply? Which is nothing but Delhi. That's it. I'm sure we are clear, guys. Good. Thank you. Next question. What is the place of supply with respect to tickets bought by Mr. Ramesh for the amusement park? Tickets bought by Ramesh for what park, my dear friends? Amusement park. Here, let me tell you, my dear friends. As per section 12.6, place of supply in case of admission to any event or amusement park shall be the place where park is located or the place where event is held. So automatically in this case, place of supply will be Gurugram. I'm so happy to see that majority of the students have replied correct answer. Very good. So quick actually. Good. Appreciated. Next question. Which of the following is a correct statement with respect to GST liability in case of fees paid to Baldev? My dear friends, come on. Fees paid to Baldev, what is the story? Fees paid to Baldev is nothing but fees is paid to director. Only we discussed that GST is payable by Luminous Limited under reverse charge mechanism. We discussed that, everybody. Friends, come on, please reply. Good. Mr. Baldev has got sitting fees amounting to 35,000 in the capacity of director of the company for the month of December. Which of the following statement is correct in this regard? Such amount is taxable in the hands of Baldev and other sources, and the company should deduct tax at source at the rate of 1%. Nonsense. Second, it is taxable under head of salaries. Why salaries will come? It is sitting fees. Next, it is taxable under other sources. Company should deduct tax at 5%. That is also nonsense. Such income is taxable in the hands of Baldev and other sources, and the company should deduct tax at the rate of 10% while making the payment. And for your clarity, let me tell you that TDS is supposed to be done as per provisions of section 194J. And generally 194J has got a limit of 30,000 rupees. But in case of sitting fees, there is no limit. To make you recall, 194J covers some interesting provisions like professional, technical, royalty, non-compete fees, director's remuneration are other than salary. Director's remuneration other than salary. In first 4 cases, the limit is 30,000, but in last case, there is no limit. Some student is telling answer is different in my printout. That you please check. I'm not really sure why it is different in your printout. But this provision, what we discussed, that answer is correct. Clear? Good. Brilliant. Next question. 6th question, that is purely related to your directors. 8th question, that is related to the government grants, financial reporting. 7th question, whether the management's understanding in relation to transfer of solar panel to companies' retail showrooms correct in view of GST law. Also determine place of supply in case of service procured from attorney by Luminous Limited and suggest if company is required to pay tax under reverse charge. Clear, friends? Now, for question number 7, what is the answer? There was 2 interesting points. First one, for transfer of solar panels to showroom, is it taxable? As per section 7(1)(c), read with schedule 1, supplies between distinct or related persons is taxable. Supply between distinct or related persons in the course or furtherance of business is taxable even though there is no consideration. Now, in the given case, transfer of solar panels from factory to retail showroom. Factory to retail showroom would attract GST since they are distinct persons. And by the way, distinct persons means what, my dear friends? GST PAN is same, but GST number is different. We call them as distinct persons. Next. In respect of attorney services, received from outside India, it is regarded as supply, and moreover, it is taxable under reverse charge mechanism, since it is in the course or furtherance of business. That's it. That's the story of this very, very, very interesting case study, wherein we have discussed about the interesting elements related to taxation points in this particular case study. Are we clear with this? Kindly please reply so that I can comfortably proceed.
Now we'll have a look at the next case, which is case study number 7. Now in this case, it is a case about a family who have been residing in a particular village since their marriage. They have been actively involved in agriculture and dairy farming business in their village and sell their output in nearby village. And all those discussions are there as far as the background is concerned. Now here, this particular case study is to do with agriculture. So you can have agriculture dimensions in income tax, GST exemptions related part. Then of course we have a standard on agriculture, Ind AS 41, that can also be tested, right? So this is the background. We'll come to whether we need to read the question fully or not later. Then we have specific issues, some related to tax matter. After the meeting, Mr. Murali was in Mumbai. He wanted to discuss all the tax matters. So we have different tax matters like, with business expansion, Murali has also purchased a controlling stake in Messrs. Khetibadi Limited and is now a director in the said company. He wants Puru to tell him briefly about the performance of his company in tea market as well. Puru tells him that for the previous year, Khetibadi composite business profit before allowing deduction relating to growing and manufacturing of tea is 50 lakhs. So here if you see, this is more pointing towards the profit and gains part of business where you have a combined, like the tea business and all the coffee business, where you apply the percentages. That is what is being discussed here. Then two peculiar transactions related to GST. So if there is a GST related part, we'll come to point number 2. Murali Lal is happy that the business has gone online as well, selling their products to various e-commerce platforms. Mr. Prabhudeva shows his concern over the online selling part and wants CA Puru to keep track on the working of the same during his audit. CA Puru assures him that his audit strategy would majorly based on the fact that good part of the company's business has gone online. So there is something which has gone online. This is a specific aspect where you look at things around audit in an automated environment. In the new syllabus, they have changed the chapter name for digital audit. Also, how audit planning has to be done when it is an online environment. Then, coming specifically to the question. First, an SSC carrying on. So, moment you see SSC related to tax, growing and manufacturing of tea is allowed a deduction under the income tax law upon the fulfillment of certain conditions. So, this is a specific question related to your income tax. Select the correct option based on the following 2 statements. Application of income, diversion of income. So there is some application or diversion of income as a part of the case, which Futeja will be discussing. Again, this is related to income tax. What would be the GST treatment of stock lying? Again, related to GST. Bansuri Private Limited also engaged in sending raw tea leaves to job workers, processed tea with after the job work has been performed. Which of the following form return is to be filed? Again, a specific question on GST. Here is where I somehow don't like institute's way of testing, because they're again testing memory. Okay, which form has to be filled, which return has to be filed, all of that are memory based. These are not business problems. Though they have told this is an integrated business solution paper, this is not a business problem. You'll have tax consultants who will figure out which form is to be filed. So, but still, that is how it is. Then we have a question based on board meeting. We will discuss in part. Now, coming to the descriptive part. Analyze whether the activities as narrated by CA Puru to Mrs. Bansuri Devi with respect to Khetibadi Limited fall within the scope of Ind AS 41 with proper reasoning. Ind AS 41 deals with agriculture and whether the activities of Kheti Badi Limited will fall under agriculture or not, that is the question. Okay, whether activities related to Kheti Badi will form as a part of agricultural income or not, that is the question. So now here we need to understand, not agricultural income, sorry, agricultural activity. Here we need to understand what are agricultural activity as per Ind AS 41 and whether the various activities are considered to be agricultural activity or not. Now here, one more thing you have to keep in mind, similar type of questions is already covered as a part of FR, okay, where we understand whether a particular activity is an agricultural activity or not. So now what do we need to look? We need to look at Kheti Badi. So let us come back, Kheti Badi. So we may have to read this, we have to be slightly quicker in reading so that we save time. So they have been actively involved in agriculture and dairy farming. They have earned much accolades for business they run and have accrued much wealth. So they have become very wealthy. There have been many instances where the couple felt that they could move to a metro town to explore more, but without any knowledge of business world and regulatory compliances, they feel handicapped. Again, nothing to do with the case. Their children are also settled abroad, nothing to do with the case. One fine day, when they are visited by CA Puru, a fast friend of their son, who usually comes down to their village quite often to know about the well-being of his friend's parent from time to time. Okay. Bansuri Devi discusses with him about agricultural operations he manages. Puru tells them about how agricultural activities are maintained and operated in metro towns where he lives and practices his profession. During the discussion, he tells her that one of his clients, Mrs. Kheti Badi, a listed company, is involved in agricultural and allied operations by procuring material from nearby areas. So here is where the Kheti Badi discussion has come. The company is also involved in various other types of animal husbandry operations. Animal husbandry operations are like your poultry farming, then your aspects related to rearing of chicken, cattle, and all of those things. The company is also involved in various other types of animal husbandry operation and works on the same scale as Mrs. Bansuri Devi and Murali work in the village. On getting curious, Mrs. Bansuri Devi asked him about the form and style in which Kheti Badi Limited works in the city. Puru tells her that unlike villages, in corporate world, large businesses have to follow certain accounting standards while maintaining books and balances of their business. Standards related to agriculture set out accounting for agricultural activity, management of the transformation of biological asset. So this is a very key part which they themselves are given in the question. Into agricultural produce, the standards generally require biological assets to be measured at fair value, less cost to sell. It tells about the following activities carried out by Kheti Badi Limited. Now, I read it fully, slowly. But one thing, if you have to observe, the question has just asked us whether the activities are agricultural activity or not. All of this background is just a noise to distract you. So you have to be smart enough to, as you read the questions, what are the things to be excluded? That is what has to be taken care of. Okay. Now, what do? Managing animal-related recreational activities like zoo, first activity. Fishing in the ocean, second activity. Fish farming, third activity. Development of living organisms like bacteria, cells, and viruses for research, fourth activity. Growing of plants to be used in the production of drugs, fifth activity. So there are 5 activities. We need to see whether it forms a part of agricultural activity or not. Okay. So now let's look at Ind AS 41, what they tell us about this. As far as Ind AS 41 is concerned, agricultural activity is management of biological transformation and harvest of biological assets, either for sale, for conversion into agricultural produce or additional biological asset. So here we are talking about management of biological transformation. Means what? For example, rearing of cattle, okay, or let's say poultry farming, or let us say plantation, agricultural plantation. There we are talking about biological transformation. Means reproduction, means reproduction or rearing of cattle. So for example, if you have a poultry farming, the objective is that the hen, they lay eggs, those eggs are sold in the market, or those eggs are hatched and they transform into chickens and those are sold in the market. So that is what is called biological transformation related to reproduction, recreation and related aspects. That is what is covered under agricultural activity, and it has to be management of the same. Management of the same meaning the company must be involved in management of the activity. They have to be managed actively. And what is the purpose? These biological transformed assets, they have to be either sold or converted into agricultural produce or additional biological asset. Now, what is the meaning of agricultural produce? Agricultural produce is harvested product of the entity's biological asset. So, if you have, for example, a paddy field, paddy, the rice that is harvested, the paddy that is harvested is the agricultural produce. If you have, let us say, cow, the milk is harvested product. Okay, so or if you are involved in, let us say, the meat business, then the meat becomes a harvested product. Okay, so that is what is the harvested product. So harvest is detachment of produce from the biological asset. You pick up the fruits, you pick up the paddy, you pick up the grains, or cessation of a biological asset's life process. Like if you, for example, if you are into meat business, so that also becomes your harvest part. Okay. Now, biological transformation relates to growth, increase in the quantity, degeneration, decrease in the quantity, production of agricultural produce, and procreation means additional rearing of additional plants and animals. Now, this is for our understanding. You are not required to explain all of these in the case study answer. What you have to see, whether those 5 activities, they are considered to be agricultural produce or not. Okay. Now, if we come back to the case study, first one is managing animal related recreational activities like zoo. So they operate a zoo. Now, when there is an operation of zoo, the management of the management of the animals here is not for sale, or it is not for additional, biological assets. It is more for recreational purpose. Okay. So if you have to call it an agricultural activity, again, if I go back to the definition, there has to be the management of biological transformation for sale or for conversion into agricultural produce or additional biological asset. Whereas if you are managing a zoo, the management of zoo, if you are managing a zoo, the purpose of management of animals there is not for sale. It is only for entertainment purpose. It is only for recreation purpose. Recreation means not the reproduction part, recreation or entertainment part. Okay. So the first one does not fall within the purview of agricultural activity. So first one does not fall under the purview of agricultural activity, because the purpose is to show the animals to the public, and there is no management of biological transformation, and there is no intention to sell, and hence it does not fall. Then fishing in the ocean, this we have discussed in the lectures Index 41 as well in detail, where there is no management. This management angle is missing here. What do I mean by management? See, if you are running your own poultry farm, or if you are having your own cattle shed, there you are actively managing the animals. In the ocean, you are not actively managing the animals. Fishes will go wherever they want to go. The reproduction part, the recreation part, the procreation part, whatever you say, that is independent. That is managed by nature. That is not managed by the entity. And hence, it is the managed, because it is not managed, it is from unmanaged sources. So fishing in lakes, hunting in forest, and all of those things, those are not agricultural activity, because it is something which is done by the nature itself. Right? Then third one comes fish farming. Now, fish farming, when we say this, we are doing with the help of active management. Say, for example, you create your own pond, or you create your own pool of water, and there you manage the biological transformation of biological asset, and then you harvest those, you fish those, and you sell those fishes. This, because there is an active management, this becomes agriculture. So the distinction you have to understand, here there is no active management, whereas under fish farming, there is an active management, and hence this is a agricultural activity. Okay. Then Development of living organisms such as cells, bacteria, and viruses for research. Now here also, you're developing living organisms for what? For research, not for sale, not for creation of additional biological asset. Because again, I'm again coming back to the definition. Either there has to be sale or conversion into agricultural produce or additional biological asset. None of these are satisfied, so it cannot be an agricultural activity. Okay. Lastly, growing of plants to be used in the production of drugs. Now, growing of plants. When you grow the plants, these drugs are your agricultural produce. Okay. So drugs like, you have this ganja, that is one drug. Opium is a drug. Okay. Legal, illegal, we are not discussing about it. A drug that is cultivated on plants, the harvest of the drug, harvest of the plant is the drug. And what is the purpose? You produce the drug and the purpose is to sell it subsequently. So because you will sell it subsequently, it becomes an agricultural activity. So here in this part, we had to know or understand what is agricultural activity. Now, when you write the answer in the examination, define agricultural activity. And then for each case, tell whether it is an agricultural activity or not with a proper reasoning. Okay, simple one again, but can be highly scoring. Then second, income tax implication of withdrawals from deposit account during the financial year, income tax related thing. What specific factors for online shopping would be considered by CA Puru in formulating the audit strategy of the company in the above case, keeping in mind concern raised by Prabhudeva. Now, what is the concern raised by Prabhudeva? So let us go back. Here is Prabhudeva. Okay. Prabhudeva had informed, oh, this is related to GST. I think. So this part we have read. That is the director of company. Okay. Now here, Prabhudeva had informed CA Puru about two peculiar transactions related to GST. So this is again related to GST. This is not related to audit. They have specifically asked us about what is the aspect or audit strategy. How will we form the audit strategy? Okay. Then, yeah. Mr. Murali is happy that their business has gone online, as well as now they are selling their products to various e-commerce platforms. Mr. Prabhudeva shows his concern over online selling part and wants CA Puru to keep a check on the working of the same during his audit. So here is where the concern is highlighted. Okay, so very important. Here there is nothing to do with audit. Prabhudeva is discussing here also, but here they are discussing about GST. What are they discussing here? Here they are discussing that, okay, we are selling our products to various e-commerce platform. Mr. Prabhudeva has concern over online selling part and wants CA Puru to keep a check on the working of the same during his audit. So he wants, okay, please have additional factors when you are when you are checking when you're doing the audit because of the online selling part. Okay. Then subsequently, whatever is discussed here is tax related matters and all of that. So basically here it is just a reference and we have to address that particular issue. Okay. Now, when it comes to online environment, please remember audit objective does not change. Audit objective does not change. But what we need to do, we need to understand about the entity and its environment. And when we understand about the entity and its environment, then we have to give specific attention to what will happen when there is an online selling part. Now, when there is an online selling part, we have to look at various things like what are the IT systems in place, what are the IT controls in place, how are the transactions captured, how are the transactions recorded, how are the transactions passed on to the accounting system, how is the control aspect tested as far as the information system is concerned. Can we change the information system? Can we change who has the right to change the information system that is being used? Okay, then what kind of controls are there when we record the journal entries, when we record the sale related transactions, inventory related transactions and all of that. So here specific pointers should be towards information system and the control related part in the information system environment. Okay, so let us look at the answer. Specific factors for online shopping. We will obtain an understanding of the information system. This is to do with the understanding of the entity and its environment. Okay. And related business process due to online shopping. First, the classes of transaction in the entity's operation that are significant to the financial statement. So what are the transactions which are significant to the entity's financial statement? And they have said it has now become a major part. They have now said it has become a major part of the operations. Okay. Second, procedures within both IT and manual systems by which those transactions are initiated, recorded, processed, corrected as necessary, and transferred to the general ledger and reported in the financial statement. Now, what is the meaning of this? Whenever you initiate a transaction, for example, you buy something on Amazon, you make the payment. Now, how does that transaction get created, how it is recorded, how you pass that transaction information to the accounting system, if at all there has to be some correction, how it is corrected, all of those things, the procedures part you have to consider. Then, what are the related accounting records in supporting information and specific accounts in the financial statements that are used to initiate, record, process, and report the transaction? So here basically what are we saying? How is the accounting done? And please remember, it may not be the exact same word in the answer in the examination. Though there is a thing that institute wants the same and same wordings and all of that, that can be true for some other theory papers where direct questions are asked. Here you can have slight variations, but the crux has to be present. Okay, so the related accounting records. So when you learn about digital audit, and when you learn about standards on auditing, where you have to understand the business and its environment, from there you will be picking up these pointers. The related accounting records supporting information and specific accounts in the financial statements. So how do you initiate? How do you start the transaction? Record the transaction, process the transaction, and report the transaction. Also, how do we correct the incorrect information? How does the information system captures events and conditions other than transaction that are significant to financial statements? So one is transaction. Other than transaction, for example, how does it capture inventory? Okay. Or how does it capture any erroneous transaction? So how all of those are captured by the system? And what are the controls surrounding the journal entries, including non-standard journal entries used to record non-recurring, unusual transactions or adjustment? Now here, when we say non-standard journal entries means journal entries which are passed one time, which are not passed frequently. Okay. Some journal entries are passed frequently. Some journal entries are not passed frequently. How do we check those non-standard journal entries? So just give me a moment. I'll share some talk. So if you look at essay 315, that talks about identifying and assessing the risk of material misstatement to understanding the entity and its environment. Okay, so this standard becomes relevant because here you are trying to identify what are the areas which require excess focus, where there can be material misstatement, right? So now here, whenever we talk about an IT environment, all of these pointers also become very, very relevant as to in an IT environment or when there are online transactions, you will have to understand the entire information system also. What kind of controls are in place? How do we check the systems? What kind of audit trails are captured? So like this, you can also add additional points that, okay, these are the extra points. So these are the extra aspects that need to be checked. For example, a simple thing could be, how does the entity check whether all the sales that are captured in the online portal, whether they are correctly reflected in the financial statement? In other words, the total sales in the online portal or the online website, is that captured correctly in the financial statement, right? So those aspects you will have to add on when it comes to understanding the entity and its environment. Okay, now we'll move to the next case. So before that, let me just share one more part. Some additional consideration if you have to look at. While obtaining an understanding of the business process and performing the walkthroughs, the use of IT systems and applications should be considered. So what kind of IT systems are in use? So when we are understanding the business process, that also needs to be considered, right? Then while understanding the entity level controls, IT governance related aspects should be considered. So these kind of pointers, if you write, like it's a 5 marks question, if you are able to write 7 to 8 pointers like this, that will be more than sufficient. And one thing you have to keep in mind, especially in a theory answer, we generally don't expect institute will give us 5 marks out of 5 marks. Okay. So even if you're able to score 3 marks out of 5 marks or 3.5, 2 marks out of 5 marks, that also will be a good number. Okay.
Good. Now let me talk about case study 7, my dear friends. Yeah, I'll share the screen. Just a second. Is case study 7 visible for you? Friends, come on, please reply if the case study 7 is visible for you. Yeah, good. Fair enough. Thank you so much. See the case study, guys. This is a slightly interesting case study, so please be very careful while looking at the case study. Mr. Murali and Mr. Bansuri Devi have been residing in Manipur since their marriage. They have been actively involved in agriculture and dairy farming business in their village and sell their output in nearby villages as well. They have earned much accolades for the business they run and have accrued much wealth. That's all time pass. There have been various instances where the couple felt they could move to metro town to explore more, but without any knowledge of business world and regulatory compliances, they felt handicapped. So they're basically in a small village doing some agriculture and dairy farming activity. A lot of times they thought they'll go to towns, but they decided not to go because they are not having much knowledge on business world. One fine day, when they are visited by CA Puru, a fast friend of their son, who usually comes down to their village quite often to know about the well-being of his parents from friends' parents from time to time. Bansuri Devi discusses with him about agriculture operations he manages with the help of a team in the village. And the scale of operations they maintain. Puru tells them how agriculture activities are maintained or operated in metro towns like Mumbai, where he lives and practices his profession. During discussion, he tells her that one of the clients, Kheti Badi Limited, a listed company, is involved in agriculture and allied operations by procuring material from nearby areas. This company is also involved in various types of animal husbandry operations and works on same scale as Bansuri Devi and Murali work in their village. On getting curious, Bansuri Devi asked him about the form and style in which Kheti Badi works in the city. Puri tells her that unlike villages in corporate world, large businesses have to follow certain accounting standards while maintaining books and the balance of their business. Standards relating to agriculture set out accounting for agricultural activity, management or transformation of biological assets. That's all your accounting standards. That's all your accounting standards. Yeah. Hearing about this, Bansuri Devi persuades Murali Lal to set up a company in town under Puru's guidance to expand their business outside village as well. Wow! Finally, they decided to come out of the village. CA Puru assures Mr. Murali Lal on all his queries and tells him that he and his team will help them at every step in setting up their company. Soon the couple, with the help of Puru, set up and started their company in Mumbai under the name and style Bansuri Private Limited, which ventured into business of agriculture operations with Murali Lal, Bansuri Devi and Prabhudeva as directors of the company. Prabhudeva is appointed as MD as the former directors are already busy in the business at Manipur. Company got registered under GST solely in the state of Maharashtra. Keep this point in mind, that company registered in Maharashtra. During the year, company falls short of fund and they decided to borrow funds from the market. Board of directors of the company resolved to borrow some of money. That's your company law. I'll not talk about it. Good. Now comes our tax part. After the meeting, since Murali Lal was in Mumbai, he wanted to discuss all the tax matters with Puru and sit with him in his office for the same. With business expansion, Murali Lal has also purchased controlling stake in Kheti Badi Limited, where they started, where they reached, and is now a director of the company. He wants Puru to tell him briefly about performance of the company in the tea market as well. Puru tells him that for previous year ended 31st March 2023, that means for financial year 22-23, Kheti Badi's composite business profits before allowing deduction relating to growing and manufacturing tea is 50 lakhs. So the moment they use the word tea, you should recollect Rule 8. In case of growing and manufacturing tea, there is a Rule 8 which clearly says 60% is agricultural income, 40% is non-agricultural income. Clear? And let me also tell you, in PGBP, there is one brilliant section called section 33AB, which talks about tea development account. In case where you transfer money to tea development account, whatever you transfer or 40% of profit, whichever is lower, that is allowed as deduction. A brilliant point actually. On 1/9/23 deposited 10 lakhs in tea development accounts. During previous year 21-22, this company has incurred a business loss of 15 lakh rupees, which has been carried forward. Okay, fine. We'll set off now. They have got time limit of 8 years for set off. On 25/1/24, it withdrew 10 lakhs from deposit account. Generally, when you withdraw, you have to use it only for a business purpose only, but not for any office setup and all. 6 lakh for purchase of non-depreciable asset as per the scheme. No problem. As per the scheme, so no problem. 3 lakh for purchase of machine to be installed in office premises. Silently pay tax. Because it's not for, if it is purchase of machinery for office, guest house and all, then they'll not allow anything. Whatever money you have used for that purpose, you have to pay tax now. 1 lakh was spent for the purpose of the scheme on 5/4/24. This is also not considered. I'll tell you why. He has withdrawn on 25/1/24. That means financial year 23-24. In which year they have withdrawn, that year only it must be utilized. There is a concept of same year utilization. If it is different year, then gone. It becomes taxable. Next. Murali wants to know about the income of the company for the year and tax liability for any thereon, and about which CA Puru gives him an approximate idea at that time itself. Now I'm sure they'll ask question on this to us. Prabhudeva had informed CA Puru about 2 peculiar transactions related to GST, which he want to discuss in the presence of Murali, related to Bansuri Private Limited. In one of the cases, they send raw tea leaves to the registered job worker under GST, Mr. Sharma in Bangalore, Karnataka. And further, the processed flavored tea, which is further delivered to wholesalers in Telangana from the job worker premises in Bangalore itself with invoice and e-way being issued by Companies Department Mumbai office. Very good. This is practically very much followed. So for example, if I am a principal sitting in one state, I am sending raw materials to the job worker who is in another state. That job worker will convert that raw material to finished products. And from the job worker premises itself, I'll supply finished products. Very much possible. Further, he asked him about the treatment of another transaction. They had sent a special lot of tea, Rosa, to another job worker, Mr. Shakti Puri in Ratlam, for making flavored tea as per directions given. Further, due to decline in market of flavored tea, they sent fresh, normal, unprocessed raw tea with new instruction to the job worker to hold the earlier consignment in stock till a buyer is found. And the new stock is easily sold, but the old stock is remained in godown of the job worker for over a year. CA Puru guides them properly about tax treatment of this 2 transactions. Tell me guys, what is going to happen if goods are sent to job worker and if they are not coming back? Is it okay? Come on, I want to hear from you. Is it okay, my dear friends? Generally, goods are sent principal to job worker, and here we observe the goods are not being returned. Generally, once the activity is over, the goods must be returned. Good. Some are telling taxable. must be returned within 1 year. Very good, very good. But let me tell you, the time limit for return is 1 year normally, but for capital goods, there is a time limit of 3 years. But this time limit will not apply for molds and dies, jigs and fixtures, and for tools. And since it did not come back within the time, it will be deemed to be supplied. It will be deemed to be supplied. And they have to end up paying GST. Student is telling section 18. My dear friend, let me tell you, it is not section 18, it is section 19. It is section 19. Section 18 talks about some interesting element called, repeat once again, section 18 talks about interesting element called availability of credit under special circumstances. Section 19 is job work. Got it? Are you clear, my dear friend? Good. Student is asking, sir, what is molds and dies? Sir, what is molds and dies is basically, molds and dies are some kind of tools which are used for the purpose of giving that shape to the products. Next point. Murali is happy that their business has gone online as well. So nice of it. And now they are selling their products to various e-commerce platforms. Mr. Prabhudeva shows his concern over the online selling part and wants CA Pro to keep a check on working of the same. And CA Pro assures of the auditing strategy. Auditing strategy not related to tax. Next. In the evening, Mr. Purulilal takes Puru to meet him. Purula with him to meet his old friend, Mr. Babulal, who resides in Mumbai with his family. Mr. Babulal had requested him for a meeting with Puru so that he could discuss with later certain tax-related issues of the family and hire his services for tax-related work. Babulal tells Puru that his son Gautam is liable to pay 10,000 per month to Barka, his ex-wife, as alimony. Alimony is basically given after the divorce. Gautam, being an employee of PQR Limited, has instructed his company's HR department to pay 10,000 per month out of his salary to his wife directly and remit remaining salary in his account. So what? Whose earning income is nothing but Gautam? Whose earning income is nothing but Gautam? Next point. Further, he tells CA Puru that he works under a partnership firm in which he and his other two sons, B and C, are partners. The partnership deed provides that after his death, B and C shall continue the business of the firm, subject to condition that 20% of the profit of the firm shall be given to Mrs. Daya, who is wife of Babulal. And Babulal wants to know the tax treatment of the receipt in wife hands after his death. Puru satisfies Babulal by solving all his query and quotes his fees to handle all the tax-related matters of the family. I'm sure you would have heard about this interesting concept, my dear friends. That is about the story of diversion of income and application of income. To call it as diversion of income, there must be something called overriding title. Overriding title. A legal obligation. Next. An multiple choice question. An assessee carrying on the business of growing and manufacturing tea is allowed deduction under income tax law upon fulfillment of certain conditions, like depositing amount in deposit account opened in accordance with a scheme framed by T-Board. Scheme framed by what, my dear friends? T-Board. Deposits made in accordance with scheme framed by other boards for agriculture commodities also will qualify for similar deduction. Which of the following schemes would qualify in this regard? So there's something called coffee board, rubber board also. See the options. Coffee board, spices board, no. Rubber board, spices board, no. Coffee board and rubber board, that is the answer. Like how we have got tea board, we also have something called coffee board and rubber board. And the last option is coffee, rubber and spices. That is also not okay. Next. Select the correct option on the basis of following two statements. Payment of 20% profit to Mrs. Daya is application of income. Answer is definitely no. It is called diversion of income because in agreement, it is already mentioned. It is by way of a legal obligation that if the person dies, 20% will be given to the wife. Next. Payment of alimony by Gautam to his ex-wife is diversion of income. How can that be regarded as diversion of income, my dear friends? It is not a diversion of income because there is no legal obligation of such. 10,000 per month, whatever Gautam is supposed to pay, it is a Gautam's obligation. But it is not an income on which she is having some overriding title as such. To call it as a diversion of income, there must definitely be an overriding title. Getting the point, everybody? Sir, speak out. Good. So first point is a diversion of income. Second point is what, my dear friends? Second point is an application of income. So both the statements what they gave are incorrect. So when I say both the statements are incorrect, the option is nothing but option D, my dear friends. Student is asking, sir, which topic explains about diversion of income? So let me tell you, this diversion of income, application of income is covered in the basic concepts of income tax in the first chapter. And to call it as diversion of income, there must be an overriding title. Overriding title. That's an important point. Good. Next point. What else they asked? What would be the GST treatment of the stock lying with what, my dear friends? Mr. Shaktipuri, the time limit is over. 1 year, 3 years. What will happen, my dear friends? What will happen? Come on. Then automatically what will happen is tax will be payable. Tax will be payable by Bansuri Private Limited on its removal from the premises of Mr. Shaktipuri. So getting my point? And let me tell you, my dear friends, answer is not option B. Answer will actually be option D. Because tax will be payable on its removal from premises of Shaktipuri, my dear friends. You have to observe the point very clearly here. They had sent a special lot of tea, Rosa, to another job worker, Shaktipuri, for making a flavor tea. But due to decline in market, they sent fresh, normal, unprocessed raw tea with new instruction to job worker to hold the earlier consignment till a buyer is found. And the new stock is easily sold, but the old stock remaining go down. Got the point? And now what is that they have asked? What will be the GST treatment of the stock lying with Shaktipuri? Tax will be payable by Bansuri Limited on its removal from premises of Shaktipuri. Are we getting clarity on this point? So for the third question, the answer will be option B, my dear friends. So the unprocessed tea and all, whatever they send to job worker, my dear friends, that will be deemed as supply and the tax will be payable by the company, my dear friends, very, very clearly. In fact, you have to observe one point here. I'll tell you something interesting. Hold on. They're actually talking about the stock which is lying with Shaktipuri, right? Oh, wait a second. Sir, that's an interesting point here. Listen. They have sent a special lot called Tea Rosa to another job worker, Shaktipuri, for making flavor tea. But due to decline in the market of flavor tea, they sent fresh, normal, unprocessed tea with a new instruction to job worker to hold the earlier consignment in stock. So what is kept in stock? What is kept in stock, my dear friends? That old tea is kept in stock. And the new stock is easily sold, but the old stock is in go down. And they are asking for the guidance. Now let me get back. Hold on. What is that they have asked, my dear friends? What would be the tax treatment of stock which is lying with Shaktipuri? Oh, they are asking about the stock which is lying with Shaktipuri, not about the new stock. So for the stock which is lying with Shaktipuri, my dear friends, sorry. For the stock which is lying with Shaktipuri, my dear friends, straight away tax will be payable by Bansuri Private Limited. The answer is option B, my dear friends, not option D. I'll tell you why. Because option D will come normally when principal is sending goods to job worker. Job worker is doing a further supply. If job worker is doing further supply from the premises, principal is liable to pay tax. That is a normal situation. But here they're asking only about old stock. old stock which is not returned within 1 year or within 3 years, 1 year for input, 3 years for capital good, then it is deemed as supply. Then it is deemed as what, my dear friend? Supply, and the tax shall be liable to be paid. So tax is payable by Bansuri Private Limited. Very, very interesting point. See, B point, D point look so close. But they ask about old stock which is lying. Very good. What a brilliant point they asked. Guys, if you get a clarity on this, please reply. Everyone, sir, I'm waiting for an answer. Good. Thank you so very much. Let me proceed. Fourth bit. Bansuri Private Limited is also engaged in sending raw tea leaves to job worker and selling processed tea after job work. That is normal story. Which of the following forms have to be filed? Straight answer, ITC 04, my dear friends. Practically also, we file this form called ITC 04, which is something which is mandatory to be filed. ITC 04, the whole purpose of ITC 04 is to declare the details of the stock which we have sent, and also to declare the details of the stock which have been returned from principal to job worker and from job worker to the principal. Clear, everybody? So which form is supposed to be filed? ITC 04. Are we clear, everyone? Done. Good. What else are asking? Fifth question is with respect to board meeting, that I will not talk. Next. First bit, activities narrated falls within AS41, Ind AS 41. FR. Eighth question, audit strategy, that also I will not talk. You are required to state income tax implications of withdrawal from deposit account. As I told you already, how much amount has been withdrawn, my dear friends? Amount withdrawn is totally 10 lakh rupees is what he has withdrawn. Correct? Let me highlight that. How much he has withdrawn is, let me go back to the question. How much he has withdrawn is totally 10 lakh rupees what he has withdrawn. Out of 10 lakh rupees, 6 lakhs is utilized for the purpose as per the scheme. So that will not be taxable. And 3 lakh is utilized for purchase of machinery installed in office. That is taxable because office is not allowed. And 1 lakh was spent after the time limit got over. What is the time limit? Same year utilization. So this 1 lakh also will become taxable. So technically 4 lakh will be taxable. And on that 4 lakh also we will tell, on that 4 lakh also 40% is taxable. Because we'll apply the logic of 60-40. We'll apply the logic of what, my dear friends? 60-40. Are we getting clarity on this point? Friends, are we clear with this? Let me show you the working also. In case of tea business, 60% is agricultural income and 40% is non-agricultural income. This is given by Rule H. And what is the profit of the business they told? Let me see the question. Profit of the business they told is 50 lakh rupees. And out of that 50 lakhs, I'll reduce, my dear friends, something called deduction under section 33AB, which is amount deposited. What is that line, my dear friends? Amount which is deposited. Amount which is deposited in tea development account, or 40% of profit, whichever is lower. 40% of profit, whichever is lower. Student is asking, sir, can you please tell this again? I'm telling that, my dear friends. So what is the profit of business is 50 lakh rupees, my dear friends. And we'll take deduction of a brilliant section called 33AB, which clearly says that whatever you deposit in tea development account, my dear friends, within 6 months from the end of previous year, that will be considered action. or 40% of profit, whichever is lower. How much did he deposit? He deposited 10 lakh. 40% of 50 lakhs is how much? 20 lakh rupees. So deduction what I'll take is 10 lakhs. Getting my point, everybody? And what is the balance, my dear friends? The balance is nothing but, one second. The balance is nothing but 40 lakh. And on that 40 lakh, my dear friends, the business income will be 40 lakh into 40%. Business income is obviously 40 lakh into 40%. And from that, I'll reduce. There is some brought forward business loss, of which year, let me check. Brought forward business loss of previous year 21-22, and the business loss figure is 15 lakh rupees. Business loss figure is 15 lakh rupees, my dear friends, what they have given in the question. So business income, which is taxable, will be 16 lakh minus 15 lakhs, which comes to 1 lakh. And of course, apart from the story, 4 lakh, which is not utilized as per the scheme, is also taxable. However, business income would be 40% of 4 lakhs, which comes to 1.6 lakhs. So this is the beautiful story of this brilliant section called 33AB and this interesting case study, my dear friends. I strongly believe that you got very good clarity on this point. Kindly please reply. If you still have some doubt, I'll explain once again. Are you fully clear, my dear friends? Please reply. Good. Thank you so very much. In fact, this is a very, very, very interesting case study. Something different, something peculiar. Student asking, sir, that 1.6 lakh will be included with 1 lakh, sir? Yes. Business income that is taxable will be 1 lakh and 1.6 lakhs. Correct. That is about case study number 7.
Now, let us move on to the next case. Case study number 8, which is discussing about LWS and Company, a chartered accountant, which has been in practice since 2006 in Delhi. And they have given the background of the firms and so and so. Then they have given different pointers. So who are the people? Subhas, Ashish, Manoj are articles of the firm. CA Harsh Bhatia, Nikhil Grover, and Shakshi Ahuja, respectively for the prestigious client. So you have 3 articles and 3 chartered accountants who are working. That is what is the context. Okay. Then CA Harsh Bhatia is working on the applicability of Ind AS for various clients. The firm has prestigious client, Shivani Construction, and they have given the details of that. Now, if you look at this particular aspect, elevator, other cost related to construction, Ind AS, something should strike your mind that you have learned in Ind AS 115. This question, specific question, has also been asked directly in the financial reporting paper. We have this specific question is there as a part of your Ind AS 115 question in the study material as well, where if a contract is performed over a period of time, how do we measure revenue? And in this specific case, if certain conditions are satisfied, then in that case, we will not recognize it using the proportionate method. We will recognize only to the extent of cost incurred. That is what we'll be discussing. But if you did not recall that question, it is time to go back and redo Ind AS 115 because this is a very, very standard question from Ind AS 115. Okay. Then CA Nikhil Grover handles tax department. So this is related to taxation. Will be handled by Shivteja when he does it. Mr. Amit, the director of SSI Private Limited, visited CA Sakshi Ahuja, who is handling all customs related. Again, will be taken care by Shivteja. Now, MCQs. First is customs. Second, again customs. Third, customs. Fourth, income from other sources. Fifth, existence of which conditions would make it appropriate for Shivani Construction to recognize revenue only to the extent of cost incurred. For refreshing our memory, let us go back to Ind AS 115 and see what does Ind AS 115 has to say in respect of such scenarios. Okay, so just a moment. Okay, so I don't know, but I'll explain it to you separately, and then we'll take up the question. Okay, so coming back to the question. Existence of which of the following would make it appropriate for Shivani Construction Private Limited to recognize the revenue only to the extent of cost incurred? Now, this is done in a scenario where normally when there is a performance obligation satisfied over a period of time, what we follow is proportionate method. Means how much cost has been incurred out of the total expected cost, how much cost has been incurred. So we'll follow either the input method or the output method. Based on the proportion, we recognize the revenue. But in some cases, it is not appropriate to recognize the revenue as a percentage of cost on incurred. And the reason there is that some part of the cost that has been incurred, actually the entity has not done any kind of work or has not done any significant component of the work. Okay, now in such scenarios, we cannot or we should not use the proportionate of input method. Okay, now when we are applying input method in this particular case, the company estimates the following with respect to the contract. Transaction price is 60 lakhs, elevator cost is 10 lakhs, other cost is 35 lakhs. The company purchased the elevators and they are delivered to the site 6 months before they will be installed. So if you look at the timeline, this is 0, this is 6. Today itself, the elevator has been sent to the site. Today itself, elevator has been sent to the site, which means 10 lakhs of cost has been incurred. 10 lakhs of cost has been incurred. But did we do any work related to that elevator? We have not done any work related to that elevator. Okay. Now, if the elevator has been delivered and if this elevator is controlled by the customer, means the customer will get the control of the elevator. For example, if you deliver the elevator, the lift to the site, before the lift has been installed, the customer, if he gets the control of the elevator, means nobody else can use that elevator. And this particular work, installation part will happen after 6 months. So you cannot separately identify that as a distinct performance obligation because elevator installation has to be completed. It is not only delivery of the elevator, it is the delivery and the installation of the elevator. Delivery is completed, means 10 lakhs of cost is completed. And do we manufacture elevator? The company uses an input method to measure the progress. Company has incurred actual other cost of 7 lakhs. Account team of the company is facing difficulty in recognizing revenue. So they have approached CA with the facts. Okay. Now, generally in case of elevators, what happens is this company will buy the elevator from an outside party, immediately deliver that elevator to the site. That elevator has now has come under the custody of the customer or under the control of the customer. But is this a performance obligation separately? No, because they are a construction company. The company contracts to renovate a building, including installation of new elevators. Installation of new elevator is not a separate performance obligation. It is a package. It is a package. Now, what the problem happens is, if you understand the underlying logic of the problem, then it becomes easier. If we say 10 lakhs of elevator cost is incurred, okay, out of plus 7 lakhs of actual cost out of 45 lakhs. Then if you see this percentage, 17 lakhs divided by 45 lakhs, if you do, the percentage comes to 17 divided by 45, which is 38%, 37.7%. Whereas on this 10 lakhs, which is a significant component or significant portion of the total cost, if you see, practically no work has happened. Only you have delivered the elevators, work has not happened. So if work has not happened, what the standard says is, don't unnecessarily estimate a higher revenue. Keep this 10 lakhs aside, keep this separately. And so just coming back, 37.7% of 60 lakhs if you do, into 60 lakhs if you do, the revenue that comes is 22.6 lakhs. But what the standard says is, on this elevator, you have not done any significant work. So on those elevator, don't recognize any extra revenue, only recognize cost of this elevator as revenue. And balance 7 lakhs out of 35 lakhs, that is 20% of the balance amount, means 60 minus 10 if we do. So basically what happens, 60 lakhs is the total consideration, 10 lakhs is elevator, balance is 50 lakhs. So the standard says only on this balance 50 lakhs, recognize revenue of 20%. So recognize 50 lakhs into 20%, that is 10 lakhs, plus cost of elevator, that is 10 lakhs, total revenue is 20 lakhs. So indirectly what the standard is saying is, don't recognize 22.6 lakhs, recognize only 20 lakhs, right? So whenever there is a scenario where the goods are not a distinct performance obligation, customer obtains the control of those goods, cost of the goods is significantly higher or significantly relatively higher as compared to the total cost, and the entity, very important, entity just purchases the goods from a third party and delivers it to the customer. Purchase from the third party and delivers it to the customer. In that case, we restrict the revenue recognition to the extent of cost. Now the MCQ that is asked us is, which of the following conditions would make it appropriate for Shivani Private Limited to recognize revenue only to the extent of cost incurred? Okay. Now, first thing is, the goods do not present a distinct performance obligation. So this has to be satisfied. If it is a distinct performance obligation, you can recognize the, what do you call it? If the distinct performance obligation, you can recognize the sale value. But it is not a distinct performance obligation, this condition has to be satisfied. Then, second, the goods represent a distinct performance obligation. This condition should not be satisfied. If this is satisfied, then you can recognize the full revenue. So option 1 is correct. Customer is expected to obtain the control of the goods significantly before receiving the services. This is also correct. Cost of such goods is significant. The cost has to be significant. Entity procures the goods from a third party and does not significantly involve in designing and manufacturing the goods. So the entity is directly procuring it from the third party and handing it over to the customer They are not carrying out any work. If they carry out work, then they can recognize revenue. So 4, 5. If you see, 1 is correct, 1 except 2. So 2 is not needed. So 2 is not needed. A is wrong. This is wrong. This is also wrong. Option B is the correct answer. Any question on this? Is it clear? Same question you can see in the financial reporting Ind AS 115 thing. So if you see, a lot of questions are directly being picked from the study material and they have been presented as case scenarios, right? Now, descriptive question. Compute the total income. This will be treated as a part of your taxation. How will Shivani Construction Private Limited recognize revenue as per the relevant Ind AS if performance obligation is satisfied over a period of time? Now, if performance obligation is satisfied over a period of time, then what do? We recognize revenue based on what? Based on the aspects related to proportionate completion of the cost, right? So as and when the performance obligation is satisfied, as and when it becomes progress, the contract progresses, we will measure the progress of the contract. And whatever percentage is completed, we will recognize to the extent of cost incurred as a proportion, as a percentage of the total progress. So basically what I mean here is, whatever is the total cost and whatever is the actual cost, whatever is the expected total cost and whatever is the actual cost, this percentage we will use to recognize revenue. Now, as we have already discussed, out of the total revenue of 60 lakhs, on this elevator, significant work is not done. On this elevator, significant work is not done. So as far as elevator is concerned, the entity will separate this elevator component, and you will have a distinction of 60 lakhs and 10 lakhs and 50 lakhs. So the way it would work is, I can just directly show you the solution. Out of this total transaction price of 60 lakhs, what you will do is, total transaction price is 60 lakhs. You will see how much is elevator, how much is others. Elevator is 10 lakhs, others is 50 lakhs. 10 lakhs revenue will be recognized to the extent of 10 lakhs, that is to the extent of cost. Others, expected cost is 35, actual cost is 7, percentage is 20%. Okay, now if percentage is 20%, 20% of 50 lakhs will be recognized. So you will recognize 10 lakhs of revenue. So the total revenue to be recognized is 10 lakhs plus 10 lakhs, 20 lakhs. So that is how the revenue will be recognized. So for cost incurred other than elevators, total revenue 50, work completed 20, revenue to be recognized 10 lakhs. Revenue for elevators equal to the cost concerned, recognized to the extent of 10 lakhs. Okay, so we'll pause here. We have discussed 3. I thought I'll be able to discuss the 4th case study also, but we have been able to complete 3. In the next class, Shivteja will be taking the balance case study related to taxation. These 3-4 case studies are very, very heavy on DT and IDT. So it will be a very good practice for you, followed by law related part. Okay. So Saturday and Sunday, we don't have classes. So you can revise the case studies that we have discussed. If you have any question on case studies, Saturday and Sunday, whatever we have discussed so far, or whatever theory we have discussed so far, you can feel free to ask the questions in the group or in the forums. We'll be happy to respond to them. Okay. Thanks a lot. And we'll continue with, so once Shivteja completes his taxation and law part, in the next class, I'll be completing the case study number 10. Okay. Now I want all of you to do one thing over a period of time as you approach the examination. Get into the habit of reading questions faster. Okay. Practice reading. Practice reading means what? Read more case studies, whatever you have completed, new case studies that we have. Practice reading them, because in the exams, unless you are able to read and highlight the important points, it will be very difficult for us to solve the question in the given time. So reading speed is very, very important. Okay, I know we are just 45 days to the 40 days to the examination. In fact, it's a short period of time, but still, for 10 to 15 minutes a day, a simple thing could be turn the page upside down. So what you can do is, to improve your speed, you can read it like this. Okay, besides company relates matter. So this will create images in your mind, which will help you to improve your study. Even if you practice 10 minutes a day of this for the next 30 days, your speed will dramatically increase. Just flip the paper and read. Okay, second thing what you can do whenever you are reading a printed material. Okay, whenever you are reading a printed material, what you can do is have an imaginary line here and focus your eyes. So you should not do something like, a lot of us have this habit. You put your finger here and you keep on dragging the finger and read it. That is a very, very slow way of reading. What you should do is focus here and move your eyeballs. Don't move your fingers or don't move your head. Just move your eyeballs as you are reading. That will actually improve your speed. I'm just asking 10 minutes a day, not 1 hour, 2 hours. 10 minutes a day, if you are able to do this, I bet your reading speed will significantly go up. How's your reading opposite? Okay. Try this, no? It is just not to understand the question. So here, can you see internal discussion on government policies indicate that revenue of Spun Limited is estimated to fall by 20% in coming 3 to 5 years. Are you able to read this line? So flip your book. This actually has improved my reading speed like anything. So can you read? On 1st of April of 2022, Sa Fashions Limited acquired 100% of Spun Limited for 5 lakhs, which was into cotton spinning business. Fair value of the net identifiable assets. We can read because mind identifies images. So that is the first technique. Second technique is don't do like this. Put a finger here and keep on dragging the finger. That's a very slow way of reading. Focus on the center of the page. Move your eyes left and right. 10 minutes a day or 15 minutes a day. Because when you get long case studies, you have to be able to read faster. Not only that, even in normal questions, sometimes institute goes crazy and they will give you 2.5 page or 3 pages of questions. You have to read it fast. So that is how you can improve your reading speed. Try it. It will definitely help all of you. Okay. Sure. Thanks a lot. And the next class again will update in the group and we'll continue.
Next. Case study number 8. Today, let's discuss this case study also, my dear friends. Are we ready? Are we excited to look at one more interesting case study, guys? Yes, my dear students, please reply. Good, very good. I love the participation. That's how it has to be. Good, excellent. Is case study 8 visible for you? Friends, is case study 8 visible for you? Kindly please reply. Yes? Good. Shall we start? Ready, come on. What is the first name? LWS, a chartered accountant firm. What is that firm? Chartered accountant firm has been in practice. What is that doubt student is asking? Nothing, no doubt. Yes. LWS Co, a chartered accountant firm, has been into practice since 2006 in Delhi. CA Suresh Shah and CA Harvinder Kaur started their firm after practicing individually for almost 2 years. And now the firm has grown into big firm as 5 partners. Very good. The partners of the firm have contributed various articles on the subject of direct tax and allied laws in the professional journals and magazines. The clientele encompasses various segments, that is software education, NGOs, government bodies, real estate, construction, jewelry. Lot of multiple clients are there. Over the years, the firm has evolved into a renowned professional firm that has worked on various assignments ranging from statutory audit, management audit, income tax planning, FEMA consultancy, GST, everything they are doing. That means in this question, income tax also will come, GST also will come. Get ready. The firm has a unique way of training its articles by involving them with experienced partners on crucial projects so that they are able to learn and understand practical issues arising in different industry. Very good. That's what a lot of firms do. Currently, Subhash, Ashish and Manoj, being articles of the firm, are working with Harsh Bhatia, Nikhil Grover and Sakshi Ahuja. Subhash assisting CA Harsh Bhatia. Currently, Harsh Bhatia is working on applicability of Ind AS. I think I will not talk about it. Yeah. Ashish is assisting CA Nikhil Grover. Nikhil Grover handles tax department of the firm. That's our job. Final calculation of income tax and tax planning is being headed by CA Nikhil Grover. He is nowadays being assisted by Mr. Ashish. One of the oldest client of the firm is MVS Private Limited. Accountant of the company approached Nikhil Grover for calculation of final tax debit of the company. And Nikhil assigned the work to whom, my dear friends? Mr. Ashish. And accountant has showed the financials of the company to Ashish as below. Profit and loss of MVS Private Limited shows a net profit of 75 lakh rupees after debiting following items. This is like how you know a PGBP question is being integrated in Integrated Business Solutions paper as a case study. It's clear PGBP question. This question came in CFNL direct tax so many times. And the same question they put in the case study. See that. 2 lakh is contributed to Employees Welfare Trust, which is not required as per any law. That means it is contribution to a non-statutory fund. If it is contribution to non-statutory fund, that will be disallowed as per section 40 capital A 9, my dear friends. As per section 40 capital A 9, contribution to non-statutory fund, that will be disallowed. Next. 7,80,000 is paid towards course fee and hostel expense for MBA course of close relative of director and is not in employment with the company. If he is not in employment with the company, if he is relative of director, is it a business expenditure? Answer is no. There are a lot of court rulings where they clearly told it is not allowed as deduction because it is not incurred for the purpose of business. Next. 3.5 lakhs are incurred expenses on installation of traffic signal so as to facilitate employees coming on time to overcome traffic jam and save office time. There is a very, very popular ruling of Bangalore High Court, my dear friends. Karnataka High Court ruling in case of Infosys, where they clearly told expenditure incurred on installation of traffic signal is clearly a business expenditure because it is basically to facilitate employees to come on time. It is in the best interest of business and shall be regarded as business expenditure. And once it is business expenditure, deduction is what, my dear friends, allowed. Next. 3 lakh is spent on gift articles distributed to various dealers under a company's sales incentive scheme. That also, my dear friends, we can take it as deduction. There are a lot of rulings for this. In fact, there is one Punjab and Haryana High Court ruling in the case law called Averi Cycle Industries, where they clearly told that in case of this gift items and all, it is regarded as a business promotion expenses. It is purely commercial in nature. Next. 3 lakh is the amount paid in March 2024 consequent upon change in currency rate due to fluctuation in excess of amount due to supplier of machinery. And it is second-hand machine acquired and put to use on 10 September. So it is related to machine. You add it to the cost of asset. Why did you take in P&L? So add back to the profits. And of course, we'll add back to the profit and claim depreciation. Oh, before that, there is one more point, point 5. Once again. 6 lakhs is being expense incurred on traveling of what, my dear friends? Wife of MD, who accompanied him on tour to Singapore on invitation of Trade and Chamber of Commerce Singapore. What do you think will happen, my dear friends? His wife has accompanied him. And wife has not come for time pass. His wife has come because it is on account of invitation of Trade and Commerce Chamber Singapore. Good. Lot of people are telling answer is allowed. Fantastic. Correct answer actually. There is one Delhi High Court ruling in one case law called Hero Honda Limited, where they clearly told if expenditure is incurred on the wife of MD on the invitation of the Trade and Commerce Chamber, it is allowed as a business expenditure. It is allowed as what, my dear friends? Business expenditure, purely on commercial consideration ground. It is for the purpose of commercial expediency, my dear friends. Good. 7th point. 18,000 and 9,000 is paid in cash on 25th August 2023 by 2 separate vouchers to a contractor who carried out repair work in office premises. 2 vouchers are separate, but it is paid on same day. It is paid on what, sir? Same day. Section 40 capital A3. Every CA student knows this. Single person, single day, paying more than 10,000, please pay only by account pay check, account pay draft. Online also is okay. If other than account pay check, account pay draft, it is not allowed. So what do you do that? Add back. Interest of 2 lakh was paid in September to a company on a loan taken from it. Tax is deducted at source in 23-24 and it was deposited in April 2024. Very good. Fantastic. No disallowance will come. Because if tax is deducted at source and it is deposited with the government on or before due date of return of income, then disallowance will not apply. Somebody is telling not allowed. Why it is not allowed? It is definitely allowed. The reason being very clear that section 40A1, 40A1A, in case of payments on which TDS is applicable, if TDS is not done, it is disallowed. Second case is TDS is done, but not paid to government on or before due date of return of income. That case also it is disallowed. Here in this case, it is paid in April. Then why disallowance will come? No disallowance at all. Getting the point, everybody? Good. Next. Additional information. Audit fees of 6 lakhs was credited during 2022-23 without deducting tax at source. 22-23, previous financial year. And such fee was paid to auditors in September after deducting tax under 194J. And the tax so deducted was deposited on 7th December 23. And 30% of audit fee was disallowed in computing income for financial year 22-23. That means in 22-23 it is disallowed. When 22-23 it is disallowed means now for 23-24 it will be allowed. When 22-23 disallowed means for 23-24, my dear friends, it will be allowed. Now allowed because it is clearly a case of timing difference. It's clearly a case of what, my dear friends? Timing difference. Got my point, everyone? Good. Next point. During the financial under consideration, company, what did they do, sir? They purchased 10,000 shares of AB Private Limited out of its total 2 lakh shares. At 40 rupees per share they purchased. And the market value on the date of transaction is 60 per share. When the market value is 60, they purchased at 40, difference is 20. Difference is what? 20, my dear friends. Difference is what? 20 per share. Just a second. Difference is 20 rupees per share into 10,000 shares, which comes to how much, my dear friends? How much it comes to? It comes to 2 lakhs. And that 2 lakh, my dear friends, will be taxable under income from other sources, as per one brilliant section called section 56(2)(10), the concept of gift. The concept of what, my dear friends? Gift. Literally, one direct tax straight question is put in the case study. That is how it is. If this comes like this, it is very scoring actually. Yeah. Manoj assisting CA Sakshi Ahuja. Mr. Amit, the director of SSI Private Limited, visited CA Sakshi Ahuja, who is handling all customs related works of the clients. Now comes GST and customs, indirect taxes. Company imported a machine from USA by air, for which details are given as under. Purchase cost is $7,000 in foreign currency. Accessories worth $2,000 are compulsory supplied with machine, and price of which is included in the price of machine. Very good. It is a part of supply. We'll include that part of the cost. Air freight. If goods are imported by air, we'll take actual freight or 20% of FOB, whichever is lower. Insurance, actual is going to take actual. Local agent commission, but it is not buying commission. If it is not buying commission, then we'll add it. Before FOB only we'll add. Exchange rate 70. Customs duty rate 10%. Accessory 20%, so what? But still we'll take 10% only because we'll take the base rate only. Next. Integrated tax 12%. Social welfare surcharge 10%. So first we'll calculate BCD, then we'll add something called social welfare surcharge. Social welfare surcharge. Then we'll also add something called IGST at the end. Clear? Done. See, proceed. Friends, come on, please reply. Did we get a clarity on this question, my dear friends? A very, very interesting question actually. No doubt about it. And this question, it is clearly a question where they have covered the concept of what, my dear friends? They have covered the concept of direct tax one question, indirect tax one question. Those two are covered directly. Done. See the question. With reference to information given in point 3, compute FOB value of machine. What will be the FOB value? FOB value will be $7,000, which will convert into Indian rupees. 7,000 into 70 will comes to 4,90,000. To that, I will add this commission, which is 4,500. So the final figure will be 4,95,000. 4,90,000 plus 4,500, which comes to 4,94,500. Are we clear with that? They only ask the question, what is the FOB? Come on, guys. What is the price of machine, my dear friends? 7,000, which is in dollars. And the price in INR, that will be 7,000 into 70 per dollar. To that, I will also add commission and brokerage, but we will not add something called buying commission. So that comes to 4,500. My FOB value will be 4,90,000 plus 4,500, which comes to 4,94,500. So what is my answer, my dear friends? Answer is nothing but option B, which comes to 4,94,500. Are we getting clarity on this question, my dear friends? All of us, please reply, sir. Everybody? Good. Second bit. What else he asked? With reference to information given in point 3, compute assessable value of the machinery purchased by SSI Private Limited. Sir, now let me tell you. This is one indirect tax question, which is just like that given. Sir, assessable value means always CIF. Assessable value always means what, sir? CIF. What is FOB value? What is FOB value, my dear friends? 4 lakh. What is FOB value? 4,94,500. Correct? And to that FOB value, my dear friends, we have to add something called insurance and freight. What is the insurance figure given in the question? The insurance figure they gave in the question is, my dear friends, $100. So $100 will be 100 into 70. 100 into 70, which comes to 7,000. We'll also add freight, which will be actual or 20% of FOB, whichever is lower. And what is the actual freight they gave in the question? Actual given is 2,000. So actual given is 2,000 means 2,000 to 70 comes to how much, my dear friends? 1,40,000. Whereas 20% of FOB is how much, my dear friends? $4,94,500 into 20%, which is coming to 98,900. So I'll take the figure as 98,900 because actual freight or 20% FOB, whichever is lower. So my CIF will comes to these three put together, which comes to 600,400. When I say it is 600,400, what is the answer, my dear friends? Answer is very clearly option A. Next, third bit. With reference to information given in point 3, compute total customs duty payable and IGST payable. In 1 minute, I'll give the answer. Because already I've got the figure of CIF. Come on, guys. BCD at what rate? BCD at 10%. We'll not take that spares rate. We'll take the actual rate only of the product. Then SWS at the rate of 10% of BCD. Clear, my dear friends? And my total will be total of these three. To that, I will add IGST. And what is the rate of IGST they gave in the question? Let me go and check once. IGST rate they gave is, my dear friends, at the rate of 12%. This into 12%. That's it. And my total customs duty will be BCD plus SWS plus IGST. That is my total customs duty payable, which comes to 1,46,017.28. So let me look at the option 1,46,017. The answer is nothing but option B, my dear friends. Sir, this is a very, very easy question actually. Generally, valuation of customs will always come in exam in indirect taxes. The same thing they gave here and they gave case study. Next. With reference to information given in point 2, compute income from other sources. What is income from other sources, sir? Already I told you, 20 rupees per share, 60 is the market value. We got it 40, 20 per share into 10,000 share, which is nothing but 2 lakhs. The answer is very clearly option C, my dear friends. Good. Student is asking one doubt. Sir, in GST compensation says, will that be on CIA plus BCD plus SWS? One line answer. On what value you calculate GST? Simple line I'll tell you, my dear friends. On what value you will calculate GST? On the same value, I'll calculate GST compensation cess. Because GST compensation cess is always on value, not on GST. That's a beauty point. Good. Fifth question. That's not related to your taxation. Then, descriptive. 2 bits are there. Second bit is related to recognize revenue as per Ind AS. I'll not talk about it. Compute total income of MBS for estimated 24-25 and tax levied under Income Tax Act on such income, indicating reasons for treatment of each item. Ignore provisions of minimum alternative tax and assume that, what did they say? Assume that company does not opt for 115 PAA and turnover of 21-22 was 250 crores. If it is 250 crores, then the tax rate will be 25%. Because the logic is very simple. If turnover during 21-22 does not exceed 400 crores, then the tax rate will be 25%. Come on. If I go back to the question, already we discussed this, my dear friends. I'll show you the working. No problem. Descriptive part. What is the net profit as per P&L account, my dear friends? It is 75 lakhs. Net profit as per P&L account is 75 lakhs. And to that 75 lakh, we will add contribution to employee welfare trust, which is nothing but 2 lakhs. 2 lakhs. Then what else? MBA course of relative. MBA course of relative. That also I'll add back. How much is that there, my dear friends? 7,80,000. Next, expenses on traffic signal. Expenses on traffic signal. I already told you there is a case law for this, Infosys. So I'll not add anything. Next, gifts to dealers. That is also allowed because it's clearly a business promotion expenditure. Next, expense on traveling of wife of MD on invitation. This is also allowed. So I'll not add back anything. Next, what do you call? Foreign fluctuation on value of machine. So that also I'll add back 3 lakh, my dear friends. Then payment in cash. That also I'll add back 27,000 because it was 18,000 and 9,000. Next, interest, TDS done in previous year and paid in April 2024. Straight answer, it is not disallowed. So answer is 0. It is definitely not disallowed. Correct, my dear friends? Then they also covered one more interesting point called audit fees, which was disallowed in last year. Audit fees, which were disallowed in last year. And that audit fees will take current year now. So what I'll do is, I'll take total of this. Hold a second. Less audit fee disallowed in previous year 22-23. How much was that figure which is disallowed? Let me check. It is 6 lakh rupees. So 30% is 1,80,000. And of course, my dear friends, last but not the least, I'll claim depreciation on 3 lakhs, which is nothing but 3 lakhs into 15%. When was it purchased, by the way? Let me check that date. It is put to use on 10 September. So it is more than 180 days. So I'll take full depreciation. So my PGBP figure will be this figure minus this. And my income from other sources will be already computed 2 lakh rupees. And my total income will be this plus this. And this figure works out to how much, my dear friends? 87,82,000. That becomes my total income. Did you get that point, my dear friends? On this total income, if I have to calculate tax liability, straight away, I'll calculate tax at the rate of 25%. 25%. To that, I'll also add, my dear friends, HEC at the rate of 4%. On this figure, if I add 4%, I'll get total tax liability, which works out to 22,83,320 rupees. That is the total tax liability which is working out in this particular question, my dear friends. Student is asking some doubt in the chat box. What is that he is telling? Sir, Madras High Court Charan Transport. Sir, one point is very clear, sir, that this, Employees Welfare Trust, whatever contribution you made, that we have disallowed under section 40 capital A9, telling that it is non-statutory fund. But alternatively, there is Madras High Court ruling in one case law called Charan Transport, which clearly says that you can treat it as a labor welfare expenditure and you can take it as deduction. But it did not follow that case law. If you follow that case law, you can take alternative answer. No problem. That is also correct. Got it, my dear friend? That's it. So that's all, my dear friends, with respect to this case study number 8. A very, very interesting case study. And I'm pretty confident and sure that we got very good clarity on this point. In fact, an interesting question which actually makes lot of sense, my dear friends. Are we clear? So friends, what we'll do is we'll call up for the day today. And now that we are done with case law number 6, 7, and 8, the balance case laws we'll discuss in next interesting session. But I'm sure today's discussion, you actually could get very good clarity on lot of interesting provisions of income tax and GST. Do you agree to that, everybody? Done. Thank you so very much. Take care. See you all in the next lecture very, very soon. And I'll also share the Excel sheet where I wrote a lot of interesting point. Student is asking, sir, can we expect more weight on taxation? See, the point is very clear. It is not that we can always expect, but generally some good amount of questions will come from tax. But if you ask me how much %, we have done an analysis and shared that. That analysis is only a medium of understanding, but it's not actual. So we really can't predict anything for sure. But high probability that from tax, good number of questions will come. That's it. Thank you so very much, my dear friends. Shivani signing off. See you all very, very soon once again. Thank you so much. Bye-bye. Thank you. Yeah, very good evening, my dear friends. I believe that I am visible and audible. Please confirm. Okay, done. Let's start the discussion, my dear friends. I hope you're all ready. Yes? Can I go ahead and share the screen? Yes, very good. Thank you very much. Friends, please confirm the screen is visible for you. Yes, thank you very much. Come on, we are looking at an interesting case study. Please see that, my dear friend. Whirlsonic Limited is a large-size listed Indian company having two business segments, namely light and electrical consumer durables. Light and electrical consumer durables. It is one of the oldest brands in the country and has a rich legacy associated with reliability and superior engineering quality. In the last few years, company has launched some breakthrough products like India's first anti-dust fan and antibacterial LED bulbs. Company is a leading Indian brand with significant global presence. Company operates with its philosophy to carve out a niche in the global industry and to evolve into a premier lifestyle home solution provider. So they basically want to become a premier lifestyle home solution provider. That's the objective what they've got. With operations spanning in over 20 countries, company has earned the trust of millions of customers, providing cutting-edge lifestyle electrical products. Then, Whirlsonic Limited has received many prestigious awards and accolades to date for its commitment and manufacture quality lifestyle electrical solutions that benchmark against the best in the industry. The company is proud to be the recipient of New Product Innovation Award in the antibacterial LED bulbs industry in India, and has been recognized as the New Product Innovation Leader in the Indian LED bulbs industry. So this is all the story and the backdrop of this company. Now see, the company worked towards getting the right products to market faster and developing long-term product strategies and coherent roadmaps. During the financial year 22-23, company decided to manufacture LED bulbs and lights with a unique feature which will enable users of such products to operate them from any distance with the help of their mobiles. Such technology requires use of an electric chip which is to be imported from Indonesia. So they want to import from chips from Indonesia. So far, LED lights and bulbs with such unique feature have been developed by 2 more companies. And according to market survey done by the marketing team of Whirlsonic Limited, the demand for these products is increasing day by day. Further, management of the company decided to offer a discount of 20% on the list price of the product to its distributors. And the list price is 150 for LED light and 200 for LED bulb. In the invoice, the list price will be mentioned on which discount will be given to arrive at the final price. So the discount is mentioned in the invoice itself. I hope you know that under GST law, there is something called what all we can reduce from value of supply. In that, we have got a section called section 15.3, which talks about 2 points. Number 1, discount recorded in the invoice. Number 2, discount given after supply is made based on agreement existing at the time of supply. And it is linked to the invoice and proportionate credit is reversed by the recipient. Done. In the invoice, list price will be mentioned, on which discount is given. Next, during the year, Whirlsonic Limited sponsored a sports event organized by Balika City Club in Jaipur. It was established in the year 1986 for protection of rights of the girl child. Company has paid an amount of 5 lakh rupees for the sponsorship of such event. Consequently, the event was named after the brand name of Whirlsonic Limited. We know this, right? For example, IPL. We see the word Tata IPL. Why is that name coming? Because Tata has sponsored that. Now, the moment you read this line, read this paragraph about sponsorship, can somebody please tell me what is that is coming into your mind? Come on, please tell me, guys. What is that is actually coming into your mind? Good. Excellently said. Student has beautifully replied telling RCM. Wonderful. In case of sponsorship services, my dear friends, reverse charge mechanism will apply if a recipient is a body, corporate or firm. In the given case, who has given sponsorship is Whirlsonic Limited. The recipient is nothing but body, corporate. Whenever a recipient is body, corporate or firm, my dear friends, in case of sponsorship, if supplier is any person, receiver is a body, corporate or firm, then that transaction will be covered under RCM. So in this particular question, on this sponsorship service, GST liability is required to be paid under RCM. Next point. SM Mehta and Associates are the statutory auditors as well as tax auditors of the company. And CA Mehta, the managing partner of the said CA firm, had set up the practice soon after becoming a member of ICAI in the year 1990. So long back only, they have started their own practice. Today, the firm has head office in Delhi with branches in 6 different states of the country. The firm has expertise in audit, including statutory, management and internal audit, due diligence and taxation matters, including international taxation. Very good. During the course of audit, Mehta, the engagement partner, asked one of the team members to analyze the taxability or otherwise reliability of various receipts and expenditure under the provisions of income tax. While analyzing the same, Rudra was skeptical with respect to following 2 points. Come on, guys, what is the point? Let's see. First one, company paid dollars equivalent to 40 lakhs as sales commission for the year ended 31st March 2023 without deducting tax at source to one person, Mr. Merrill, who is citizen of UK and a non-resident who acted as an agent for booking orders from various customers who are outside India. Already in one case study, I told you this point. When we are making payment of commission to a person who is a non-resident, who is sitting outside India, my dear friends, the provisions of TDS will not apply. The reason being, the income is not accruing or arising or receiving in India for the non-resident. In other words, income is not accrued or received in India. When it is not accrued or received in India, then it is not an Indian income. When it is not an Indian income, it is not taxable for a non-resident. Now, when it is not taxable, there is no requirement to do TDS. Now, when there is no requirement to do TDS, there is no question of disallowance. This point I taught you already, my dear friends. Are we clear with this point? Come on, please reply. Yes, fair enough. Next. An amount on account of secret commission was paid during the year 22-23. Guys, secret commission, is it allowed or not allowed? If secret commission, what has been paid, it is on account of any offense or prohibited by any law or violation of any law, then definitely it is not allowed. Because the point is very simple. Section 37(1) clearly says that any expenditure incurred which is in violation of law, that is not allowed as deduction. Next point. Further, Mr. Rudra had certain confusion with respect to allowance or disallowance of the following expenditure under provisions of Income Tax Act incurred by the company. Interest amounted to 55,000 payable to GST department, which was paid after the due date of filing return. If it is paid after due date of filing return, my dear friends, so as per section 43B, disallowance will apply. Because 43B, there is first point which says any tax, duty, cess, fee. And let me tell you, Rajasthan High Court, in one wonderful case law called Mewar Motors, my dear friends, they have clearly held that even interest on GST is also covered in 43B. And if it is not paid before due date of filing return of income, that will be disallowed. Getting the point, everybody? This answer is because of section 43B. Next point. He asked CA method to clear the confusion on the above points. Very good. During the year under audit, company has entered into a high C sales transaction with Lavish Limited for its products. What is high C sales, my dear friends? High C sales means when goods are in transit to India, when the goods are in transit to India, the goods are sold to somebody. For example, let us say Shivateja is importing goods from USA. When the goods are in transit to India, before clearance for home consumption, I am selling that goods to Mr. Raviteja. Now, law clearly says, my dear friends, this transaction is neither regarded as supply of goods nor regarded as supply of service. Because section 7(2)(a), read with schedule 3, talks about the transactions which are neither regarded as supply of goods nor regarded as supply of services. In that, there is one point, high C sales, supply of goods before clearance for home consumption. Management is of the view that GST on such high C sale transaction is payable at the time of such sale. Why? It's not required at all. And BCD is payable at the time of filing bill of entry for import of goods. Further, they have established a vigil mechanism to enable directors and employees to report genuine concern and seek protection against victimization. Very good. While discussing about the status of audit work, one of the directors discussed about corporate governance regulation requirement that is related to your law. Next. Also, Somesh was very impressed with the quality of services and effectiveness and efficiency of the audit work done by CA Mehta. He accordingly requested CA Mehta to provide services of actuarial, investment advisory, and investment banking to Whirlsonic Limited after the same is approved by directors of the company. Fair enough. First point. With respect to payment made by Whirlsonic Limited for sponsorship, which of the following statement regarding the GST liability is correct? GST is payable by Whirlsonic being recipient of sponsorship under RCM without any second thought, my dear friends. What is the answer, my dear friends? Answer is option A. Straight answer. What is that doubt you're asking, my dear friends? Door LLP. What is Door LLP? Sir, law says in case of sponsorship services, does LLP? LLP will be considered. In case of sponsorship services, recipient is liable to pay GST under a reverse charge mechanism if recipient is body corporate or firm. So what is going to happen is, my dear friends, in the given case, since the receiver is a company, the company shall be liable to pay GST under RCM. That's it. Very, very simple question, but an important question. Next bit, MCQ number 2. What will be the value of supply of LED bulb with a unique feature to be manufactured by Whirlsonic Limited? Tell me, my dear friends, what is the answer? Come on. LED bulb, right? What is the price of the bulb they told? So the price of LED light is 150. LED bulb is 200. And they clearly told 20% discount will be given, and that will be mentioned in the invoice itself. What will be the value of supply? Straight answer, my dear friends. The answer will be 160. No second thought about it. Value of supply generally means transaction value. Further, discount recorded in the invoice shall be reduced from transaction value. What is that line I wrote, my dear friends? Discount recorded in the invoice shall be reduced from transaction value. Hence, the value of supply shall be 200 minus 20% of 200, which comes to 160, my dear friends. That's the story of this small, interesting MCQ. MCQ number 2. Next, third bit, that's about your LODR regulations related to law. Next. Fourth bit, related to your audit and law. Fifth bit, whether interest payable by the company to GST department, which is not paid before the due date, will be disallowed. 100% answer is yes, my dear friends, that will be disallowed. Getting the point, everybody? That is because of what, my dear friends? I already told Rajasthan High Court in one case law called Mewar Motors. They clearly told that interest on GST also will be covered in 43B. For expenses covered under section 43B, deduction is allowed. I repeat once again. What did I say? Deduction is allowed only if they are actually paid on or before due date of return of income. Under section 139(1). And one such point is any tax, duty, cess, fee payable under any law. Clear, my dear friends? Hence, GST will be covered under section 43B. And moreover, Rajasthan High Court, in the case of Mewar Motors, has held that interest on GST would be covered under section 43B. When I say it is covered under 43B, what does that mean? Payment must be made on or before due date of return of income. If it is paid on or before due date of return of income, then disallowance will not apply. But if it is paid after due date of return of income, then that expenditure will be disallowed. Getting my point, everybody? Fair enough. Next, come on. Explain how GST will be levied and what would be nature of supply in case of import of electronic chip. Import of electronic chip means that is definitely an interstate supply. And for import of goods, we charge BCD. We'll also charge IGST. Also examine whether the view of management is correct with regard to high C sales entered by the company. That view is not correct, my dear friends. The reason being very clearly that in case of high C sales, it is neither regarded as supply of goods nor regarded as supply of service. But of course, some part is correct that at the time of import of goods, they'll file bill of entry and they have to pay customs duty. That extent, the answer is correct. Everybody? Good. Fair enough. Come on. Let me write the answer. Descriptive question, guys. Come on. In that, first bit is very clear. First bit is talking about what? First bit is talking about goods imported to India. In case of goods imported into India, my dear friends, it is regarded as interstate supply. Accordingly, IGST would be levied along with BCT. What is BCT, my dear friends? BCT stands for Basic Customs Duty. Getting my point, everybody? Moreover, further, in case of specific goods, GST compensation cess also may be levied. I hope you know that in case of aerated waters, tobacco, motor cars and all, there is a concept of GST compensation cess that is levied by the government in order to ensure that they'll use that money to compensate those states who have lost revenue on account of introduction of GST. Getting the point, everyone? And I hope you already know this point, but still let me tell you that assessable value will be CIF. And first we always charge BCD. We charge something called social welfare surcharge at the rate of 10% of BCD. Then we take total. And on total, we will charge IGST. Very, very interesting point, my dear friends. Now, second bit. What did they ask in second bit, my dear friends? That is high C sales. In case of high C sales, GST would not apply since the transaction is neither regarded as supply of goods nor regarded as supply of services as per section 7(2)(a), read with schedule 3, my dear friends. I hope you are getting clarity on this point. So basically, goods are supplied before clearance for home consumption. Sir, please speak out, my dear friends. Further, the price paid by last buyer shall be considered for levying customs duty. At the time of filing, bill of entry. I hope you know that we'll pay customs duty on the time of filing bill of entry. So basically what will happen is that at the time of filing bill of entry, my dear friends, he has to pay BCD also, he has to pay IGST also. Who will pay that? The last buyer who is going to the port or airport to collect that goods, he is going to pay that duty. And what will be the assessable value? Assessable value will be the price paid by the last buyer who is filing the bill of entry for home consumption. Getting clarity on this point, everyone? Please reply, come on. What is saying? Last buyer price, assessable value, whichever is higher, right? Exactly. We'll take higher price only because logically you can't try to play with the government telling that assessable value, CIF value is 1 lakh you are selling at 60,000, then 40,000, then 20,000. That they will not allow. If you try to play that games, they will not allow. We'll take the last buyer price. That means basically the last price paid by the last buyer, or your CII value, whichever is higher, obviously. Done. Going back, my dear friends. 7th question is about LODR, and 8th question. Examine the availability of the two expenditures incurred by Whirlsonic Limited under provisions of income tax related to payment of sales commission and secret commission. I already answered this, but still let me write the 2 points. Question number 8. Clear, friends? Are we ready? Yeah. In case of commission paid to non-resident who is working outside India, provisions of TDS will not attract since income is accrued and received outside India. So logic is very simple, my dear friends. Since income is accrued and received outside India, the provisions of what, my dear friends? TDS will not apply. TDS provisions are not applicable since commission income of non-resident is not taxable in India. Since it is not taxable in India, my dear friends, the TDS provisions will not apply. Finally, one last and what I'll write is that since TDS provisions are not applicable, the provisions of disallowance will not apply. So when there is no question of TDS, my dear friends, where is the question of disallowance? Everyone, please speak out, my dear friends. Next point. Secret commission is a kind of commission paid by business owners. Is a kind of commission paid by what, my dear friends? Business owners. For obtaining orders or contracts, etc. For obtaining contracts, orders, etc., they pay this something called secret commission. They pay this secret commission, my dear friends. Are we getting clarity on this point, everybody? Now, as per section 37(1), any expenditure incurred which is in any expenditure, what, my dear friends? Incurred which is an offense. Which is an, what, my dear friends? Offense. And prohibited by any law. Then it is not allowed as deduction. Then it is what, my dear friends? Not allowed as deduction. Getting my point, everybody? Hence, if secret commission is in nature of offense prohibited by law, then such secret commission will not be allowed as deduction. That's it. That's the story of this. Very, 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 very interesting point. I strongly believe that we got very good clarity on this question, my dear friends. Very interesting case study. Makes a lot of sense, actually. Pretty simple, pretty comfortable, but of course important. Good, fair enough. Thank you very much, Kapoor.
Good evening, everyone. So today we'll continue our discussion on the case studies. So this week we have selected 4 case studies for the next 3 or 4 days. So what we'll be doing is we will be taking specific subjects So for example, today I'll be talking about financial reporting, strategic cost management, and few aspects of audit. Then tomorrow we'll have the in-depth discussion on taxation, and then we'll have a discussion on law for these 4 case studies. The reason is, one feedback what we got was there would be some disconnect, because let's say we understand all law related concepts together, then it becomes easy for us to retain and remember and comprehend the case studies. Of course, again, after 4 or 5 case studies, we'll have a single case study where all the faculties will be present. And again, we'll be discussing the case study together. Okay. And just a second, let me just share the screen. So is my screen visible? So this case study, what we have chosen today for this week, we have chosen case study 4 and case study 13. 4 doesn't have anything related to financial reporting. So we'll be, even if we take it up, we'll be taking it up subsequently. First, we'll handle the aspects related to financial reporting, and then we'll move to the other subjects. Okay. So this is case study 30. Now here in this particular case study, if you see, unlike what we had, in the previous case study where there was a detailed outlook about the economy, about the airline industry and all of those things, here it is more straightforward. So in the examination also, we can expect a mix and match. Okay. It is not that all the case studies will be having, very detailed economic or industries background. So that would not be the case always, right? So here, we are looking at this case study number 13. Now, again, like we did in the previous class, let us first quickly scan through the questions, okay, before we come back. So first one, they have asked tax liability. This is to do with DT. So you need to calculate the tax liability. Then second one is related to TDS. Now, we will be providing you section numbers and TDS rates and all of that, which you can carry to the examination to calculate how much will be the TDS related liability. So that will be helpful for you. Residential status, again to do with the direct taxation. Okay. Then business combination, and they have asked something specific about pooling of interest method. Now, friends, if they have asked us pooling of interest method and they have said pooling of interest method considered to involve the following, which means again it is not directly related to the case given in question. Okay. Then with information given in para 6, x and y equals to what number? So this is specific to paragraph 6. Then you have descriptive question on, for, tax liability of income tax. Then assume there are no transaction, past journal entries in the books of technology, balance sheet and balance sheet. So this is something which is directly related to financial reporting, right? So we got a gist of, it took us hardly 2 minutes to figure out what is the gist. Now what we'll be doing is specific aspects. One is the overview of the case, and the specific aspects of financial reporting in this particular case study, we will be picking up and we will be discussing, right? Now, again, one thing what I suggest each one of you is to take at least the case study that we are discussing or any other case study, try to get into a habit of reading faster. That will save you a lot of time. Okay. Now here, let's see. As from last many years, it has been observed that people are returning back to their country, India. India, as evidenced by economists all over the world, is not only the world's largest democracy, but a country with untapped and unlimited economic potential. Again, these are simply generic statements which does not have a huge impact on the case that we are discussing. Okay, so we should just ignore that part. There is a rising trend of companies in sectors such as pharmaceuticals, manufacturing, automobiles, healthcare, shifting more and more research and development work to India. Now, they have mentioned about research and development. There is nothing related to that again in the question. This trend is leading in many Indians to return from overseas to lead prime projects. So, what is happening? Many overseas Indians, NRIs what we call, are coming back. This situation is called reverse brain drain. Again, nothing to do with the case study. Brain drain is a term when Indians move out, when they come back, it is a reverse brain drain.
It is a form of brain drain where human capital moves in reverse from a more developed country to a less developed country that is developing rapidly. People returning back to their home country may accumulate savings, earn skills, knowledge which can be used in their home country. This became possible in India only due to the strategies and long-term planning implemented by the government. Now, first paragraph, second paragraph is to be ignored. Okay, so how did we get to know ignored? Because it is not related to any of the questions. So just quickly skim through. One important trick what I used and what I can suggest you is read the first sentence and read the last sentence of a paragraph. That will give you a sense of what is mentioned in the paragraph. For example, it has been observed that people are returning back to their own country. This trend is leading many Indians to return from overseas. So this talks about for Indians coming back to the country first. Second, this is called reverse brain drain, and this is possible because of the government strategies. So this is talking about brain drain. Now let us try the same thing in the third paragraph. NRI knowledge as well as experience can be applied in Indian context in numerous ways across all sectors. So this only has two sentences. So basically it is saying that NRI's knowledge we can apply across different sectors. That is also not relevant for us. Mr. Pradeep had left India in 2007. He was living in the UK. And he has stayed so and so. Mr. Pradeep wants to spend rest of his life in his home country. Now, what does this mean? Mr. Pradeep, he had left in 2007. Now he wants to spend rest of life. So this is the paragraph which talks about one Mr. Pradeep who is returning back to the country. So this may be relevant for the tax purpose. He returned with one of his close friend, a foreign national, and a cricketer came to India as a member of England cricket team, so on and so forth. So this basically, if you remember, there was a question on residence status and all of that. This will be relevant at that point. Okay. After reaching Pradeep visited one of his close friend who is a chartered accountant and discussed the details of income. So this again is purely related to income tax. And there is a case question, first case if I am not wrong. With reference to information given in para 4, calculate tax liability of Mr. John. So we are talking about 5. Okay. So here, para 4, we need to calculate the tax liability of Mr. John, which will be discussed in your taxation thing. Then, Mr. Pradeep came back to his parental house where his parents were staying with younger brother, so and so, with the grace of God and blessings of parents. They are well settled in India, so and so forth. And then here, if the company wants to appoint more than specified limit, it can do after passing a special resolution. This is talking about board of directors. So like this, by reading the first line and the last line, you can actually figure out what is given in the contextual paragraph, right? So this is to do with your law related provision, which will be discussed when we come to law. Then technologies has two divisions, laptops and mobiles. Division laptops has been making constant profits, while division mobiles has been invariably suffering losses. The company called a meeting for the discussion of the financials of the company, and the draft financial is given below. Similar question, if you remember, we have done in financial reporting when we talk about demerger or reconstruction. Similar question is there. There are multiple divisions. One of the division is demerged. Same thing as it is has been put here as your, what do you call, case study. So in fact, this has nothing to do directly with the case study. This is more like an independent question. They are fitting it as a part of case study. So I'm expecting at least 2 or 3 questions of these lines where you need to be careful about the provisions. You need to be careful about the provisions. How do we do the mergers, accounting, demerger accounting? And then if you know that, you can score good marks in this. So they are given PPE, depreciation, net PPE of laptops and mobiles division, current assets, current liabilities, total finance by loan, capital, surplus. The management is of the opinion to sell division mobiles along with its assets and liabilities for 50 crores to Mobiles Limited, a new company who will allow 2 crore equity shares of 10 each at a premium of 15 per share. to the members of Technologies Limited in full settlement of the consideration in proportion of the shareholding. One of the members of the Technologies Limited was holding 52% shareholding of the company. Now, here we have two MCQs. One MCQ deals with pooling of interest method, and another descriptive question, not MCQ, talks about passing the journal entries and related aspects. But before I move into that, I want to quickly discuss the meaning or the context what they said. One particular director or one particular shareholder holds 52% shareholding of the company. Now, what does that mean? Let us have a look at it. Okay. So we have Technologies Limited. Technologies Limited has laptop division and mobile division. You have laptop, you have mobile, these two divisions. They want to cut this division apart and transfer it to Mobiles Limited. So this will no longer be there. What will Mobiles Limited do? So you have shareholders. You have shareholders of Tech Limited. Mobiles will issue shares to shareholder of the Technology Limited. Now they have said that in this shareholding, there is one shareholder who holds 52% of Technology Limited. Who holds 52% of Technology Limited. Now, coming back once again, Mobiles Limited is a new company. Screen not visible. Screen nahi aa rahi hai. Is anyone else facing? If you are on mobile, you can just swipe. अगर आप mobile पे तो आप left right swipe करेंगे तो आपको screen दिखेगा. If you are on mobile, you can swipe left and right. Screen is not visible. Can someone please confirm whether screen is visible or not? Okay, it's visible. So Shilpi, what you can do is, if you are on a mobile, try to move left or right, swipe left or right. You will be able to see the screen. Okay. Now, Mobiles Limited is a new company. Means this Mobiles Limited is a new company. So they also will need to issue 52% to that shareholder. Let us say Mr. X, which means Mr. X was controlling Tech. And now Mr. X will also control Mobiles Limited. I'm repeating once again. Mr. X was controlling 52% of Tech. Mobiles Limited will also issue 52% shares to Mr. X. So now Mr. X will also control 52% of Mobiles Limited. These kind of transactions, we call them as transactions under common control. Transactions under common control. The meaning of that is earlier also Mr. X controlled Tech. Now also Mr. X will control mobiles. So earlier also both the divisions were controlled by Mr. X. Now also both the divisions will be controlled by Mr. X. So we say that this is a transaction under common control. And when there is a business transaction, business combination related transaction under common control, then we have a separate accounting treatment. Right? So that is what you have to understand. If it is a common control business combination, then there is a separate accounting treatment. So common control business combination means a business combination involving entities or businesses in which all the combining entities or businesses are ultimately controlled by the same party. Same way, if a business is being split and if they are controlled by the same party before and after. So what do I mean by that? Before the demerger, laptop and mobile was controlled by Mr. X. After the demerger also, laptop and mobile is being controlled by Mr. X, and hence it is called a common control transaction. Whenever we talk about common control transaction, we apply pooling of interest method. Pooling of interest method is different from our normal accounting. Under pooling of interest method, we recognize or we account for assets, liabilities, and all of those things at their book values only. We consider the book values or carrying amount. There is no adjustment made for fair value, right? With this understanding, let us come back to the question. Business combination involving entities or businesses under common control shall be accounted for using the pooling of interest method. The pooling of interest method is considered to involve the following. Now, what does pooling of interest method involve? That is what we have to discuss, right? First, the asset and liabilities of combining entities are adjusted to bring them to their fair values. Just now we discussed that when there is a common control transaction, we follow pooling of interest method. Fair value is not considered. When fair value is not considered, first option is not relevant to us. Now here if you see the options are 1, 3, 4, 5, 6, 2, 3, 4, 6, 2, 3, 4, 7, and 1. So 1 is not there. This is also not there. Now we are left with 2, 3, 4, 6 and 2, 3, 4, 7. So how to save time in the examination? This also has 2, 3, 4. This also has 2, 3, 4. So 2, 3, 4 are correct. We have to take care between 6 and 7. So directly we can jump. You can read this subsequently. Directly we can go to 6 and 7. Okay. The difference, if any, between the amount recorded as share capital issued plus any additional consideration in the form of cash or other assets and the amount of share capital of the transferor shall be transferred to capital reserve. That is the first sentence. Here, they shall be transferred to goodwill or general reserve. Now, let me just share with you the screen. Difference between the amount recorded as share capital issued plus any additional consideration in the form of cash or other assets and the amount of share capital of the transferor shall be transferred to capital reserve. So what we will do? We'll transfer it to capital reserve. When there is a common control transaction, goodwill is not recognized. Okay, so that is one more thing you have to keep in mind, because everything is considered to be taken at their carrying amounts only. And one important reason why we follow pooling of interest method is we are not recognizing any fresh goodwill. Okay, so that is what we have to keep in mind. Any doubt here? Now, when we solve the problem, we will see how the calculation is done and how it is recognized in the capital reserve. So this doesn't work well. So option is 6. That is the correct one, which becomes option B. So now here you see, by just eliminating the first option and the last option, and by ensuring that this 2, 3, 4 is same as this 2, 3, 4, our task became a lot more easier. Sorry, I missed the screen. I'm just showing the screen again. By eliminating first option and the last option, and by ensuring that this 2, 3, 4 is common, we just had to look at 2 points, 6 and 7. And in that sense, you would have saved some time in evaluating the numbers. Okay. Now that is done. Then in descriptive thing, we need to pass journal entries in the books of Technology Limited, prepare the balance sheet of Technology Limited, prepare the balance sheet of Mobiles Limited. So 3 things. One is journal entries in the books of Technology Limited. So let us come back. We are selling Mobiles division. If you are selling Mobiles division, we have to de-recognize PPE, depreciation related to PPE, current assets, current liabilities, and we also have a loan fund. All of this has to be de-recognized. De-recognized means if it is a debit balance, now we will. If it is a debit balance, now we will credit. If it is a credit balance, we will debit. Okay. So we have to de-recognize PPE 1000. It is a debit balance. So we can directly write to property, plant, and equipment 1000. Then provision for depreciation negative number. This is a credit balance. Now we will debit it. So Provision for depreciation, debit 800. Okay. Then that is done. Then current assets. Voice breaking. Just a second. Just a moment. Anybody else facing voice breaking issue? Okay. Just give me a moment. Is it better now? Yes, no, yes, yes. Okay, so I'll go by majority because I think all of them have said it is better. Screen not displaying. Screen is not displaying. I'm writing something. So if I'm saying, Shilpi, if you are on mobile, please swipe left or right. You will see the screen. Are you on mobile? Shilpi, are you on mobile? Correct. So try to swipe left or right. You will see my screen or up and down. Okay. Yeah. So we have de-recognized those things. Then we have current assets of 1000, current liabilities of 800. Current asset has a debit balance. So credit them to current asset 1000. Then current liabilities to 800. Current liabilities debit 800. Then loan 600. Loan debit 600. And there is nothing else left. Okay. So 800 plus 800, 1600 plus 600, 2200, 1000, 2000. So we are left with 200 of balance. Now, what is this balance? This is our gain, right? So we can transfer this to P&L, considering it to be gain of 200. Now, here, one thing all of you have to keep in mind is the company is not receiving anything by demerging the mobile division. The company has just transferred the assets and liabilities to third parties or a different company. The company has given considerations to the shareholder, which means the company does not receive any business consideration, any purchase consideration. So we will just de-recognize the liabilities and the assets, and in the course of de-recognition, whatever is the balance figure, we will recognize it as a gain or loss in the books. Okay, this is the first part of journal entry. Okay, this is in the books of Technologies Limited. Now, after passing this entry, we need to prepare the balance sheet of Technologies Limited. Now, please keep in mind, I'll just discuss this part. Balance sheet presentation will be straightforward. Technology Limited, now mobile is no longer there. So we'll just exclude the mobile limited. What are we left with? We are left with laptops. Laptops has a PPE of 50. So you'll consider that. Then it has current assets of 400, current liabilities of 50. That also you'll consider that. Then under loan funds, we don't have anything. So it becomes 0. Capital 50 remains as it is. Then we initially had 150 of equity or 150, sorry, not equity, 150 of other equity or surplus. Okay. 350 minus 200, 150 was there. Now, what happens is, to that 150, we'll add this 200 of gain. So now our surplus becomes
150 plus 200, 350. So nothing changes. Just that we are retained or we are left with only the technology division. Technology division, and the shares that the company has issued, the Mobiles Limited, that will not be accounted in the books of Technology Limited because Technology Limited has not received the shares. Shares are received by shareholders of Technology Limited. So if you see it here, shareholders will receive the shares. The company will not receive any. So if I just show you the presentation of the balance sheet. This journal entry we already passed. Balance sheet, property, plant and equipment 50 as discussed. Current assets 400, equity 50, other equity surplus 350. That is basically 150 plus 200. That makes it 350. Now the next question is balance sheet of Mobiles Limited. Now when it comes to balance sheet of Mobiles Limited, when it comes to balance sheet of Mobiles Limited, what we need to keep in mind is we will recognize assets of 200 of mobiles. Then we will recognize the current assets at carrying amount of book value only 1000. Then loan funds of 600. Against that, they have issued 50 of shares. So what has happened here is, if we calculate, PPE is 200. So let me just erase here and do the working. For Mobiles Limited, PPE what they have taken is 200. Current assets that they have taken is 1000. This makes it 1200. Current liabilities that they have taken is 800. So minus 800. And loan they have taken is 600 minus 600 of loan. So 1200 minus 800 minus 600 minus 200 is the net asset. Oh my God. So this has become a reverse scenario. Instead of a positive net asset, the new company has taken more liabilities than the assets. The new company has taken more liabilities than the assets. So because they have taken more liabilities than the assets, the net assets taken over is 200 negative. They have taken more liability. Okay. And they have issued consideration of 50. Now normally see what happens is, if net asset taken over is 100 and consideration is, let us say, 50. Net asset is 100. I'm not putting 50, I'll put it, let us say, 75. I'm repeating my question. If net asset taken over is 100 and if consideration is 75, how much is the capital reserve? If net asset taken over is 100, consideration paid is 75, how much is the capital reserve? Capital reserve is 25. How did we get that? 100 minus 75, we got 25. Now here, this number itself is minus 200. So minus 200 minus 50, if I do, I get minus 250 of reserve or capital reserve. Sir, why can't we, can we call it goodwill in that sense? Please remember, common control transaction, no goodwill. So negative reserve of minus 250. So when we prepare the balance sheet, $200 of property, plant and equipment, 1000 of current assets, equity 20, this is at face value, borrowing 600, current liabilities 800, and here if you see, Securities premium is 30. Capital reserve is minus 250. Why minus 250? Net assets minus consideration. Net assets was minus 200. Minus 50 when we did, we got minus 250. That is what is captured here. Is that part clear? Okay. Now, what this also means is, if these type of questions are given in the examination, we must be thorough with the presentation and calculation part. Of course, in financial reporting, you would have done that. That will help you. And the theoretical part, this theoretical part, if at all you get confused for MCQ, the notes will help you. So here in the MCQ, what we took, here if at all you get confused, the notes will help you. Okay. So that was the first case study for our discussion. That is as per the new syllabus. And generally what we have seen is, first time when these kind of exams are conducted, the new case studies that the institute releases, they have a high chance of being tested in the examination. They ask generally questions as it is. So a proper study is very, very important. Other aspects related to taxation and law will be covered in subsequent sessions. Now we will take up the next case study. This is from November 23 paper. Yeah, so this is from the November 23 paper. And one thing which I wanted to bring to your notice as well is, case study based, the solutions have been worked out on the basis of certain assumptions, view derived from facts given or language used in the question. It may be possible to work out the solution in a different manner based on the assumptions made or views taken. Especially this is relevant for descriptive, and that is where we need to be very careful about. If you are making some assumption, please make it, properly in the answer book. Though they say, they are not responsible for the correctness or otherwise, we'll go with the suggested answers as they have been published by the institute.
Okay. So now we're going to move on to one more case study, which is also the last case study for today. Okay. So what we're doing is, we are taking up the case study from our student digest, which was published in November 23. So it has got many case studies. Today specifically, we are going to be discussing case study 13. Okay. So this is from the student digest of November 23. Okay, so again, it's a very long case study. Para 1, para 2, para 3, 4, 5, 6, 7. So do we have to read all of these paragraphs? No, always jump to the questions first, because who knows, you don't have to read all of this. All right. So we're going to jump on to the relevant question relating to company law. This is such an easy question that, you will answer it even without looking at the case study. And try to do it, try to solve this question yourself. Okay. So let's see. With reference to the information given in para 6, x and y equals to what? Okay, so I have already marked the answer. I'm so sorry. But never mind. We are going to still try to solve it. Okay. So para 6, see, this question simply says para 6. We have to check. So we don't have to read the whole question. We are just going to go to para 6. What does para 6 say? So para 6, let's read it. Mr. Pradeep came back to his parental house in Punjab. Who is Mr. Pradeep? I don't know. But as of now, we are still going to read it because we need to know the facts of the case just so we can solve. All right, we need to find out the figures x and y. What is this paragraph saying? Okay. Mr. Pradeep came back to his parental house in Punjab, where his parents were staying with Pradeep's younger brother, Mr. Gulshan. Okay. With the grace of God and blessings of the parents, Mr. Gulshan is also well settled in India. Very good. Presently, Mr. Gulshan is managing a company, Technologies Limited, being the director of the company. So this is the main company that we are talking about. Mr. Gulshan is a director in this company, Technologies Limited. Presently, Technologies Limited has got 9 directors. Okay, company's board of directors desire to increase the number of directors from 9 to 16. So in a company, can we have 16 directors? Think about it. The company already has 9 directors. But the company secretary of the company informed the company's board of directors that as per the Companies Act, every public company shall have X number of minimum directors and Y number of maximum directors. But if the company wants to appoint more than Y number of directors, it can do so by passing special resolution. So that means X is the minimum number of directors in a public company and Y is the maximum number of directors in a public company. Now, can you tell me what is X and what is Y? Come on, this is so easy, so easy. This is like the most basic thing we study. Okay, so you don't even have to know the provisions, like go into the sections for this. What are the answers? Tell me. 3 and 15. So minimum directors 3, 15 is the maximum directors. Does everyone agree with this? Okay, so someone saying 2 and 15. Is 2 the minimum number of directors? Is it? Okay, so here specifically we are talking about a public company. All right. So what is the section? We're still going to see the section just for reference. So here we are talking about section number 149, which talks about the minimum and maximum number of directors. So for a public company, the minimum directors is 3. For a private company, minimum directors is 2. For a one-person company, even 1 director is sufficient. Maximum number of directors in all cases is 15. But you can have more than 15 directors also if special resolution is passed. Okay, so accordingly, what is going to be our correct answer? The correct answer is going to be C, which is 3 and 15. X is 3, 15 is your Y. Okay, so if you're thorough with the provisions, this particular question does not even require you to think much. Some of the questions are easy like that. Okay, so that was the case study, and this was the only question from company law in this particular case study. So I hope all of you have understood. Do you have any questions from the sessions that we discussed today? We'll be taking up any questions that you have. Monica is saying no. Deepika is also saying no. Okay. Okay, so I think we don't have any questions. So Ashleisha ma'am, if you want to say something to the students, and then we can like close the session.
Nothing much. We would just say that whenever you're solving a case study, learn how to extract the relevant part of the case study, which is relevant for the answers, just like we did today for law. We did not go through the entire case study, whether it was Yogita ma'am or me. We first read the question, and just because we skimmed through the case study earlier, we knew that this portion is relevant for us to answer the question. So that is something which you can take away and also use this skill in your examination when you are writing down or solving the case studies. Read the question and only take up the relevant part to answer your case study. And that's what you should be doing. And as in when you practice more case studies, identifying which part is relevant will become easier. Right, Yogita ma'am?
Correct, correct. And sometimes, you know, some questions are like very easy. They're actually not even too hard, you know. So be confident, and the more you practice, the better you're going to get at it. It's not very difficult. These questions are not very difficult. So, okay. So I think that's it from our side, right?
Yes.
Okay, chalo. So we'll close this session. We'll see you very, very soon, right?
Thank you.
Bye.
Shall we go ahead and start? Are you guys ready? Please reply once. Yes, looks like everybody's ready. Wonderful, wonderful, wonderful. Thank you so very much. So friends, I'm sure a couple of discussions has happened with respect to 2-3 interesting case laws, with respect to provisions related to law and also provisions related to strategic management and other interesting arenas. Now, it's time to talk about the tax related content of that 2-3 interesting case studies what we have been discussing, so that we get a very good clarity of thought on the taxation related content also. So let me start, my dear friends, without any delay. Let me go ahead and proceed for the further discussion. I'll share the screen. Can you please confirm that the screen is visible for everyone? If you tell yes, then I can happily start. Yes, my dear students? Done. Thank you so very much. So first, let me talk about some interesting case study called Case Study 13. And as we've been hearing earlier from other multiple faculties also, it is very important that student has to highlight what is that relevant part of the case study which is relevant for your question. That's very important, because a lot of times it does so happen that in the case study, they talk about multiple different elements which are not relevant for your questions at all. For example, they talk a lot about industry overview, what has happened in India, what happened in the past, what is happening in the foreign country. All that is more of an enlightenment related part, which is not relevant for your particular question. So that's the reason why students should have a clear clarity of thought in terms of what is relevant for you, what is not relevant for you, which is extremely important. So let's see this question. So in this case study, if you observe, there is para 1 where they gave past so many years. It has been observed that people are returning back to their own country. India, as evidenced by economists all over the world, is not only the world's largest democracy, but a country with untapped and unlimited economic potential. These are all big statements what they give. As there is a high rising trend in companies in sectors such as pharmaceutical, manufacture, automobiles, healthcare, shifting more and more research and development work to India. So in simple terms, what they're trying to say is that India is blooming and a lot of people are returning back to India to run their business in India or perform their activities in India, especially related to pharmaceutical, manufacturing, automobile, and healthcare. Part 2. This situation is called reverse brain drains. What is that situation called as? Reverse brain drains. That means basically people thought they'll have something interesting in foreign. They went to foreign, but they realized that in India there is a lot of potential in India, so they're coming back to India. And this phenomena is known as reverse brain drains. It's a form of brain drain where human capital moves in reverse from a more developed country to a less developed country that is developing rapidly. People returning back to their home country may accumulate savings, earn skills, as well as knowledge which can be used in their home country. This became possible in India only due to strategies and long-term planning implemented by government to reverse the migration. So if you observe carefully so far, there is nothing related to tax. Yeah. NRS knowledge as well as experience can be applied in the Indian context in numerous ways across all the sector, whether it be managing MNCs, new business startup, domestic industries, etc. For attracting NRIs, developing countries like India always endeavor to create an environment which will provide ample rewarding opportunities for those who have earned knowledge and skills from overseas. So basically, they are trying to say that in India, there is a huge potential for those people who have gained knowledge and skill set in abroad, so that they can utilize that skill set in a developing country like India, where they'll have huge potential growth. So this is all a background or the backdrop of the situation what we are trying to understand. Now comes a real game related to tax. Similarly, Mr. Pradeep had left India in 2007. In 2007, he left India. He was living in UK since then and finally moved back to India on 12th June 2023, where he has spent substantial part of his life. Mr. Pradeep was a non-resident in 9 years preceding the previous year 23-24, but he has visited India on various occasions and stayed in India for a total period of 630 days during last 7 years preceding 23-24. And Pradeep wants to spend the rest of his life in the home country. And the moment this much level of content comes into your brain. Now let me share an interesting thing here. The moment this much level of content comes to your brain should immediately recall something interesting related to the concept of residential status. I'm sure you remember the concept of residential status, where section 6.1 has given some basic condition, and if any of the basic condition is satisfied, he is regarded as a resident. And if both the conditions are not satisfied, he is regarded as non-resident. Good. I'm happy that some students are replying. Section 6, very good. And the first condition says he must be in India for a period of 182 days or more during the previous year. Or second situation, he must be in India. He must be in India for a period of 60 days or more during the previous year and 365 days or more during 4 years preceding the previous year. So friends, I'll repeat once again. The first condition says he must be in India for a period of 182 days or more during the previous year, or he must be in India for a period of 60 days or more during the previous year and 365 days or more during the 4 years preceding the previous year. And here some special cases are there known as Indian citizen leaving India for the purpose of employment outside India. Second case, Indian citizen leaving India as a member of crew of an Indian ship which is foreign bound. The third case is Indian citizen or a person of Indian origin who comes to India for a visit during previous year. And in our question, if you observe very clearly, Mr. Pardeep, he is not somebody who left India during previous year for employment. He is not somebody who left India during previous year as a member of crew of Indian ship. And he is not somebody who has come to India for the purpose of visit during previous year. So he is not covered in that special case. So if he satisfies any of this condition, we'll treat him as a resident. Correct? Yeah. And let's say for a second, my dear friends, if a person is a resident is regarded as ordinarily resident if following additional conditions are satisfied. And let me tell you, my dear friends, the additional conditions for your kind information, they are given by section 6.6. which says number 1, he must be resident in India in at least 2 out of 10 previous years preceding the previous year. That's the first additional condition. And here the word, some interesting line I'll use, that is and. What is that word, my dear friends? And means what? Both the conditions have to be satisfied. There is no doubt about it. Second condition is that he must be in India for 730 days or more during last 7 years. In other words, during last 7 previous years preceding the previous year. If these both conditions are satisfied, then only we call him as ROR. Yeah. Now coming back to the case study. I'm sure case study is visible for you. Yeah. Now if you observe carefully, when did he come to India? He has come to India on 12th June 2023. Now when he has come to India for 12th June 2023, my dear friends, he is definitely in India during previous year for 182 days or more. So he's 100% a resident. But the problem here is, in last 10 years, he is there in India only for 630 days. That means he can't satisfy that 730 days or more during last 7 years condition. That means additional conditions cannot be satisfied. But Mr. Pardeep can satisfy basic condition. So hence, my dear friends, the residential status of Pardeep will be resident, but not ordinarily resident. A very interesting situation. Good. I'm so happy that a lot of students are participating and giving answer. Fantastic. I appreciate that. Very good. Next. He returned with one of his close friends, Mr. John. And Mr. John is a foreign national and a cricketer. What is he, my dear friends? He is a cricketer. He came to India as a member of England cricket team. Fantastic. In the year ended 31st March 2024, for 50 days, if he is coming to India for 50 days, he cannot satisfy any of the basic condition and he will become non-resident. Because first basic condition says 182 days or more. Second basic condition says 60 days or more. And is coming only for 50 days. How can he become a resident? Next slide. John received 5 lakh for participation in matches in India. He also received 1 lakh for advertisement of a product on TV. And he has also received, he contributed articles in newspaper for which he received 10,000. Fantastic. Let me make you recall one interesting provision which you would have heard something, my dear friends. That is one brilliant section known as 115 BBA, which is applicable for non-resident sports person, sports association, or entertainer, where they told in the law, if he is earning income by way of participation in game in India, or is earning income by way of acting in an advertisement in India, or is earning income by way of contributing articles in India, then in that case, my dear friends, the straightaway income tax rate is 20%, which is given by section 115 BBA. So that point should strike to your mind, which is important. See, a lot of students keep thinking that it's an open book, we'll open the book and just look at the answer. But the whole point is you should be able to identify where to check, right? That is the most important. For that, skill set is required. Got the point? So tax will be 20%. And of course, I'll add something called health and education, just 4%. Don't worry. That is always there. Next. When he stayed in India, he also has won a prize of 10,000 rupees from horse racing in Mumbai. When it is horse racing, my dear friends, it is very clearly a casual income, which is taxable as per section 115 BB. Next. He has no other income in India during the previous year. Very good. Good. One student is telling, we'll apply TDS provision under 194B. First of all, let me tell you, in case of casual income like betting, gambling, lottery, it is 194B. If it is horse race, it is 194BB. And in horse race also, my dear friends, let me tell you that TDS provision will come only if the winning is more than 10,000 rupees. Here in the question, if you observe, they gave only 10,000, not more than 10,000. So there is no question of TDS under 194BB. I hope you got your answer, my dear friend. See, that's how they try to play with your mindset. Got it? Yes. See, some student is telling, oh my God. Yes, oh my God, that's how it is. Our brain keeps telling TDS will come, but TDS will apply only if it is exceeds 10,000. And the question, it is exact 10,000. That is the reason why it's not just about looking at the book and writing the answer. It's about understanding it to the right sense. That is most important. You got it? Excellent. Thank you. Good participation. Next. After reaching India, Pardeep visited one of his close friend, Anuj, who is a chartered accountant by profession, and discussed all the details of income. And by the way, what is the resident status of Pardeep? A resident status of Pardeep is RNOR, which is nothing but resident, but not ordinarily resident. Now here, let me tell you, my dear friends, that is, Pardeep is RNOR. And let me tell you, my dear friends, as per section 5, following incomes are taxable. What is the following income taxable? Number 1, Indian income, which is nothing but which is accrued or received in India. Accrued or received or deemed to be received or deemed to occur in India. Second point, foreign income in 2 cases. That is, business controlled from India, or second case, profession set up in India. Set up in India means having an office in India. Only in those 2 cases, it will be taxable. Yeah, good. Next point. Let me go back to the question, my dear friends. Come on, guys. Come on, come on. Don't relax. Please look at the question. When I'm discussing, please look at the question. Come on, what's the first point they gave? The first point they gave is rental income from flats situated in London, which was deposited in a bank there. That means it is accrued in London, received in London, which is nothing but foreign income. And if it is foreign income, it's not taxable for Pardeep because Pardeep is RNOR. He is not ROR. Next point. The flat was going on rent by him after his return to India since July 23. Okay. Dividend on the shares of 3 German companies which are being collected in a bank account in London. Oh my God. It is also a foreign income because it is accrued and received outside India. Once it is foreign income, we will not tax RNOR except in 2 cases. Business income controlled from India, professional income which is set up in India. He proposes to keep the dividend on shares in London with permission of RBI. Very good. He has got 2 sons, one of whom is 12 years. That means minor income. Another son is major. Both his sons are staying in London and are not returning to India with him. And each of his sons is having income of 75,000 in UK, which is not received in India. Oh. If it's not received in India, it's not Indian income. It is foreign income. That will not be taxable. And 20,000 in India. That 20,000 in India, that 20,000 will become taxable. And moreover, as per section 64(1)(a), my dear friends, income of minor child will be clubbed in the hands of Mr. Pardeep. Generally, we club in the hands of that parent whose income is higher. Here, since question is silent about Mrs. Pardeep, we will club in the hands of Pardeep. And let me tell you, Pardeep also will get exemption of amount clubbed or 1,500, whichever is lower, as per section 1032. And that exemption will come only and only if Pardeep is paying tax under optional tax regime. But if Pardeep is paying tax under default tax regime, 1032 exemption will not apply. Very, very important situation. Next. During the preceding accounting year, when he was non-resident, he has sold 1,000 shares which are acquired by him in British pound sterling, and the sale proceeds were repatriated. The profit in terms of British sterling pound on this sale of 1,000 shares was 1/7% of the cost at 37,500. Indian rupees, it was 50,000. So what? This is only a past untaxed profit which is now brought to India. If it's a past untaxed profit which is now brought to India, it is not an income for current year at all. When it is not income for current year at all, it's not taxable at all. Next point. Para 6. If you observe, Para 6 is all about directors, which is all about your story of law. Next. Para 7 is all about your financials, where related to your financial reporting completely. Come on, let me look at the question. With reference to information given in Para 4, what was given in Para 4, my dear friends? Para 4, they spoke totally about Pardeep and John. Correct? Yeah. Let me discuss. Compute the tax liability of John for assessment year 24-25. What a brilliant question, my dear friends. So they're talking about something called tax liability of John. And if I have to talk about tax liability of John, my dear friends, how do I calculate tax liability of John? Tax liability of John is basically there is some income which is taxable as per section 115 BBA. And what income John has got is very clearly, he has got income from the sport, he has income from advertisement, he has also got income from newspapers. Totally 5 lakh plus 1 lakh plus 10,000, he has got 6 lakh 10,000. And he has got income from horse race, which is nothing but 10,000. And the total income what he has got is 6 lakh 20,000. How do I calculate tax? On 6 lakh 10,000, I'll calculate tax at the rate of 20%. 6 lakh 10,000 into 20%. Next. On 10,000, I'll calculate tax at the rate of 30% as per section 115 BB, casual income. 10,000 into 30%. So total is 1,25,000. On that I will add HEC at the rate of 4%, health and education cess at the rate of 4%. So my total tax liability will work out to 1,25,000 plus 5,000, which is coming to 1,30,000. That is how we need to figure out the answer for this particular question. And if you observe carefully, what are the options they gave? 125, 130, 132, 170. Answer is 1,30,000. By applying provisions of 115 BBA and 115 BB. Next. Second bit. With reference to information given in Para 4, income earned by John would be subject to TDS, of course, and the income constituting 5 lakh for participation of matches in India, 1 lakh for advertisement, 10,000 for article. Would be subject to TDS at the rate of 20%, my dear friends. Let me tell you, TDS will be at the rate of 20%. We have got one brilliant section called 194E that says 20% TDS. Next. 10,000 horse racing, TDS will be 0%. I told you 0% because it does not exceed 10,000, my dear friends. When it does not exceed 10,000, there is no question of TDS because the story of TDS on horse racing will come only if it exceeds 10,000. So the answer will be option A, 20% and 0%. Good. Student is asking, sir, if horse racing was more than 10,000, then we would have already accounted for TDS as it is already paid. Yes, definitely we would have accounted for TDS. No doubt about it. But when we calculate tax liability, we'll reduce TDS, balance only will pay to the government. That's very clear. Got it, my dear friend? Please reply yes so that I can proceed. Thank you. Third question. What would be the residential status of Pardeep? Already I answered this question to you. Answer is RNOR, which is nothing but option B, my dear friends. Correct? Exactly. Without any second thought, the answer is RNOR because Pardeep is somebody who has satisfied the basic condition but did not satisfy both additional conditions together. So for Pardeep, the answer is RNOR. That's it. Next, fourth question is related to your FR. Fifth question is again related to your law. Then they're asking, Mr. Pardeep provides, RNOR as not all additional conditions satisfied. Very good. Sixth question, descriptive part. Mr. Pradeep provides sources of his various income and seeks your opinion about his liability to income tax thereon in India for assessment at 24-25. Assuming that he has exercised the option to shift out of default tax regime. If he's shifting out of default tax regime, he can take that 1032 exemption of amount clubbed or 1,500, whichever is lower. That exemption can be enjoyed. And as we discussed already very clearly, my dear friends, what happens for him, what is taxable is the first income, rental income from flat in London, that will not be taxable. Dividend on shares, that is not taxable. Major income, we will not club. Minor income, 75,000 in UK, not received in India, that is not taxable. 20,000 received in India, that will be taxable, but we'll get exemption of 1,500 per child. So 1,500 will reduce, the balance figure is 18,500. On that, no tax because it does not exceed basic exemption limit. And finally, the last point, which is nothing but the fourth point, my dear friends, that is your preceding accounting year. Some repatriation has been done that we will not tax at all because it is not the income at all for previous year 23-24. When it is not the income for previous year 23-24, why that figure will be taxable, my dear friends? That's it. So point by point, you need to answer that. Then you'll get your scores. And the descriptive question, what is the second question? Assume that there are no other transactions required to pass journal entries. That's related to your financial reporting. That's it. That's the story of the tax related content of this reverse brain case study. And I'm pretty sure that you have got very good clarity on this. And if you have some query, you can feel free to ask. If you are comfortable, then I'm happily I'll proceed. Kindly please reply. Student is asking, yes, sir, one doubt. Yes, my dear friend, please ask. What is your doubt? Please type. You can type what is your doubt. Yeah. What's the doubt student is asking? So reverse brain is just an imaginary term or real term? Absolutely real term, my dear friend. It is actually practically this concept is there. That concept is called reverse brain drain. Basically what happens is that humans who are basically staying in developed country, they come to a less developed country, which is growing more rapidly. so that they'll have a better source for development and they can earn better income. That's the whole point. Good, comfortable. Thank you.
Okay, now let's go to case study number 13. So in this question also we have got one MCQ, which is MCQ number 5. Now MCQ number 5 is something which we have already done before. I mean, this case study is new, but this exact question was covered in one of the previous case studies that we have discussed. Okay, so I'm not going to answer this question. You will be answering this question. And in case you are not able to, then I will tell you the answer or we'll discuss the provision. Okay. So with reference to the information given in para number 6, X and Y equals to what? 212, 215, 315, 312. Okay. Now we'll have to read para number 6 for it. Let's go to para 6. We have to find out the value of X and Y. Okay, so Mr. Pradeep came back to his parental house in Punjab, where his parents were staying with Pradeep's younger brother, Mr. Gulshan. With the grace of God and the blessing of the parent, Mr. Gulshan is all well settled in India presently. Mr. Gulshan is managing a company that is Technologies Limited, being the director of a company. Presently, Technologies Limited has got 9 directors. Okay, yahan se we have got the important details given. So Technologies Limited has got 9 directors. Company's board of directors desire to increase the number of directors from 9 to 16. But the company secretary of the company informs the company's board of directors that as per the provisions of the Companies Act, every public company shall have X number of minimum and Y number of maximum directors. Okay, so X is minimum number of directors of a public company and Y is maximum number of directors of a public company. Yeah, Zoom user is saying 3 and 15. I don't know the name of the Zoom user, but you are correct. Okay, so what is the minimum number of directors for every public company? It is 3. The maximum number of directors for a public company is 15. Where is it written? Where is it written? Which section is it written? So here our correct option is going to be C. Can anyone tell me the section number? So the composition of the directors, board of directors is given in section 149. All right. Okay. So this was a very easy question and we have already covered this in one of the previous case studies.
Let me proceed to the next interesting case study, my dear friends. Are we ready, all of us? Can I proceed? Friends, come on, please reply, please participate. Yes, come on, let me share the screen. Next interesting case study, my dear friends. Case study number 14. I hope you can see that. Lakshya has been recently appointed as chartered accountant with effect from 1st April 2022 in a company namely Lotus Private Limited, which was incorporated 6 years ago. 6 years ago has been appointed as chartered accountant. So 6 years ago, the company has been incorporated. For that company, in 1st April 2022, has been appointed as chartered accountant, and that company paid up capital is 1.5 crores. Lotus Private is a maintenance company and is operating in a commercial complex, a state-of-art mall located in Delhi. What is it, my dear friends? Basically, it's a maintenance company. Good. So a lot of special points will come in this question. The mall has been developed by another company, hereinafter referred to as mall developer. But after the commencement of operation, maintenance services in respect of the mall have been outsourced to Lotus Private Limited. Since Lakshya wants to ascertain the GST liability to be paid for the month of April 2022, he needs to do reconciliation of the data fed in the books of accounts for cross-verification to remove discrepancy, if any. For this purpose, Lakshya has gathered the following facts and information for doing the reconciliation exercise and to compute the exact GST liability. All the units which have been sold by the mall developer are occupied by owner themselves, and some units of the mall which have not been sold have been provided on the lease by the mall developer to the tenants. So some of them have been sold and some of them which could not have been sold, my dear friends, that have been given on lease. Lotus Private Limited does billing of each charge. They do what, my dear friends? Billing of each charge to only those units which are either occupied or which are taken on rent. That is, either it should have been purchased by the respective owner or it should have been rented by the person from company which has constructed the mall. That is mall developer. Next, GST rate applicable is 18%. The description of nature of revenue which Lotus Private Limited collects from its customer is mentioned as follows. Slightly crazy question, more related to GST, but please be very careful when I'm going through the question, my dear friends. Slightly peculiar question, so please be careful. Common area maintenance charges are fees paid by unit owners or tenants to Lotus Private Limited to help cover costs associated with overhead and operating expenses for common areas. Common areas are spaces used for or benefited by all owners or tenants and include but are not limited to elevators, parking lots, lobbies, bathrooms, public building security, everything. And Lotus Private charges common area maintenance charges from customers at the rate of 10 rupees per square feet. The charges are to be paid on the basis of super built up area allotted to the landlord or tenant as the case may be. So each landlord or tenant, how much built up area they got, that into 10 rupees per square feet. That is a common area maintenance charges, which we'll calculate. Next, electricity charges. It collects the electricity charge from the customer on reimbursement basis. That is, a separate billing is done in this regard, wherein the GST is not levied thereon. Very good, correct. Technically, they are acting as a pure agent, my dear friends. For example, if there's an apartment and apartments has got one society association. Society association is collecting electricity from the flat owners and paying that electricity to the electricity department. They are clearly acting as a pure agent. On that, why would they charge GST? I hope you know this word called pure agent. Next, there are separate meter connection attached to the shop from where Lotus Private Limited, on the basis of meter reading, collects charges from the customer in the form of reimbursement. The state government which supplies electricity to the mall and units thereon does not charge any GST along with the bill amount because electricity is outside GST. For the limited purpose of this case, assume that billing of electricity charge is exempt from tax on the contention that supplier is acting as pure agent. They only told in the question. So sweet of them. Next point. DG backup. DG, that is your generator or DG unit charges. Due to vague interpretation of power outages in the region, electricity through genset is being provided. And Lotus Private Limited has its own DG set to provide electricity in such case. And DG fixed charges per kilowatt is equal to 500 and unit charges on the basis of main meter consumption is 12 per unit. So fixed charges is 500 per kilowatt and unit charges on the basis of consumption is 12 per unit. Next, customer who failed to make payment within the due stipulated time, they are required to deposit the interest amount for late payment of outstanding dues to Lotus Private Limited at a rate of 15% per annum. Very good. This interest also will form part of value of supply because I hope you know that section 15 which talks about value of supply, in that there is one point called 15(2)(d) which says any interest, late fees or penalty which is charged by supplier from the recipient shall be included in the value of supply. Next line. Vending charges. Lotus Private Limited on each bill prepared of common area maintenance charges levy vending charges from each customer at the rate of 25. That is also included. Interest-free maintenance security. It's something like security deposit, I guess. It's a lump sum amount which the mall developer charges in lieu of maintaining the mall. As per the agreement, it is to be credited in the account of Lotus at the time of registry by concerned person. And the amount so collected is refundable If it is refundable, it is not included in the value of supply. Next. During the month of April 22, Lotus Private Limited has incurred certain expenses, and the details are as under: total expense incurred 15 lakhs. CGST receivable on expenses as per total invoicing 70,000, as per MIS report prepared by data operator in Excel for each and every transaction. CGST, SGST, IGST. CGST receivable on expenses, which is considered as eligible input, 60,000. 60,000 is just CGST, 60,000 is again SGST. As per the entries done by the accountant in the books of accounts after every voucher approval by indirect taxes manager. Other relevant data is as under: common area maintenance charges. Refer note 1. What is that? We'll see. Including billing done for common area maintenance charges against advance received in earlier month. Electricity charges, DG backup charges, gross interest from customer, DG unit charges, credit note with respect to common area maintenance charges issued to customer within the same month of billing. So credit note is given whenever there is a reduction in value of supply, reduction in tax, we'll give something called credit note. Gross advance received from customer for maintenance. Billing done to customer from common area maintenance charges from whom gross advance as reflected in the bank statement was received in February, 70,800. Vending charges, interest-free deposit. There are 500 units in the mall. Owner occupied units 300, let out units 100, units held in inventory is 100. Carpeted area is given, super built up area is given, KW taken for a DG backup, DG unit consumption is given. Next. Number of registries done during the month of April is 25, and amount of IMFS receivable interest-free security deposit is 30,000. Meanwhile, accounts department has received a request from the unit owner Mukesh, who runs his own business at Noida, UP. He wants to receive the bill as per his business address situated in Noida. Since he will be able to take the benefit of GST input accordingly at Noida address, is it possible, my dear friends? 100% answer is no. In case of immovable property, place of supply is the place where property is located or intended to be located. Just because Mukesh business is in UP, he cannot tell that place of supply will be UP. That's not possible at all. Getting the point, everybody? And the mall is in Delhi, so place of supply will be Delhi. Next. During the year, Lotus Private Limited, in the month of October, took a loan of 1 crore from another corporate, Humara Limited, which is related to Lotus Private Limited. Loan was taken with the purpose to deposit statutory dues of GST, which was pending for a long period of time. And the loan taken was repaid by Lotus to Humara in the month of February itself. That means in the same year, it has been repaid. And hence the closing balance of the loan is nil. Lakshya believes that since closing balance is nil, it does not need to be reported anywhere in the financials or in report of auditors. That is not acceptable because in Form 3CD tax audit report, previous session I have shown you that loans taken, even if they are squared off during the year, even if they are repaid during the year, still we have to report them in the tax audit reports. It is mandatory. Next slide. Further, Lotus Private Limited has defaulted in payment of service tax amount to 30 lakhs for the long time as per the notice received from the department. And this liability is pending. And the amount could not be deposited even after 31st March 23. Disputed matter is still pending at SSTAT for litigation after going through appropriate levels of adjudicating authorities at various forums. According to Association of Certified Fraud Examiners 2020 report to nations, expense reimbursement fraud account for 21% of the fraud in small business, 11% in large business. And company's internal control, policy of expense reimbursement, that's all not related to your tax. They have donated 8,000 in cash to one of the NGO. But is 8,000 in cash, can they get 80G deduction, my dear friends? 100% answer is no. Because 80G has got a limit only to the extent of 2,000 rupees. If the contribution is more than 2,000, it should very clearly be other than cash. And it is shown as expense in P&L. Expense in books of accounts. We'll add back that. Their profit before tax is 5,40,000 and other particulars are as follows. Oh my God. Wages to casual workers, interest on late payment of TDS, depreciation as per Companies Act, depreciation as per Income Tax Act. They use the word other particulars, right? Very good. And interest on fixed deposit. Come on. First MCQ, my dear friends. So you're getting this case study right? Come on, guys. Let's get back. MCQ number 1. Suggest how the issue can be resolved for the request received from unit owner Mukesh to send invoice with corresponding GST to his Noida address. Can it be done, my dear friends? Can be done, my dear friends? 100% answer is no. Invoice cannot be prepared on Noida UP address since IGST will be levied in that case. So answer is, my dear friends, option B, my dear friends. Getting that point, everyone? In case of services, in relation to immovable property, place of supply shall be the place where the immovable property is located or intended to be located. In the given case, the property is located in Delhi. Moreover, supplier is also located in Delhi. Hence, CGST and SGST is levied and not IGST. So answer is, my dear friends, what was the answer? Come on. The answer is very clearly option B, my dear friends. I hope you got clarity on this MCQ. Good. Next MCQ, guys. Lotus Private Limited does the billing of those services separately, which are subject to exemption from GST, like electricity in this case. What should be the terminology for such kind of document as per provisions mentioned in GST Act? Come on, my dear friends, you tell me the answer. What is the correct statement? Student is telling answer is option C. What is option C, my dear friends? Refund voucher? No, not at all. Definitely, my dear friends, answer is option B. We give a document called bill of supply. MCQ number 2, my dear friends. In case where registered person is supplying exempted goods or services, or in case where person has opted for a composition scheme, the document to be issued by the supplier shall be bill of supply and not tax invoice. Very clearly, what document they'll give is, my dear friends, bill of supply, but they don't give a document known as tax invoice. Which point? MCQ number 3. What is the taxable amount under PGBP? They're asking, my dear friends. Interesting question. Come on, friends. What will be taxable amount under PGBP? Lotus Private report a net profit of 5,40,000 for the financial year. Other particulars are as follows. What is that they gave? Wages to casual worker 15 lakh rupees. What will do with the 15 lakh rupees, my dear friends? That would have already been debited to P&L account. Then interest on late payment of TDS, that is definitely added back, my dear friends. Then depreciation as per Companies Act, that will add back. Depreciation as per Income Tax Act, that we will reduce. Then interest on fixed deposit, that is also reduced, my dear friends. Why it is reduced? The reason being very clear that it is not an income related to PGBP. And they clearly told 8,000 rupees donation they have debited to P&L. That also will be added back. Are we getting clarity, everybody? Come on, let me do the working. Net profit as per P&L account. How much, my dear friends? 5,40,000. Next. We will add interest on TDS. How much is the figure? 1 lakh. Depreciation as per Companies Act. How much figure, my dear friends? 12 lakh rupees. Then donation 8,000. Less. Come on, what all will reduce, my dear friends? Depreciation as per income tax. How much is that figure, my dear friends? 18 lakh rupees. Interest on fixed deposit, that figure is 2,50,000. Income under PGBP will be this plus this plus this plus this minus this minus this. The figure is coming to negative 2,02,000. That is basically loss, my dear friends. Got this question, everybody? A very, very interesting question. Question number 3 MCQ. Good. One student is asking one question before I proceed. Sir, one doubt. Can issue tax invoice for supply both exempt and taxable as single tax invoice, or should we issue separate tax invoice for taxable and bill of supply for exempted? See, what they told in the law is generally for taxable we give tax invoice. If we supply only exempted, we give something called bill of supply. But there is a possibility where, example in supermarket, where taxable and exempt are supplied together. In supermarket, the taxable and exempt are supplied together. When the taxable and exempt are supplied together, in that case, we give a document called invoice cum bill of supply. We give a document called invoice cum bill of supply. That is possible. Got it, my dear friend? Done. Fair enough. Very good. Thank you. Let me proceed to next MCQ. MCQ number 4. How much deduction can be claimed under ATG for donation to NGO? Come on, my dear friends. What is the answer? Straight answer. No deduction is allowed because donation made in cash exceeding 2,000 are not allowed as deduction under ATG. Next. Whether the loan obtained from Hamara Limited needs to be reported in Form 3C by the auditors. 100% answer is yes, my dear friends. Loan should be reported even though it is squared off during the year. Mandatory. This case study is completely related to taxation. If you observe, almost every point is related to taxation only, my dear friends. Donations in cash exceeding 2,000 is not allowed as deduction as per section ATG. Then MCQ number 5, my dear friends. Loan taken during the year are to be reported in Form 3CD even though they are squared off during the year. Even though they are squared off during the year, my dear friends, it is mandatory that we have to report that loans taken. Done. Come on, let me proceed. Analyze the issue of Lotus Private Limited for the billing done to customer and accordingly compute the net GST liability to be paid for the month of April 2022. Support your answer with details working. Oh my God. Detailed working and explanation wherever it is necessary. Very good. They are talking about total billing done to customers. We have to talk about all these points. Correct? Come on. Let's start the discussion then. Particulars, amount. Got it? Come on. First of all, common area maintenance charges. How much is common area maintenance charges, my dear friends? First of all, tell me, my dear friends, come on. What is common area? Common area maintenance charges. I'll go back to the question. Hold on. Sir, common area maintenance charges is totally 10 rupees per square feet, my dear friends. And what is the total square feet we have got? Should I see carpet area or super built up area? Should I see carpet area or super built up area? In the question, they told that point. The charges are to be paid on the basis of super built up area allotted to the landlord or tenant. Come on, how much is allotted to landlord or tenant? Super built up area is 1,50,000 and here it is 50,000. What is units held in inventory? That is not considered. So total figure is 2 lakh square feet into 10 rupees per square feet. It comes to how much, my dear friends? 20 lakhs then. Two lakh per square feet into 10 per square feet. I mean 2 lakh square feet into 10 rupees per square feet. I'm sure you got this working, my dear friends. That is the story of common maintenance charges. Come on, please reply, my dear friends. Then electricity charges, I'll put it as 0. Obviously, I put it as 0 because we are acting as a pure agent there. What else? DG backup fixed charges. DG backup fixed charges, my dear friends. Come on. DG backup fixed charges. What is that they have specified in the question? Let me go back to the question, my dear friends. DG backup fixed charges. DG fixed charges is 500 rupees per kilowatt. 500 rupees per what, my dear friends? Kilowatt. Number of unit, number of 500 rupees per kilowatt, no, my dear friends. Come on, how many kilowatts are taken? Let's see that. How many kilowatts taken for a backup is, my dear friends? 750 and 250. Total is 1000 kilowatts. 1000 kilowatts into 500 per kilowatt. Into 500. Friends, I hope you are getting clarity on this point. Very, very interesting question, my dear friends. That is about DG charges. Then interest received from customer as reflected in the bank statement is 3,18,600. So the point is very clear. Whenever interest is received, that interest is received is always considered as including GST. And the figure is how much, my dear friend? 3,18,600. Interest received from customer. 3,18,600 into 100 divided by 118, because that figure is always taken as including GST. That's it. So I got this figure as 2,70,000. Next, come on, my dear friends, what else is given? I'll again share the question. I need to again and again keep sharing, no problem. Next, interest point is done. Next, what else? DG unit charges. How much is the DG unit charges they told in the question? DG unit charges is based on the consumption, which is 12 rupees per unit, my dear friends. They clearly told DG unit charges is based on consumption, and that is 12 rupees per unit. ₹12 per unit. Get back. DG unit consumption. 4,000 is consumed by owner occupied units. 1,000 is consumed by let out units. So total is 5,000, my dear friends. 5,000 is the DG unit consumption. So that into ₹12. DG units consumption. Sir, I hope you're getting clarity on this point, everybody. Friends, come on, please reply. $5,000 into 12. Very, very interesting question. A lot of GST related points are there in this question, my dear friends. Student is a little difficult. See, every question is not the same. Some questions are definitely crazy questions. So you have to be very careful with them. Got it right? Next point. Credit note with respect to common area. Credit note, what we'll do is always reduced. Then gross advance received from the customer for common maintenance charges reflected in balance statement. Since it is advance, this figure will take it as inclusive of GST. Let me write that, come on. Negative figure 80,000. Next. Advance from customers. 3,54,000 into 100 divided by 118. So that figure is coming to 3 lakhs. I'm sure we are getting clarity on this point, my dear friends. Come on, please reply. Advance is always considered as inclusive GST, and we have taken that amount for a simple reason, because in case of services, my dear friends, time of supply is what? Date of invoice or date of payment, whichever is earlier. So payment received in advance, that will be considered, my dear friends. Good. Next point. Last 1-2 more points to discuss. That is billing done to customers for CAM charges from whom gross advance as reflected in the bank statement amount as in corresponding column was received in February. That means already billing is done before only, my dear friends. When billing is done before only, my dear friends, come on, the point is very simple, my dear friends. When the billing is done before only, my dear friends, before only we would have paid GST. Now, before only we would have paid GST. Why will you pay GST now again? That will be reduced. Because now we are doing billing. That means basically advance is adjusted. Advance is what, my dear friends? Adjusted. Because on this advance, we would have already paid GST before itself, my dear friends. On this advance, we would have already paid GST before itself. Friends, come on, please reply. I hope you are getting clarity, everybody. Clear with that point, everybody? Come on, finally, 1, 2 last points in the question. Sir, this point again. Okay, let me repeat that point once again. Billing done to customer. So in this month, what has happened is we have done the billing, my dear friends. In this month, in the month of April 2022, we have done the billing. Billing is done for what? Billing is done for CAM charges from whom advance as reflected in the bank statement was received in February 21. That means before only long back we got advance. Long back only we would have got advance means that time only we would have paid GST. Now just because we gave billing, will we pay the GST once again? That is something like advance is adjusted, my dear friend. I hope we are getting clarity, everybody, sir. Sir, I hope we are clear with this point. Come on, kindly please reply. Done. Next point. Vending charges. What is the vending charges, by the way? Somewhere they told previously. Vending charges is 25 from each customer. Vending charges is what, my dear friends? 25 from each customer. Correct, right? And how many units are there? 300 units are owner, 100 is let out, 100 is inventory. Forget inventory. So 400 units into 25 per unit. Vending charges 400 into 25 per unit, my dear friends. Sir, I strongly believe that we are getting clarity on this question. A very, very interesting and important point. Are we clear? Can I proceed? Please reply. Student is telling advance adjustment put negative figure. I did not put negative. Yeah, this has to be negative. So this will be minus 60,000, right? Yes. Getting my point, everybody? Then refundable deposits. This will be 0 because that will not be taxable. So total value of supply will be, how much is that figure, my dear friends? 30 lakhs. Total value of supply will be 30 lakhs, my dear friends. CGST at the rate of 9% will be 30 lakhs into 9%. SGST at the rate of 9% will be 30 lakhs into 9%. So that's the story of output CGST and SGST. So getting my point, everybody? So that is the story of output GST. And by the way, what is input GST? What is the input GST figure? Let me go back to the question. They gave here CGST receivable, SGST receivable, IGST receivable. But eligible input is only 60,000, 60,000, 20,000. Let's take the figure of only eligible input. Input IGST 20,000. Input CGST 60,000. Input SGST 60,000. I hope you are getting clarity. I know it's slightly crazy question, but you still have to get a clarity, my dear friends. Ultimately, not every time same kind of questions will come in exam. Output CGST, output SGST. And the figure is 2,70,000 and 2,70,000. Come on, friends. When I wrote the figure of output figures, now what is that I have to reduce first? When I write less input tax credit, what is that credit I have to reduce first? Come on, please tell everybody. Always the figure must have to reduce is IGST, because law clearly says, my dear friends, CGST, SGST credit to be utilized only after IGST credit is fully exhausted, and IGST credit can be used first for IGST, then for CGST or SGST in any order, any manner. And preferably we always adjust equally so that we can do optimum utilization of credits. So net GST payable will be net GST payable will be 2 lakhs and 2 lakhs. So that is the net GST payable by this so and so entity where brilliant, interesting points are involved. I strongly believe that we got very good clarity on this case study, my dear friends. I know it's slightly critical and crazy, but a very, very interesting point, my dear friends. Getting the point, everyone? A very, 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 very interesting case study, actually. Lot of GST related points are there in this question. Done. MCQs we have discussed. Descriptive first question done. Second question is not related to taxation internal controls. It is. Third question is related to audit report. That is also not related to taxation. Student is telling solution they gave 190 and 210. They would have adjusted that IGST credit with CGST. Sir, IGST credit can be used for IGST, then for CGST or SGST in any order, any manner. Whatever manner to set up, that is still okay. Just because in solution they have done something doesn't mean that is only correct. Let's go by the provision. Okay, my dear friend? Yeah, that's it. That's all for today's discussion, my dear friends. I want to discuss these two very interesting case studies so that we get complete clarity of thought and also get an experience as to what kind of variety questions keep coming in the examination. I hope you are fully clear with this point, my dear friends. Don't be scared. The whole idea of solving this kind of question is only to ensure that we get more clarity and perfection. And as I told you already, 1-2 case studies will always be slightly critical. Because generally it's so set pattern that 70 to 80% paper will be comfortable, but 20-30% paper will definitely be some crazy questions coming into the examination. That's the reason why I wanted to discuss this kind of case studies so that you get more clarity, my dear students. That's it. That's all for today. Thank you so very much. Take care. See you all tomorrow at our regular timings only. We'll meet tomorrow, and tomorrow we'll cover 2-3 more interesting case studies. Thank you so much. Shivateja signing off. Bye-bye. Thank you.
Let's move on to the next one, case study number 15. TDS requirement, first question. Credit of tax paid, GST related part. According to the provisions of Company Act, listed company may have one director elected by small shareholders related to directors and small shareholders. Compute the interest on machinery that is allowed at deduction under Income Tax Act. Again, income tax part. As the management of Vallabh Cotton Limited approached CA Rajesh for seeking advice on appointment of woman director company law. Describe in the light of provisions contained in Companies Act whether the proposal to appoint Mr. Brijesh as a small shareholders director can be adopted by the company. Again, law part. Treatment of interest payment on loan and depreciation allowable for assessment year 24-25. Again, company income tax part, and input tax credit. Again, your income tax part, right? Now, this case study will be taken care. Case study number 15 will be handled by your tax faculties and law faculties. But here, the reason why I brought about this particular case study is coming to this part, what I wanted to specifically discuss. C. Arvind Kapoor, the founder of Kapoor and Company, is a member of ICAI, who initially set up his practice in Delhi, has rich experience of more than 35 years. So these are all your normal discussion. They are specialized in some area, that is also normal discussion. Then here they talk about issues related to a client which is a listed company. One sister concern of Vallabh Cotton Limited is Agresian Spinner Private Limited. Agresian Spinner Private Limited was in the business of trading of yarns. Now gradually the company wants to go forward in the area of manufacturing as well. Now here you can have dimensions of strategic management as well, where they are trying to go into manufacturing. Currently they are doing what? Trading. So in the supply chain, you have yarn. Currently you are buying yarn, but now you want to manufacture. When you want to manufacture, you are going back one step in the supply chain. Okay, please understand. There is something called as forward integration. There is something called as backward integration. You are going back. Manufacturing is going back. So there can be some angle related to backward integration as well. Then the company purchased machinery on 1st of April for 10 crore. Company paid from their own funds 30%, 70% loan from a particular bank at 12% per annum. Now tell me one thing. In this particular case, can we capitalize interest as per Ind AS 23? Can someone tell me, as per Ind AS 23, whatever interest they pay, 12% per annum, 1st April they have acquired, own funds 30%, 70% is a loan, that is 7 crores of loan into 12%. Can I capitalize this interest as per Ind AS 23? Yes or no? Can I capitalize interest paid on buying this machinery as per Ind AS 23? Yes or no? So you are saying yes, but here you have to understand, generally, machinery, whenever you procure, they have said they purchase. Whenever you procure a machinery, generally it is ready for use. Unless you have to carry out some installation construction, which will take a significant period of time, you cannot capitalize the interest. So whatever interest is paid here, you will not capitalize. You will consider it to be an expense only. Okay. So that is what you have to do. They are put to use on 1st of February, but was it ready to use? That is the question we have to ask. Okay, because we may have delayed the usage because we didn't have other aspects. The machinery might have been ready for use. It will not generally, trucks, machinery and all of those things which you do not construct, which you purchase outright, are considered to be in a usable condition. You will not require significant amount of time. But if you are constructing a plant and machinery all by yourself, then it may be a qualifying asset. So that's it from this angle. Yeah. Okay. Then we have this case study number 13, reverse brain drain. I think that is as a part of your November 23 paper also. So that we will discuss at that point of time. We have uploaded extracts of important sections for corporate law and a referencer with form numbers which are filed, for which form numbers are required to be filed. So you can start going through that. Again, when you're preparing for this paper, don't try to by heart anything. Whatever you're carrying, just know this section is available here. I need to pick up the relevant section and I will need to write the answer. This theory is here. I will pick it up from this place and I will write the answer. That will be our approach, right? So in the next class on Monday, either taxation or law will be covered. Then after this, what we will do is, after this set of case studies completed, we will complete the case study digest of November 23, some of the thing. Now, I also want, or we'll also give you some case studies for your own practice out of this set, and our own created case studies, especially for FR, where you will need some more, push on practicing the questions, and also maybe some case studies on law which may be relevant. which you have to start writing on your own. Now, understanding is one thing, presenting and writing in the exam is another thing. So that is where our focus will start moving from this week onwards. So you will be getting some homeworks which you have to do on your own. And then we will see how do we handle or whether we are able to manage one case study in that given point of time. So that is very, very important as well, right? So we'll need to see in a timed way, are we able to complete those case studies? So that is what will be the plan going forward from next week onwards. Chalo, thanks a lot, and we'll continue on Monday with the remaining cases. Thank you.
So friends, today what we'll do is, we'll also spend a little bit more time and discuss case study number 15 also, my dear friends. I'm sure you are ready to cooperate, my dear friends. Please respond, everyone. Can I go ahead? Thank you very much. Case study number 15 and the last case study for today's discussion. CA Arvind Kapoor, the founder of Kapoor & Co, is a member of ICCA who initially set up his practice in Delhi. And Kapoor & Co has rich experience of more than 35 years in almost every field and served a diverse clientele from individual taxpayers to conglomerates. He has given service to individual and he has given service to big corporates also. Their audit approach is pragmatic, relying on risk-based audit methodology, built on extensive planning and client input, and is fully supported by latest technology and tools. Wow! As a result, firm's audit practice has grown continuously and earned specialization in direct tax, indirect tax, internal audit. Arvind Kapoor, Rajesh, Piyush, and Gaurav are 4 partners of the firm, and they are specialized in their own niche. They all met at a common event and decided to start their own firm. With their combined efforts and dedication, firm has accumulated an enormous amount of knowledge that has been built with passing of every year. So first individual was there, then they decided to get into firm. That's it. One of the valuable clients is Whirlsonic Cotton Limited, which is a listed company. And Whirlsonic Cotton Limited is a manufacturer of cotton. There are some issues going on in the company. Company gets its all finance-related work done from Gaurav. When the management discussed matter with Gaurav, he praised work of his partner Rajesh. And hence management approached Rajesh for seeking advice on appointment of small shareholders director related to your law. I'll proceed then. One sister concern of Vallabh is Agarsen Spinners Private Limited. Earlier, Agarsen Spinners was in the business of trading of yarns. Now gradually, company wants to go forward in the area of manufacturing as well. Last year, company made investment in construction of building, and this year they purchased machinery for 10 crores. And company paid from their own funds 30% and balance 70% by taking loan from the bank. So loan is taken from the bank to purchase the asset. Clear? And that asset what they purchased is machinery, my dear friends. And that machinery is used for the purpose of manufacturing. Machine was required for extension of business and was put to use into effective production on 1st of February 2024. And let me tell you, under income tax law, if it is put to use for less than 180 days, we will claim only half of normal depreciation. Next slide. Accountant wants to take advice from CA Arvind, who specialized in direct tax regarding depreciation. We'll discuss that. Management also wants to discuss with Arvind regarding TDS provision on payment made for a job work, excluding material cost. That means payment is made to contractor towards work done. How much is paid? 22,000, 15,000, 23,000, 25,000 and 18,000. How much the total comes to, beta? 22 plus 15 is 37. 37 plus 23 is 60,000. 60 plus 25 is 85,000. 85 plus 18 is 1,03,000. Here the point to be noted is that in case of 194C, TDS provision will apply if single payment exceeds 30,000 or aggregate exceeds 1 lakh. Since starting when payment is made, we don't know whether we cross 1 lakh or not, my dear friends. The last payment, that is 18,000, when it is made, we know that we cross 1 lakh. While making payment of 18,000, we have to do TDS on the entire amount of 1,03,000. That's the beauty of section 194C. Company claims that it is not liable to TDS. They will tell all the story. Company seeking advice. That will tell no. Next. Partners and staff usually meet on every Saturday over coffee and discuss topics requiring deliberation. Such exercise make their staff updated as well. Very good. In one such meeting, they discussed about issues related to block credit and credit admissible. In this meeting, they also discussed about remedy that would be available if incorrect input is taken. If incorrect input is taken, they have to reverse it. All of a sudden, CA Piyush expressed his willingness to handle a renowned client, IGT Private Limited, having good volume of turnover. See that line, my dear friends. 1 second. IGT Private is the business of manufacturing of textile products. The accounts team of company is not much aware about GST law. Earlier, GST work was taken care by some other professional, Ryan and Co. And in February, proprietor has shifted abroad. Hence, the management approached Kapoor and Co. for their GST work, for which CA Piyush came forward to support. Accountant has correctly taken all other credit related to company purchases, but he was confused in respect of availing ITC on following. If he is confused, we are there to clarify. First point, goods purchased without invoice, no credit. Purchase of goods not to be used for business, no credit, it's a block credit. Purchase of goods from Sethilar and Sons, invoice received in February, but goods were received in March. If goods are received in March, take credit in March, because there is a mandatory condition in section 16 that goods or services or both must be received. Pollution control equipment used in factory, capitalized in the books, take input. Motor lorries for transportation of goods. Generally for motor vehicle, we can't take input, but we can take input if it is for transportation of goods. Electrical transformers used in the factory, we can take input. Capital goods to be used as parts, purchased from supplier paying tax under a composition scheme. If supplier is in composition scheme, how can receiver take input tax credit? Next. Molds and dies used in factory, take credit. Company buys cement, tiles, and avails services of an architect for construction of building. Whatever credit is related to construction of building, it's very clearly a block credit. That credit we can't take, my dear friends. First MCQ. With reference to information given in table regarding payments on account of job work, which one of the below option is correct in respect of amount on which TDS is required? I already told you, my dear friends, TDS is supposed to be done on entire value of 1,03,000. No doubt about it. So answer is option C, my dear friends. Because 194C, single payment exceeds 30,000 or aggregate exceeds 1 lakh, TDS will apply. Next point. Credit of tax paid on almost every input that is used for supply of taxable goods is allowed under GST, except list of items provided under CGST Act. Thus, ITC on such items is not allowed, even though they qualify as inputs, input service, and capital goods. Concerning the relevant to GST law, which of the following ITC is admissible? First one, goods lost, stolen, destroyed. No question of ITC. General insurance of motor vehicle for transportation of person, seating capacity is 7%. If it is 7%, you can't take, because even if capacity is more than 13%, then only credit is allowed. 17.5 clause A. Next. Confectionery items for consumption provided to employees working in a factory under statutory obligation. Friends, let me tell you, if it's on account of statutory obligation, if it is provided on account of obligation under any law, then definitely credit is allowed. Normally on food and beverages, credit is not allowed, but it is given on account of obligation under any law, then definitely credit is allowed. D point, food and beverages procured from Mohan caterers for being used in dealer's meet. How can we take credit? In case of food and beverages, there is no question of claiming credit. Third question, directors. Which point? Fourth bit, compute interest on machinery that is allowed as deduction under Income Tax Act to Agar Sarsin Spinners Private Limited. Let's go back to the question. What is that they have done actually? Yeah, they purchased one machine. Okay. Now, when did they take the loan? They purchased one machine on 1st April, my dear friends. 1st April, they purchased one machine. I repeat once again, my dear friends, see the point very clearly. When did they buy the machine? 1st April, they purchased the machine. Okay? And machine was actually put to use from which date, my dear friends? 1st of February. 1st of February. Then what is that is going to happen, my dear friends? Come on, friends. Let me clarify the point very, very clearly to you, my dear friends. And write the answer actually. We are not talking about depreciation. The question they're asking about interest, my dear friends. MCQ number 4. Straight answer, my dear friends. Interest till the date asset is put to use is capitalized and added to cost of asset. But interest for the period after asset is put to use is allowed as expense. Now, what is that? They asked in this question, my dear friends. They asked in the question very clearly, what is the interest that we can claim as deduction? If we're talking about what is the interest that is claimed as deduction, my dear friends, from 1st of February, asset is put to use. So, interest for February and March is allowed as deduction. And what is the loan they have taken, my dear friends? The loan they have taken is 7 crore, my dear friends. Friends, correct, no? So come on, my dear friends. Loan what they have taken, my dear friends? Loan they have taken is 7 crore, my dear friends. Loan taken is 7 crore at 12% per annum. So interest allowed as deduction is equal to 7 into 12% into 2 by 12, which comes to 14 lakhs, my dear friends. I've done 2 by 12 for a simple reason, because it is 12% per annum and will take only for 2 months. Are we getting clarity, everybody? So very clearly, my dear friends, the answer is option D, my dear friends, which comes to 14 lakhs. Very, very interesting question. And I'm pretty confident and sure that you got clarity on this point. I'm expecting a reply from you, my dear friends. So kindly please reply. Thank you very much. Good. Now see the next point in the question. 5th bit related to your law. Next. Descriptive question. 1st bit. In the light of provisions contained in Companies Act, whether the proposal to appoint company law. Next. 7th bit. Advise Agrasen Spinners Limited on the tenth of interest. I already told interest till the date asset is put to use is capitalized. After that period, we'll charge off to P&L account as an expense. Clear, my dear friends? And they're also asking what is the depreciation allowable. First point, actual cost of asset is 10 crore. And interest till asset is put to use. Tell me, guys, for how many months will you take? For how many months, my dear friends? How many months will take is obviously for 10 months, April to Jan. $10 months, which is equal to 7 crore into 12% into 10 by 12, which is coming to 70 lakh, my dear friends. So therefore, total cost of asset will be, come on, my dear friends, total cost of asset will be 10 crore 70 lakhs. And on this, my dear friends, I'm going to claim depreciation at the rate of 15%. Friends, come on, my dear friends, depreciation, what rate I will claim? 15%. This into 15% into 1 by 2. Why is that I've done 1 by 2? Obviously, I've done 1 by 2 because it is put to use for less than 180 days. If it's less than 180 days, I'm going to claim obviously only half of normal depreciation. But one special point in this question is that apart from normal depreciation, my dear friends, I'll also claim additional depreciation because it is used for manufacturing. Additional depreciation will be 10% because if it is put to use for less than 180 days, my dear friends, additional depreciation that is allowed is only 10% and the balance 10% can be claimed in next year. Balance 10% can be claimed in what, my dear friends? Next year. Are we getting clarity, my dear friends? Very, very interesting point. There is no doubt about it. Super duper point. Good. Let me get back to the question. Come on, friends. What is the last thing they have asked? Compute the input tax credit admissible under GST law to IGT Private Limited for February. Come on, get back. I think already we discussed. I gave an answer already, but still we'll see again. Come on. First bit. Goods without invoice. What is the answer? No credit. Not for business purpose. No credit. Purchase goods. Invoices come in February, but goods will come in March. Again, the answer is no credit. Pollution control equipment take credit 1,50,000. Motor lorries for transportation of goods take credit 2,50,000. Electrical transformers take credit 225. Capital goods from composition, no credits. Moulds and dies take credit 65,000. Company buys cement, tiles, and avails service of architect for construction of building. So ITC related to construction of property, we can't take it as credits. So credit what we can take is only 1,50,000, 2,50,000, total is 4 lakh, plus electrical transformers 225, which is 625, mounts and dies 65,000. Total credit what I can claim is only 6,90,000. That is only the credit which will be eligible for me, my dear friends. Because rest all credit is block credit. That's it. That is the story of this very, very interesting case study. Because other points, credit is either blocked or we have not satisfied conditions of section 16. And in those cases, credit is not allowed. So that's all, my dear friends. That's the interesting story of this case study number 11, 12, 13, 14, 15. 13 I didn't discuss today, but in previous session, already we covered case study number 13. So 11, 12, 13, 14, 15 case studies are done. Clear, my dear friends? Totally everybody, sir. Can you please respond, my dear students? Sir, I have a doubt. Yes, my dear friend, please ask me what is your doubt. Sir, please add key points and the questions in the group. I'll share that. I'll share that in the group. Don't worry. Yeah. One student told he is having some doubt. What is that doubt? Please ask.
Hello. Hello, can you hear me, sir?
Sir, you can type the message. Whatever doubt you have, please type that.
Hello.
Yes, my dear friend, please
Sir,
type.
can you hear me?
Yes, please go ahead. So now you can ask. Yesterday I had not attended. Can you please ask them to upload the video? I'll talk to the team, don't worry. My dear friend, you can unmute yourself now.
Okay.
What happened, my dear
Hello.
friend? Yes, ask please.
Okay. If a person is declared as insolvent today by the court,
Okay.
but he has involved in a Hawala transaction before 2 years, and income tax department sent a notice to him. But
Okay.
what will be his status right now? Because he is already declared as insolvent, but he declared as he got a notice around 78% unexplained money. I understand you.
I understood from where this question is coming. From 115 BBE, unexplained incomes, that 78% tax is coming,
Yes.
and that fellow has actually become insolvent.
Yes.
When he became insolvent, technically he cannot pay that 78% tax. Now the point is that if he has been declared insolvent through court route and he has already become insolvent, then practically income tax department can recover only to the extent of any assets which are left out in the order of that liquidation process.
Okay.
That is the only option that is
But
left.
will he go to jail or something like that?
Jail is highly possible, depends upon the quantum involved. Prosecution is very much possible. Just because you are insolvent doesn't mean that you will escape prosecution. Yes.
Yeah, because I heard a news that last week, six months, one lady got imprisonment by the court for not filing income tax return.
No. That is very much possible, my dear friend. Very much possible, no doubt. Yeah.
Okay.
Thank you very much. Thank you very much, my dear friends. Thank you very much. See you all very soon and again with some more interesting case study. Thank you very much. Take care. Shivateja signing off. Bye-bye. Thank you, my dear friends. Good night. Take care.
Okay, now we are going to move on to the 15th case study, which is also the last case study of our study material. Although today we are going to be covering more case studies. Now, 15th case study has got more questions relating to company law. Okay. So let's look at the MCQ. So MCQ number 3 is relating to company law. Let's read the MCQ. Then we are going to see the remaining things. Okay. 1 second. According to the provisions of the Companies Act, a listed company, whenever you see these words, no, listed company, private company, unlisted company, please mark them, because accordingly, our provisions change, the applicable provisions change. A listed company may have one director elected by the small shareholders. The provisions enable the small shareholders to place their representation to the board of directors of the listed company so that their voice is also listened effectively. The small shareholders are entitled to give a notice to the company requiring the company to make the appointment of the small shareholders director. Whether 400 small shareholders of Whirlsonic Cotton Limited are in the position to propose Mr. Brijesh as the small shareholders director. Okay, so this question is clearly about small shareholders director. This question says that this company is a listed company, and this listed company has 400 small shareholders that are making an application to the board of directors asking them to make Mr. Brijesh as their small shareholders director. Accordingly, we'll have to select the correct statement. Can Mr. Brijesh be appointed? Can this application be made? Okay, we'll have to select the correct option. Okay, so now in order to understand, we need to have some more facts from the case, like what exactly happened with this company, how many total small shareholders are there. Then we will refer to the provision relating to small shareholders, and then we'll select the correct option. Okay, so let's go into the question to see other facts. Okay, so we've got to read a huge paragraph here. Let's read this paragraph to understand more. One of such valuable clients, Whirlsonic Cotton Limited, which is a listed company. Whirlsonic Cotton Limited is leading manufacturer of cotton. We don't care. There are some issues going on in the company with respect to appointment of small shareholders director. The company gets all the finance related work done by Mr. Gaurav Satija. Now, when the management discussed this matter with CA Gaurav Satija, he praised the work of his partner, who is an expert in the company law matters, etc., etc. Hence, the management of Whirlsonic Cotton Limited approached this CA for seeking advice on appointment of small shareholders director and appointment of woman director in the company. Now, the company has got, okay, here the important facts are stated here only. All this was garbage. It was irrelevant for us. Okay. Now, the company has got 10 lakh equity shares of 10 rupees each. So 1 crore capital. The company has 500 small shareholders. So in total, the number of shareholders, small shareholders are 500. Majority, that means 400 of these small shareholders want to appoint Mr. Brijesh as the director, their representative in the company. Now, Mr. Brijesh already holds 10,000 equity shares in the said company. So these are the facts. Okay, total 500 small shareholders, 400 of them want to appoint Mr. Brijesh. Mr. Brijesh holds 10,000 equity shares. Into 10, that means 1 lakh capital this person holds. All right. So which of these following statements is correct accordingly? So for that, we need to also see the provision. How many small shareholders can appoint a small shareholders director? So what is the relevant section here? Can anyone tell me? Okay, so we have got section number 151, which talks about small shareholders director, which is relevant for us. Correct. Dheeraj is correct. Okay, so see, section 151 says that a listed company may have one director who can be a small shareholders director. That means he will represent the matters relating to small shareholders. Now, what is a small shareholder? A small shareholder is a person who has less than, not more than 20,000 rupees of nominal value of capital. That is a small shareholder. This is not the prescribed limit for someone who can become the small shareholders director. No. This is generally one person who is a small shareholder. Okay. Next. When for the sake of appointment, the application has to be made by the small shareholders, or the other alternative is that the company can themselves on their own appoint someone as a small shareholders director. These are the two possible options. Company can suo motu make the appointment, or small shareholders can make a representation. Now, how many small shareholders can make a representation? Not less than 1,000 small shareholders, or 1/10 of the total number of small shareholders, whichever is less. That is, those number of people can make the representation. Okay, so in our given case, we had total 500 shareholders, which were small shareholders. Out of that, 400 made the representation. So we'll do some calculation here. So if you look at the calculation, 1,000 shareholders, or 1/10 of the total number of shareholders. In this company, we have total number of shareholders 500. So 1/10 of 500 is 50 small shareholders. So if an application is made by 50 small shareholders, or any number more than 50 small shareholders in this company, it will be sufficient. These shareholders will have enough capacity as per the Companies Act to make this representation. Right? So in this given case, 400 small shareholders have made the application. Is this a valid application? Tell me. Is this a valid application from the small shareholders? Yes or no? Yes, yes. Correct. So we are going to accordingly select the option. Let's read the option. Option A, yes, the notice may be given by at least 1,000 or 1/10 of the total number of small shareholders. Whichever is lower, this seems like the right option. But still, we are going to read the other three options also. No, the notice may be given by at least 1,000 small shareholders, or 1/10 of the total number of small shareholders, whichever is higher. Whichever is higher. So this higher word is wrong. It has to be whichever is lower. Therefore, this second option is incorrect. Third, no, the notice may be given by at least 1,000 small shareholders. This is partially correct, not complete. Yes, the notice may be given by at least 9/10 of the total number of small shareholders. That is incorrect. Okay, so we have the correct option as A. Now see, these provisions, this we have understood, okay? But see, if you remember law, if you remember these important provisions, you will save a lot of time in the exam. Why? Because this is something which is like, so if you have read law multiple times, this is a very common, this is a very simple provision. It has been asked so many times in the exam. So then you will save the time of looking into the book, finding the provision, and then checking the answer. If you have already studied the exam papers, no, this, you will remember this provision. You will save time and you will directly look at the options and tick mark the correct answer. So if for specifically for law and taxation and these law related subjects, try to learn the provisions, at least the important ones. That will save you a lot of time in the exam, because then you will not have to look at the book and find the provision. That time will be saved. And in the exam, time ultimately matters. Time, you think it's 4 hours, but it's actually, when you start solving the questions, it feels less. Okay, so moving on to the next question. So next question is question number 5. Let's look at question number 5, MCQ 5. Okay. As management of Vallabh Cotton Limited approached Mr. Rajesh Damija for seeking advice on appointment of woman director in the company, which one of the following he should have suggested regarding the same as per law? Okay. This simply says select one of the correct answers. Sorry, one statement which is correct out of the existing options relating to advice on the appointment of woman director. Okay. Now, if let's say you don't even know the facts of the case, if you just look at the options and you look at the provision relating to woman director, you will be able to easily solve the answer. You will be able to come to the answer. Okay. So before we read any of these options, first let's look at the provision, so that you know what is the provision of woman director. Once you look at the provision, we'll be able to easily select the answer. Okay. So woman director we have just now studied. We have discussed that woman director is covered in section number 149. Okay. Now, certain prescribed companies will have to have at least one woman director. We have discussed this. What are these prescribed companies? Rule number 3 says that listed company should have at least one woman director. Any other public company where paid up share capital is 100 crores or more, or turnover is 300 crores or more, should have a woman director. Okay, now this is the basic provision. Now, based on this provision, what should be the advice of the CA? Let's select the correct option here. All the companies need to appoint a woman director. Is this correct? Should all types of companies should have a woman director? No. Only prescribed companies should have a woman director. Every listed company or every other public company having paid up share capital of equal to or more than 100 crores or turnover equal to or more than 300 crores. Now this looks similar to what we discussed. So this seems like the right answer. We had discussed this only. Every listed company and any other public company having paid up share capital of 100 crores or more, turnover of 300 crores or more. That's what this option says. So B is the correct answer. We are still going to read the other two options. Every listed company or every other public company having paid up share capital equal to or more than 10 crores or turnover equal to or more than 100 crores. Now, this is not the prescribed limit. So this is incorrect. The other requirement of a woman director is applicable only for private companies. This is again incorrect, right? So B is the correct answer. Even if you do not read the question, the case study, this is something which we can directly jump into our provisions and we can solve this answer. Okay. Okay. Let's move on. Next, we have one descriptive question here also. So question number 6. Okay. Describe in the light of the provisions contained in the Companies Act whether the proposal to appoint Mr. Brijesh as a small shareholders director can be adopted by the company, and also brief the law relating to appointment of small shareholders director. What would be your answer if Brijesh is already holding the position of small shareholders director in 2 companies? Now, whenever you read a descriptive answer in this paper or in any other subject, please divide the question into parts. See, here we have got 3 parts of the question. Each of these part covers marks. So if let's say, if you're in a very fast pace, you're, randomly brushing through the question and trying to answer the question, you don't have enough time, probably you will only write part of the answer. You will probably just write half of the provision, or you might miss out one, part of the question. So ensure that you don't do that. Ensure that whenever you read a theory questions, divide it into parts and then answer and address every part of the question. Ma'am, will I need to read the full law book before exams? Not the full law book. I mean, see, you have to at least have the provisions correctly. Like you need to see the entire provisions, all the provisions. And just so that you know, just a broad reading or broad idea of what all is covered, that is needed if you genuinely want to give a good exam. Okay. Otherwise, also you should at least know the full index, all the possible sections that are there, what are the provisions covered. Without that, randomly, how will you know which provision to go to and all? Okay. Acha. Okay. So we'll go to this question now. Describe in the light of the provision whether the proposal of Mr. Brijesh being appointed is correct or not. First part, we have to see whether Mr. Brijesh is eligible or not. Okay, second part, we have to state the law relating to appointment of small shareholders director. The entire section number 151, you have to reproduce. Imagine that's such an easy thing to do. You just open section number 150 to 151 and write all the provisions in your answer. You will get the marks. Third, if Mr. Brijesh is having a position of small shareholder in 2 companies, is he eligible or not? This you can check in section 151. You will know the answer. Okay, let's look at the answer now. I'm going to briefly go through the answer. You can, of course, read the entire answer yourself also. So what does section 151 exactly say? Section 151 says that for every listed company, the company may have one director to be appointed as the small shareholders. This director, who is a small shareholder, he may be appointed suo motu by the company, or a notice can be given by the small shareholders. This notice has to be given by not less than 1,000 small shareholders or 1/10 of the small shareholders of the company, whichever is lower. This meeting should be given, this notice has to be given at least 14 days before the upcoming meeting. Now, in this notice, details have to be given. What are the details? What is this name of the person who has to be appointed? What is his address? What are the number of shares that he holds in the company? And then who are the people who are proposing to appoint this person as the small shareholders director? Okay. And apart from that, this person who has to be appointed, his DIN also has to be given. We have to check he should not be disqualified under section number 164, and his consent also has to be attached. Now, this person should be an independent director. He should not be disqualified under section number 149, and he will not retire by rotation. His tenure is going to be 3 consecutive years. Then there's going to be a 3-year cooling period. Okay. Now, he will vacate office if there is a disqualification as per section number 164 or under 167 or 149. Okay. Now, in case this particular small shareholders director is a small shareholders director in more than 2 companies, then he will have to vacate one of the companies. That means at the most, he can be a small shareholders director in 2 companies. Okay. All right. So this provision, you will have to nicely write it down along with the section number. Okay. So that will be your answer. And this last point, in case the person is a small shareholders director in 2 companies, then he cannot be a small shareholders director in any other company. Okay, this will also answer the last part of our question. If Mr. Brijesh is already holding the position of small shareholders director in 2 companies, will he be eligible? Can he be appointed as a small shareholders director in this company? Tell me yes or no. Yes or no. Yes or no. Yes. Dheeraj is saying yes. Why is Dheeraj saying yes? If Brijesh is already a small shareholder in 2 other companies, can we appoint him also as a small shareholder here? No. Yeah, correct. So no, he cannot be appointed. Okay. So with this we complete the study material cases 1 to 50. Okay.
Yes. Hello, my dear friends. Very good evening. I believe that I am visible and audible. Please reply. Yes, guys, come on, please reply. Shall I proceed? Good. Thank you so very much. Come on. So I'll share the screen and start the discussion, guys. So friends, first let me talk about an interesting case study. Case study number 16. You can start looking at that, my dear friends. Shananya Limited owns a building A, which is specifically used for the purpose of earning rentals and had been classified as property, plant and equipment in the financial statements. That is basically PPE. Before the applicability of financial reporting framework as per the principles of Indian accounting standard. Company has not been using building A or any of its facilities for its use for a long time. Company is also exploring opportunities to sell the building if it gets a reasonable amount in consideration. Following information is relevant for the building A for the ending 31st March 2023. And please see that, my dear friend, building A was purchased 5 years ago at a cost of 10 crore. So 5 years ago, that building was purchased for 10 crore. And the building life is estimated to be 20 years. And the company follows straight line method of depreciation. Very good. That is what company is following. But I hope you could know very clearly that under income tax law, we cannot follow straight line method. We only follow WDV. That too, we follow something called block of asset. Next slide. During the year, company has invested in another building B with the purpose to hold it for capital appreciation. Property was purchased on 1st April 22 at a cost of 2 crore rupees. And expected life is 40 years. As usual, company is following straight line method for that also. Next. Further, during the year, company has earned or incurred following direct operating expenditure relating to building A and building B. But however, the accountant, instead of capitalizing the same, he has directly debited that to P&L account. Rental income from building A, building B, sales promotion expenses, fees and taxes, ground rent, repairs and maintenance, legal and professional, commission and brokerage. Company does not have any restriction on contractual obligations against property A and B. For complying with the requirement of Ind AS, that's all Ind AS story here. Fair value is computed by DCF and all. Okay. And key inputs for valuation. That's all related to your valuation stuff. Next. Am I audible, my dear friends, totally? Any issues to anyone? Audible, yes. Thank you so very much. Come on. So this is all related to your financial reporting and all. And they received a grant. That is also financial reporting. And financial statement have been prepared for in 2022-2023. Auditor noted the following observation in audit reports. Holding company holds various properties. Fine. Financial statement closure process, requirement of Ind AS. So it's all related to your financial reporting. Next point. Shananya's limited turnover during 2021 and 21-22 was 500 crores and 600 crores respectively. And previous year 22-23 turnover is 800 crores. Net profit as per statement of P&L account for 22-23 is 500 crores. Details of expense debited to statement of P&L account for the year 31st March 23 is as under. Come on, my dear friends, please see that. Depreciation as per Companies Act is 80, but that is not allowed. We'll take depreciation as per income tax. But since that is debited to P&L account, we'll add back that and reduce as per income tax. Next, interest on borrowings from banks not paid up to tax return filing. What is going to happen, my dear friends? As per section 43B, interest on loan taken from a bank, if it is not paid till the due date of return of income, that will be disallowed. I hope you know that, my dear friends. Next slide. Provision for bad and doubtful debts. This also will definitely add back, my dear friends, because the logic is very simple. Income tax law clearly says deduction for provision for bad and doubtful debts is allowed only and only in case of banks or public financial institutions, but not to any person other than banks and all. So who can take is only banks, public financial institution, NBFC and all. Only they can take deduction for provision for bad debts. But any other person, they are not allowed deduction for provision for bad debts. And since it is debited to P&L account, what we'll do is we will add back. Next, corporate social responsibility expenses. This also will add back because I'm sure in previous case studies, we discussed already that CSR expenditure is not allowed as deduction as per section 37(1) because it is not incurred for the purpose of business. Next, expense incurred for services taken from Saurashtra Private Limited, a company registered in Maharashtra region, on which corresponding TDS under 194C has not been deducted. So they are clearly telling the question that TDS is not being done. Friends, tell me, my dear friends, if TDS is not being done, what is going to happen when we talk about payment to non-resident? 100% is disallowed. But when we talk about payment to resident, 30% is disallowed. You might get one doubt, sir, in the question, they didn't tell whether resident or non-resident. But you have to understand by basic logic, they are telling something called 194C. 194C will come only when payment is made to a resident. So what will be disallowed is 30% will be disallowed. Good. Some students have beautifully answered already. Section 40A 1A. Excellent, sir. Next. Bonus paid on 30th April 2023, 3 lakh rupees. Bonus paid on 30th April is how much, my dear friends? 3 lakh rupees. Come on. What is going to happen to that bonus? Is there any problem with that bonus? Allowed. No problem at all. It's a clear-cut business expenditure. Come on, friends. Please reply. Getting the point, everyone. Next. What else? Expenditure incurred on voluntary retirement scheme. Tell me, my dear friends, anyone, any idea what happens to the expenditure incurred voluntary retirement scheme? This point is actually covered by section 35DDA, which clearly says that expenditure is allowed in 5 equal installments. Over a period of 5 years, you will take deduction. And since the entire amount is debited to P&L account, what we'll do is 4/5 we will add back. Because 1/5 is anyways allowed, 4/5 will be added back. Next point. During 22-23, company has not deducted tax at source on the expenditure of 15.73 crores incurred and paid to PQR Limited. So they have not done TDS, my dear friends. Company has collectively deducted taxes or further payment to PQR and deposited the same to the credit of government in financial year. I think there is a problem here. In fact, this has to be 21-22 and this has to be 22-23. That means 21-22 they have not done TDS, but 22-23 they have done the TDS. So if that is the case, what will happen in 22-23? That 30% will be allowed, because in 21-22 30% would have been disallowed. That 30% would have been disallowed in 21-22. That same 30% would be allowed in 22-23, my dear friends. Are we getting clarity on this point, everyone? There's some clerical mistake in the years given in the question, so don't be shocked and surprised. Yeah, students telling they would have paid before filing return of income. No, sir. Where is the question of paying return of income? They have not done TDS at all. See, two situations. If TDS is not done during previous year, 30% is disallowed. If TDS is done in next year only 30% reduction will come. Correct, sir. Yes, very good. Perfect. Thank you. Following information relates to block of asset for 22-23. Let's see. Land, 50 lakhs. Land, there is no question of claiming depreciation. Plant and machinery, 480. Purchase of new asset is nil. Come on, what happens to the plant and machinery, my dear friends? We reclaim depreciation at the rate of 15%. Good. Office building, my dear friends, depreciation out at the rate of 10%. But you have to make a point here. Date. Come on, tell me what is the twist in the question? What is the date of putty use, my dear friends? Come on. The date of use is 15th of February. When it is 15th of February, what is going to happen is we will claim only half of normal depreciation. Next point. Furnitures and fittings. 25th of September. But is 25th September, will I take full or half? Definitely I'll take full. And what is the rate of depreciation for furniture and fittings? Furniture and fitting depreciation rate is 10%, my dear friends. Somebody is telling 15. Answer is no. It is 10%. Next, intangible assets. So let me tell you, intangible asset depreciation rate is 25%. That also I'll take full depreciation. Next. Brought forward business loss as per income tax return for 22-23 is 35 crores. This 35 crores, what we'll do is we'll reduce this brought forward losses from the business income what we'll get. Company's retained earning balance is 1200 crores. Okay, very good. Company is doing well for some time as the company has witnessed a rise in revenue due to its aggressive marketing campaigns. Although revenue has increased since past, but the debtors are also accumulating over a period of time. And most of the clients are related to government sector, which takes a reasonably long period of time to get the payment cleared. And the company is facing liquidity problems due to non-availability of cash. Hence, it has not been able to pay the statutory dues within the time. And as a consequence, company filed a return on 31st December 2023 and paid the due taxes accordingly. So return of income is filed after the due date, my dear friends. Next. The tax audit of the company started in the month of November 23 due to delay on the part of management and was finally signed by the auditor on 20th of January 2024. It may be noted that transfer pricing audit is not applicable. If it is not applicable, the due date to file return of income will be 31st of October and the due date for tax audit will be 30th of September. Getting my point, everybody? Wonderful. Come on, let's see the questions. What they are trying to ask us. First bit, auditor's observation related to audit. If income tax provision at the beginning of the year is so and so, closing balance is how much? That is related purely towards your financial reporting. Simple logic, guys. Take the opening income tax provision, whatever provision you made during the current year and reduce the tax what you have paid. Got it, my dear friends? Next point is related to Ind AS. Fourth bit is related to government grants recognized in books of accounts. Next point, whether Shananya Limited is liable to pay any penalty for failure to furnish tax audit report. 100% answer is yes, my dear friends. Let me tell you, penalty provision with respect to failure to file tax audit report is given by section 271B, which clearly says penalty will be 0.5% of turnover or 1,50,000, whichever is lower. And what is the turnover in this question? Turnover during 22-23. 800 crores, my dear friends. 800 crores, 0.5% will come to 800 crores, right? Into 0.5% will come to 4 crore rupees. So the penalty will be 1,50,000 or 4 crores, whichever is lower. So the answer is definitely 1,50,000. So answer is option A, 1,50,000. Next, descriptive question. Question number 6. What would be the treatment of building A and B in the balance sheet of Shananya? So that's related to your financial reporting. How do we report that investments? Clear? Next part. Compute total income and tax liability of Shananya Limited for assessment year and ignore the provisions of MAT. Very good. Compute the amount of advance tax payable along with the due date for provisions of installment of advance tax. What a brilliant question, guys. Let me start solving. In case of failure to file tax audit report within the due date, penalty provisions are given under section 271B, and penalty shall be 0.5% of turnover or 1.5 lakh, whichever is lower. So in the given case, 0.5% of turnover is 4 crore. Accordingly, penalty payable shall be 1.5 lakhs. That's it. Descriptive questions. Let me talk about question number 7, where they asked computation of total income, my dear friends, and of course the tax liability. Tell me, my dear friends, what is the as per P&L account, which is nothing but 500 crores. Correct, right? To that, what will I add? Come on. Depreciation as per Companies Act. How much is given, my dear friends? 80 crores. Next. Interest on loan taken from bank. This is being disallowed because of section 43B, my dear friends. Next. Provision for bad and doubtful debts. Allowed only in case of bank and NBFC and financial institutions. Only in those cases it is allowed, my dear friends. And what is the figure given in the question? It is 6.20. Moving ahead. CSR expenditure. What's the figure for CSR expenditure? It is 2.5 crores, my dear friends. Clear, everyone? Next. What else is there in the question? Expense incurred for service taken from Maharashtra. Yeah. Payment to Saurashtra where it is not done. Expenses paid to Saurashtra without TDS. What is going to happen is 7 crore they paid. Out of that, 30% will be disallowed. So this will be 2.1 crores. Next, expenditure towards VRS. 450 is disallowed as per section 35 DDA. Because 35 DDA says deduction allowed only in 5 equal installments. And what is the figure they gave in the question? They gave figure as 2.4 crores, my dear friends. So this will be 2.4 into 4 by 5, which is coming to 1.92. So that's the total of all add. Then I'll take total after add. And I'll reduce what, my dear friends? Come on. Payment to PQR Limited in 21-22. 30% disallowed in 21-22. Shall be allowed in 22-23. Since TDS is done in 22-23. And I told you that in the question, there are clerical errors with respect to year which is involved. And the figure is, my dear friends, 15.73 crores into 30%, which is 4.719. I'll take it as 4.72. Okay, then what else? Depreciation as per income tax. We don't know that figure at all. This will be sum of these two. Then the balance figure will be profit as per income tax, which will be this minus this. But this answer is not correct for a simple reason, because we still now don't know the depreciation working. And from that we'll reduce brought forward losses. How much they give the question, my dear friends? Brought forward losses, they give the figure as 35, my dear friends. The balance figure is gross total income. But that figure will change because we have still not entered the depreciation figure. Less deduction under chapter 6A, nothing is given in the question. The balance will become total income. On that total income, we'll compute the tax liability. But before that, we need to compute something called depreciation. Come on, my dear friends, let's do the working for depreciation. Tell me, guys, come on, what all we have got in the question? Depreciation on land, depreciation will be 0. Next, plant and machinery, my dear friends, 15% depreciation. It is 480 given in the question. 480 to 15% is coming to 72, my dear friends. Office building, in the question they told opening is 200 and we purchased another 75 for less than 180 days. You're able to see that, right? You can see there, office building I have opened 200 and 75 for less than 180 days. $275 less than 180 days. So that will be 200 into 10%. Plus 75 into 5%. So it is coming to 23.75. Next. Furniture and fittings. Furniture and fittings opening I have 65. Purchased is 35. Total is 100. Total is 100. And 35 is also put to use for more than 180 days. So I'll directly take 100 into 10%. Next. Intangible assets, that will be 25% depreciation rate. And the figure is opening, I don't have anything, but I have 40 what I have purchased, which is more than 180 days. So my total depreciation works out to 115.75. This figure I'll take there. The moment I take that figure, my dear friends, my total income is changing because that total income what I got earlier was not correct because I have still not yet done that working of depreciation there. Getting clarity, everybody? So the total income will be 440, my dear friends. Student is telling that goodwill is not considered intangible asset. So let me tell you, in case of goodwill, depreciation is not allowed. They have clearly made an amendment a couple of years back where they told intangible assets like patents, copyright, trademark, in all those cases, depreciation is allowed. But on goodwill, there is no question of depreciation. Yeah. How do I compute tax liability, my dear friends? Tax at the rate of 30%. Why will I do 30%? Because turnover during previous year 21-22 exceeds, previous year 21-22 exceeds how much, my dear friends? Exceeds how much? 400 crores. But since it is 440 crores, I'll also add surcharge at the rate of 12%. Total is 147.84. To that, I will add HEC at the rate of 4%. Total, including HEC, is coming to 153.7536. That is the final figure of computation of total income and tax liability, my dear friends. Getting the point, everybody? An interesting question, which makes a lot of meaningful sense. And I'm sure you are very comfortable with this question. I don't think it's a big problematic point at all. Yeah. Apart from this, my dear friends, in descriptive question number 8, they have also asked about something called advanced tax liability. I hope you know that advanced tax due dates are what, my dear friends? Advanced tax due dates are what? Come on, please reply. 15th June, 15th September, 15th December, and 15th March. And what are the percentages, my dear friends? Come on, somebody please tell. 15th June, what is the percentage, my dear friends? 15th June, we have to pay. How much, my dear friends? How much we have to pay? We have to pay 15%. Somebody is telling 5. What's wrong with you, man? Into 15%. Then 15th September, this into 45%. Net payable, you have to pay this. Here you have to pay this minus this. 15th December, you have to pay. By 15th December, you have to pay 75%. That means if you would have already paid this, pay the balance. Next, finally, 15th March, you have to pay 100%. That's it. So this is the net payable figures. 23.06, 43, 46.13, 46.13, and 38.44. That much is what you have to pay on or before the due dates. 15, 45, 75, 100. Student is telling minimum 36, minimum 12, minimum 36. There is nothing called minimum 60, my dear friend. First and second installment only we have got minimum 12 and minimum 36. But that minimum 12, minimum 36 is only for interest under section 234C, but not for calculating advanced tax payable. For 234C purpose, first installment they told in the law, instead of paying 15%, if you pay 12% also, it is okay. Second installment, instead of paying 45%, if you pay 36% also, it is okay. But third installment, you have to pay 75. Wonderful. A very, very, very brilliant and interesting question, my dear friends. I strongly believe that you have got very good clarity on this case study, my dear friends. Yes? Can I comfortably proceed? Definitely. Very good. Thank you so very much.
So next case study will take up is case study number 16. Case study number 16. Shananya Limited owns a building. So something related to property, plant and equipment or investment property would be there. Okay. So all this presentation disclosure part, similar question is there. You can find it in India's 40 as well. So let's jump into the questions directly. What appropriate term of the following would be used in auditor's observation on the analysis of issue regarding investment property in the audit report as per the relevant standard on auditing? Now, there is some issue in the audit report that we have to consider. So let us come back. The company does not have any restrictions against property A and B. Key input for valuations are given below. Fair valuation of property is discounted cash flow basis. One of the manufacturing unit is situated in the remotest area. So there you have, government grant. They have received a government grant. Meanwhile, assume the financial statement have been prepared for the year ending 31st March. Auditor has noted the following observation in its audit report and said observation have been documented after discussion with those charged with government. The holding company owns various immovable properties that have been let out to group companies, third parties for lease periods. India's 40 requires assets to be classified as investment property in case certain conditions are met. This involves significant judgment, estimation with respect to lease term, management intention, basis which assets are classified either a PPE or investment property. We obtained an understanding of the financial statement closure process, including the process of assessment, classification of immovable properties, and preparing of relevant disclosures. We also understood the design, implementation of control. We assessed various lease agreements entered into by the companies. We read the judgments and assumptions made by the management. We assessed the disclosure of investment property made in the consolidated financial statement. So that is what they have given as far as the audit report is concerned. Now, tell me, in which of the following category can be considered this particular, disclosure? What appropriate term of the following would be used for auditor's observation on the analysis of issue regarding investment property as per the relevant standard on auditing? Is it so? Basically, it's a very, because you have handled so many audit reports related question, this will not be difficult at all, right? But still, how do we approach this? Either eliminate it or directly you can write it. Okay, first, is it opinion? It is not opinion. Why is it not opinion? It is not opinion because opinion is not given. Okay, that is one. They have said we have understood. We have got some understanding of the issue and related aspects, right? Then is it key audit matter? It's not also key audit matter because there is no matter which has to be brought to the attention of the users. So key audit matter is also not there. Now, whether it is emphasis of matter or other matter, what do you think? Are we emphasizing the matter? Again, let's come back. They have observed the following observation in the audit report, and this has been documented after discussion with those charged with governance. Means this is an important para. This is an important paragraph because out of the matters that we discussed with those charged with governance, we'll pull out certain matters, and those matters are given as key audit matters. Okay, you will pull out those matters and then you will give it out. So that will be out of key audit matters. Hence, key audit matters is the correct answer. It's not emphasis, it's not other matter. It is something which has come out from those charged with governance, and hence key audit matter paragraph is the one which will be relevant. Okay. Now this is as per SA 701. Income tax provision is out. There are certain carve-outs and significant differences between IFRS and Ind AS. Which of the following statement is correct in reference to Ind AS 40 and IAS 40? Now, one thing, if you have followed Ind AS 40 properly, in Ind AS 40, fair value option is not there. In Ind AS 40, fair value option is not there. We will have to carry it at cost model only. IAS 40 permits cost and fair value. Ind AS 40, no. IAS 40 permits only cost model, no. Ind AS 40 permits only fair value, no. IAS permits both cost model and fair value.
This is the correct answer. Calculate the amount Shananya Limited would recognize in the books of accounts in the first year for the grant received from the Government of India amounting to 35 crores. Now, what have they received? They have received 35 crores. Now, 35 crores we have to recognize based on the expenditure. 20, 40, 70, 120. 20 plus 40, 60. 60 plus 70, 130. 130 plus 20, 250. First year we have to recognize 20 out of 250 multiplied by 35. 35 only, right? They have received 35 crores. So, 20 out of 250 into 35. It is 2.8. See, even without reading all the points in the question, we can get to the answer. That is how you have to play this thing smartly. 2.8 crores, option D is the correct answer. What would be the treatment of building A and building B in the balance sheet of Shananya Limited? Provide detailed disclosures and computations in line with relevant Indian accounting standard. Treat as if you are preparing a separate note or schedule of the given assets in the balance sheet. Now, this question, as I told you, similar question is given as a part of Ind AS 40. So, let's come back. Building A and building B. They own building A, which is specifically used for purpose of earning rentals. So, this is Ind AS 40 investment property. Then the company invested in building B to hold it for capital appreciation. This also is investment property. So both the properties will be shown as investment property. That is a very simple and straightforward case, right? How will we measure it? We'll measure it at cost and we will show it. Now, they want us to prepare a schedule of this investment property. When we have to prepare a schedule of the investment property, we have to see what is the opening balance at gross value, additions during the year, deletions during the year, closing balance. Then depreciation, opening balance, add current year, what is the closing balance and what is the net amount, right? So, building A was purchased 5 years ago at the cost of 10 crores. So, gross value is 10 crores. Life is estimated to be 20 years. So, 0.5 crore depreciation for each year. 5 years ago means 2.5 crores of depreciation we have to charge. For 5 years, current year depreciation 0.5. Building B, 2 crores purchased, life of 40 years. For this also we have to calculate depreciation. So, let us see how do we present it. So, you have to actually show the schedule like we see in the notes to accounts in the case of companies. Same way you have to present it here. So, gross amount, building A 10, addition to 12. 2.5, how 2.5? 10 out of 20 into 5. This is 2.5. Then depreciation during the year 0.5 for building A and 0.05 for building B. So this is the depreciation during the year. This is the net amount. Now, they have also given us amount related to investment property. Rental income, this will go to your P&L. Sales promotion expenses will be taken to expenses. Fees and taxes, ground rent, repairs and maintenance, legal, commission, brokerage, all of these will be shown as expenses. So what you will have to also show is separately for this investment property, income is 1 crore. Expenses, what are the direct expenses? What are the depreciation related expenses? All of that you have to show. And what is the profit? That also you have to show. A very simple thing. Now, another important aspect is you have to disclose the fair value as per Ind AS 40. And you have to also disclose what are the various inputs that you have considered to value the property as per Ind AS 40. What has been the input? Input is expected rent, discount, period, and all of these. These are the inputs. So considering these inputs, we have used which method? Fair value has been computed by the method using discounted cash flow method. So this same question you will find, as I told you, in Ind AS 40, the study material. Same question has been given as a case study, not related to the case, but if you know Ind AS 40 properly, you will be able to handle it well. Okay. So let's see the presentation. Amount recognized in P&L with respect to investment properties, revenue, expenses, depreciation, we have calculated profit. Disclosure. The investment properties consist of A and B. The fair value is 10.5, performed by independent valuers. Valuation recommended by International Valuation Standard Committee. You can take it from the question. And inputs. Use discounted cash flow. This is the inputs and this is the range that has been considered. That is the disclosure required. Right? So with this, we have completed this particular case study number 16. We will need one more session tomorrow to complete a few more case studies. I think 2 more days, Thursday as well as Friday. If it is possible for all of you to join in at 6 o'clock tomorrow, okay, then we can stretch from 6 to 8 and try to complete everything tomorrow itself. Okay. If not, then we'll split it over 2 days. Okay.
Yeah, so we'll start with whoever have joined in. So now, from in this specific week, we'll be taking selected case studies from the case study digest of November 23, which serves as a good base for us to review and recap our approach for approaching the examination, because a lot of case study questions, for example, some of the case study questions which are given in our current new study material, that is the 15 case studies that has been released by ICAI. So if you see in that, what we could observe is a lot of case studies are from case study digest. Okay, so they have taken, so for example, the case study of ABCD Textile, Luminous, Solar, Murali, all of these are they have taken from case study digest of November 23 of our elective paper. And also after that, the suggested answers, the questions from May 23 and November 23 examination were also given as your new study material questions. So that is why we would be considering that also as our base when we are discussing. Okay. So I'll turn off my, but if I turn off, do you feel some lag today also? Like last time, what you have complained that there was a lag. Is there any lag from my end? Just a moment. I'll change something. So I think it should be better now. I've done some changes. So as I was discussing, there have been cases where the previous case studies have been given as a part of new study material. So that serves a good base for us. This file is provided to you in the note section of the course. So you can access it from there subsequently, and you can refer to that as well. Right. So what we'll be doing is this week, we will be taking up some selected case studies from the case study digest of November 23. Okay, so we'll be taking up case study number 17, 18, 17 onwards, some selected case studies, and subsequently we'll come back to case study 1 and 2 by respective faculties. So today we'll be starting with case study number 17. Yeah. So we'll be starting with case study number 17, that is dealing with Shivani, who is a newly qualified chartered accountant, and she has done certain aspects. So again, as we have been doing this pattern previously, we will be first looking at the question and then coming back. Before that, we will quickly have a look at the starting and the ending part of the paragraph. So Shivani is a newly qualified CA. After qualification, interest was in consultancy. So she wanted to take consultancy firm. Then towards the end, they're saying, issuing Form 16A, ABC is paying 40,000 per month to Shivani, something related to her consultancy background. Then, after gaining exposure across various areas, she was assigned statutory audit in another assignment. So that is what it says. So here you can see they're talking about UBA Private Limited, which is a subsidiary of MAR Limited. MAR Limited is listed on the stock exchange, and statutory audit of MAR Limited are XYZ, one of the top rated firms of the region. Okay, so that is the next aspect. Then finance team of UBA Private Limited is unaware of the changes and latest development in the field of accounting standards. So this is one very odd, example I find, especially with the institutes, right? The finance team, how can they not be aware of what are the latest changes? Okay, but that is just to build up the thing. Then they talked about register office shifted to complex beginning of the year. Then they're paying rent 80,000 per month, and related aspects have been given. Then information about employee benefit is given. Was presented certain material liabilities as non-current in its financial statements for a period up to 31st March. Then, so there is something about certain material liabilities as non-current. And then you see, while preparing annual financial statements, they discovered that these liabilities should have been classified as current. So there is a error on that part. So 3 aspects related to FR is covered here. Then after the completion of audit, XYZ has asked ABC to bring to the principal auditor's immediate attention any significant findings requiring to be dealt with at entity level. And further, XYZ has asked for detailed questionnaire from ABC for the information on those matters which require special attention. Now, we'll come back to the question. It says after completion of the audit, Messrs. XYZ has asked Messrs. ABC. If we come back, ABC is the consultancy firm. Shivani was assigned the statutory audit in another assignment. The company to be audited is ABA. Subsidiary of MAR. MAR is listed. Statutory audit of MAR is XYZ. So here if you see the relationship, UBA Private Limited will be audited by Shivani, the consultancy firm is ABC, and MAR Limited is listed, whose auditor is XYZ. So there you have another auditor, and we need to see what is the relationship of that if there is a question on this. Then after completion the assignment of UBA, Shivani has assumed a role back in office. One of the paid assistants of the consultancy firm has sought the help of Shivani to complete draft notice to be presented before AGM. So here, this is a law related part which we will be discussing in law. So there is notices for the board meetings and all of those things. Then at the end of 22-23, Shivani has to file a return of income. Since she has not filed her own return of income in the past, she wants to corroborate it from her firm's partner regarding the selection of appropriate return of income to file for her income received from the consultancy firm, as she is not interested in presumptive income scheme. So this is about return filing. Shivani files a return of income for her sister each year. A lot of you might also be doing filing returns of your relatives and friends. So that they have given basic salary, DNS allowance, and all of those things. Then during the year, Reena, who is Reena? I think this sister itself is Reena, right? So they have houses and all of those things. So they have given a lot of information. So if you see in this case study, there is a question about a chartered accountant. That chartered accountant is working, in some consultancy firm carrying out audit. There is some problem in that company regarding classification and all. And then they have moved to the personal life where they are handling income tax returns, all of those aspects. Right? Reena has asked her sister Shivani to help her income and all of those things. So that is the background of the case. Now coming to the specific MCQs like we have been doing. First one deals with Companies Act. Again, related to Companies Act. Now for this forms, we already have given you the list. So you can have a look at the list if at all you are confused in the examination. Then again, Companies Act, income tax return. Then comes the question on Ind AS. How much amount of expense income for employee benefits UBA Private Limited is required to recognize in the other comprehensive income section of its financial ignored deferred taxation. So this is to do with Ind AS 19. How much of expense or income for employee benefits UBA Private Limited is required to recognize in OCI. So let us come back to the plan. So here if you see, the UBA Private Limited has following information about employee benefits. Contribution by employees during the year 75,000. Benefits paid during the year 50,000. So benefit when they are paid, so we have something called as plan assets and plan liabilities, or liabilities just if you can consider. If benefits are paid, your assets are also reduced, liabilities are also reduced. Fair value of plan assets at the beginning of the year 2 lakhs. Return expected on plan assets 20,000. Fair value of plan assets at the end of the year 2,50,000. So with this information we have to calculate. Now before that I will just take you quickly through a couple of aspects related to Ind AS 19 that we need to be aware of. So when it comes to Ind AS 19 calculation for long-term benefit plan, I want you to have a specific look at a table which will help you to calculate. One is closing liability or closing liability of defined benefit obligation. So the way you have to see is opening balance. This is a liability of the defined benefit obligation. Current service cost increases. Current service cost increases the liability. Interest cost also increases the liability. Past service cost may increase or decrease the liability. Then actual losses. Then actual losses, actual gains, benefit payment will reduce the liability, gain on settlement will reduce the liability, loss on settlement will increase the liability. So this is how you calculate defined benefit obligations, right? Then actual gains or losses are changes in the present value of the defined benefit obligation resulting from experience adjustment and effects of changes in actual assumption. So whatever we had thought, okay, this will be our actual assumption, and earlier we had done certain assumption. Now, if we are changing them because of the experience adjustment, earlier we assumed something, now we are assuming something else. Because of that, if something happens, that we will capture in actual gains and losses, right? That is one. Then this part, on the net liability part, you will calculate. So you'll take the opening balance, add the current service cost. So current service cost increases the net liability. Past service cost also increases the net liability. Net finance cost, loss on settlement, less gain on settlement. Then what is the expected closing balance? What is the actual closing balance? And the difference becomes gain or loss. So like this, you have to calculate the obligations part, asset part, arrive at the closing balance, and if at all there is some gain or loss which needs to be recognized, we need to recognize that in the financial statements when it comes to Ind AS 19. Okay. Now, the question that has been given to us is, if I come back, how much of expense or income for employee benefits UBA Private Limited is required to recognize in OCI? So they have not asked us about income statement. They have not asked us about income statement. What they have asked us is about the other comprehensive income. Now, in other comprehensive income, you will not take current service cost or past service cost and all of that. You will take anything which comes from, let us say, actual gains or losses, or if there is something related to remeasurement, that is what is taken to the actual gains or losses. Now, let us see what or how do we calculate this. Now, for this, what you have to do is, they have given us asset balances. They have given us asset balance at beginning of the year. They have given us asset balance at the end of the year. They have given us some movement during the year. With this, we have to see what is the expected return or difference between expected return and actual return, or what is the balancing figure in this particular aspect, right? And that part has to be taken to the other comprehensive income. So what we do is, you can do it in two ways. One is prepare a T-shaped table. Okay. When you prepare this T-shaped table, this is my asset account. So in my asset account, what will I do? I will take the opening balance. So opening balance is 2 lakhs. Okay. And see, this is an MCQ question, so you don't need to give a detailed working also. Okay. Then on this, there is a contribution of 75,000. Now contribution will increase my plan asset. If I'm contributing something to plan asset, it will increase my plan asset. So I will add 75,000 of contribution. This is the first part. Then benefits paid. If I pay something from the plan asset, my asset balance will reduce. So I'll post it on the credit side, 80,000. Then return expected. Returns will increase my plan asset. So 20,000. Then fair value of plan asset at the end of the year, closing balance 2,50,000. Okay. Now, if I do the total here, 3,30,000. This side, if I do 2 lakhs. 2 lakhs, 275 and 20, 2,95,000. Okay, so this becomes 2,95,000. This is 3,30,000. So 3,30,000 minus 2,95,000 if I do, 330 minus 295 if I do, I get 35,000. Okay, so 35,000, which option does it match with? $35,000, we have actual gain, we have actual losses. So the question is whether it is a gain or loss. Again, for that you have to come back in the question or in the working what we have done. Debit side, credit side is more. Credit side is higher. Okay, which means my pencil has gone dead, so that's why I'm not able to highlight this. Just bear with me for a moment. Credit side is higher means there is something which I have to post it on the debit side, which means I have to increase my asset balance. If I have to increase my asset balance, it becomes my gain. So in this case, there is a gain of 35,000. So option A is the correct one. Option A, actual gain of 35,000 is the correct answer. Okay. Now, please understand, the actual gains or losses or remeasurement related aspects, they are recognized in OCI. They are not recognized in income statement. So the last part that you see, all expense and income related to employee benefits are to be recognized in profit before taxation. That is correct. Okay. So just give me a minute. I'll get the pencil charged and we can continue after that. So the same thing, you can also do it using the statement format. You can prepare the statement, opening balance of plan asset, add contribution, add expected return, and all of that. And whatever is the balance in figure, see, if my asset balance is lower and if I have to increase the asset balance, it is a gain. Otherwise, it is a loss. Okay. So that is as far as the first part is concerned. Then moving on. Yeah. So there was an issue with the pencil. Just a moment. Okay. Moving on, next one. Would the classification of liabilities from non-current to current in the comparative amounts be considered to be correction of an error? Would the entity UBA Private Limited need to present a third balance sheet? Support your answer with reference to relevant Ind AS. Now, whenever there is an error, the applicable Ind AS is Ind AS 8. As per Ind AS 8, if there is any error, if there is any material error which needs to be rectified, and see, error can be because of recognition issues, error can be because of measurement issues, error can be because of disclosure issues, anything. If there is any material error, then we need to rectify that error. It has to be a retrospective rectification. That is the first thing. Okay. Second thing is, whenever you are rectifying an error, as per Ind AS 8, we need to present 3 balance sheets. So what happens is, so if you come back, what happened? Let us just quickly see the error part. UBA Private Limited has presented certain material liabilities as non-current in its financial statements for periods up to 31st March 22. In the current year, they have realized. So in 31st March of 23, they are correcting it. In 31st March of 22, it was wrong. This also needs to be corrected. Okay, this also needs to be corrected. And then whenever you do a corrections, you have to prepare 3 balance sheet. You have to prepare the third balance sheet as on 1st of April of 21. This third balance sheet also must be presented, right? So if there is any error because of recognition issues, measurement issues, or presentation issues, then we have to rectify them. If there are any material errors, now here if you see, they have said these liabilities, material liabilities. So if it is material, it has to be rectified. Okay. Now, when the material error is rectified, what you have to do? You have to rectify in the 31st March 23 balance sheet. That is first thing. Then you have to restate 31st March 22 balance sheet. And then you have to present a third balance sheet. Now, the third balance sheet requirement is as per Ind AS 1. As required by Ind AS 1, you have to present the third balance sheet. Okay. Now, third balance sheet is with date beginning of the previous period, that is 1st of April of 21. So you have 1st of April of 21, 31st March of 22, and 31st March of 23. 3 balance sheets have to be prepared. So the way you have to understand this is, I'm repeating once again, 31st March 23 is the current period balance sheet. So here you have to present the correct picture as current liabilities. I think current only. Current. Then as on 31st March 22, the previous comparative balance sheet, you had presented non-current, which was wrong. Now you have to correct that also. And beginning of the financial year. What is beginning of the financial year? Beginning of the financial year is 1st of April of 21. On this date, you have to present the third balance sheet. So this thing you have to keep in mind, right? Then moving on to the next one. How UBA Private Limited is required to account for the security deposit in its books of accounts for the rent agreement made between it and the complex owner. Past journal entries for the entire duration of security deposit since inception. Now, this question has been lifted directly from Ind AS 116, read with Ind AS 109. So it is actually a question of Ind AS 109. Okay, where you have to see how do you account for only security deposit. So not a 116 question related to 116, but you will apply the principles of Ind AS 109 as far as the accounting and recording part of it is concerned, right? So what is the question? Let us go back. The registered office of UBA Private Limited has been shifted to a complex at the beginning of the year, which is taken on rent from complex owner at 80,000 per month. As per the rent agreement, company is also required to deposit amount of 1 lakh as security to the landlord. However, the landlord would not pay any interest on the said amount of security. This clause has been added in the rent agreement. Duration for which the agreement has been entered in between the company and the landlord is for 3 years. Repayment of principal amount as well would be at the end of the 3rd year. Interest rate for similar deposit in market is 12%. Accountant of company initially recognized the security amount of 1 lakh as deposit in the liabilities. At the end of the year, its carrying value is standing at 1 lakh. So this is what they have done. Now, as per Ind AS 109, we know. So for the company, what you have to understand, for UBA Private Limited, they have shifted to a new complex, which is taken on rent from the complex owner at 80,000 per month. And the company is also required to deposit an amount of 1 lakh, and they have deposited that amount of 1 lakh. Okay. Now, surprisingly, if you see in this question, they have said accountant of the company has recognized this deposit in the liability. First thing, if you deposit some amount with another entity, that an amount should not be recognized as a liability. See, I am depositing. If I am depositing something, that deposit is not a liability. That deposit is my asset. So I think there's a drafting error in the question, or you have to make a note saying that it is not a deposit, it is not should to be shown as a liability, it has to be shown as an asset. That's the first thing. Second thing is, as per Ind AS 109, this asset, whatever I have, 1 lakh of deposit of asset, this does not give me any interest. So what I have to do is, I have to consider 12% discount rate and calculate the present value. And whatever is the present value, that I have to consider as my, present value, that is the amount of security deposit which I should consider. Okay. So then what about, how do we handle the difference? So generally what will happen is, In such cases, first you will calculate present value of 1 lakh at 12% for 3 years. So how do you do that? You can do 1 lakh divided by 1.12 to the power of 3. If some of you are confused with the formula, future value is equal to present value into 1 plus r to the power of n. So present value will be future value divided by 1 plus r to the power of n. So basically what we are saying is, we are at year 0. After 3 years, we will get back 1 lakh. What is the present value of that? Only that part should be my asset. The remaining part should be considered as lease payments. Lease payments, or it should be considered as a part of my lease accounting. Okay. So now 1 lakh divided by 1.12 to the power of 3 if you have to do. So 1 lakh divided by 1.12 to the power of 3 if I do, we get 71,178. 71,178. Only this amount is my asset. So on day 1, I will say my asset security deposit is 71,178. I will credit bank by 1 lakh. Balance amount, whatever is done. See, they have asked us only deposit treatment. Balance amount, whatever is there, whatever we have paid, okay, that whatever amount that has been paid along with this deposit, that will be your part of your lease payment or your rent expenses. Of course, because it is a lease, you will recognize a right of use asset and all of those things. It will be treated as a lease payment related aspect as far as the difference is concerned. So 1 lakh minus 71,178, 2, then 8, 2. This will be my deferred expenses. Or you can treat as if I have paid rent in advance, or I have paid rent, I have made rental payments in advance. That is how it will be considered. Okay. Now let us look at the accounting part of this. Security deposit amount 1 lakh. You will not get anything back. You will not receive any interest. 3 years at 12%. If you do, we have calculated this 71,178. So security deposit initially will be measured at fair value. So security deposit debit 71,178, deferred rent or lease payments 28,822, to bank 1 lakh. Now what will happen is, on the 71,178, you will prepare an interest schedule. 71,178. What you will do is, you will take year, opening balance, interest at 12%, closing balance. Okay. Now, first year opening balance is 71,178. Interest at 12%, 71,178 into 12%. If you do, you get 71,178 into 12%. If you do, we get 8,541. 8,541. Closing balance is 71,178 plus 8,541, 79,719. Okay. Second year, you will take 79,719. 79,719 into 12%. You get 9,566. Right. Same way for the third year. Not here. 9,566. Same way for the third year also, you will calculate. Okay. So first year income, security deposit in the balance sheet 8,541. You will increase your security deposit amount and you will recognize the interest income to the extent of 8,541. Second year interest income will be 9,566 and you will credit the same to the P&L account or the interest income 9,566. Same way third year you will calculate 10715, 10715. That is how it will be calculated. Okay. Then the excess amount that you have paid, you can spread it over the life of the term and book the rental expenses. Okay. And at the end of the third year, when you receive back the deposit, it is bank account debit to security deposit 1 lakh. Now here in this question, if we check the question, the question has only talked about the entire duration of security deposit. So you can pass security deposit plus whatever is the incremental component related to the rental expenses, that also can be treated. Now here what you have to understand is the treatment that we are giving is 1 lakh if I am getting after 3 years, that 1 lakh what I get after 3 years is not the same as 1 lakh that I have given today. So the difference component, whatever I have paid, that should be recognized as my expense over the period of 3 years. Correspondingly, equal amount of income will be recognized as well. So that is how Ind AS 109 works. And similar things you can see in case of concessional interest loan to the employees. So in those things also you have the case study. So what you can do is you can do that question also. So one is treatment of security deposit, then you have loan to subsidiary, which is interest free. This also you should revise. Then if you give concessional rent, concessional loan to employees, that also should be considered, right? So these are the aspects which can be tested in the examination as far as financial instruments are concerned, right? Then the next part, how should Messrs. XYZ Chartered Accountants indicate in its report for responsibilities of their work and Messrs. ABC Chartered Accountants work in the course of the audit, so that the stakeholders could clearly differentiate for the respective defined roles? Provide your answer with relevant lines of standards on auditing, which Messrs. XYZ has to consider while drafting the report for aforementioned matter. Now, if you see who is XYZ, after gaining, so that is fine. The company to be audited is UBA Private Limited. So you have UBA Private Limited, who is being audited by XYZ. You have the parent company, MAR Limited, MAR Limited, right? MAR Limited. UBA is audited by ABC. See, we also tend to get confused. And MAR Limited will be audited by XYZ. Now, MAR is the parent entity. MAR is the parent company, parent entity. UBA is the subsidiary entity. So when MAR prepares the consolidated financial statements, then please understand they have to use, or they are using, the work of another auditor. Okay, it is not a joint audit. This is the work of another auditor, and you are using the work of another auditor. For example, the auditor of a branch or auditor of a subsidiary or the auditor of a division, that we call as the component. Now, in March financial statement, UBA financial statements will be incorporated, and XYZ is making a report on March. Now, what does XYZ ask? After the completion of audit, XYZ has asked ABC to bring to the principal auditors, principal auditor is XYZ, immediate attention to any significant findings requiring to be dealt with at the entity level, and XYZ has asked for a detailed questionnaire from ABC for the information on these matters which require special attention. So it is the case of a principal auditor and other auditor, or the auditor of the component. And principal auditor, whatever work he's using of the component auditor, he will not be responsible for the subsidiary's audit, because subsidiary has been audited by another chartered accountant, and the principal auditor can rely on the work. So whatever work that has been given to the other auditor or the subsidiary auditor, principal auditor is not responsible. Okay. Now, whenever XYZ is preparing, its audit report, they have to clearly mention that this audit report or this financial statement includes the financial statements of a subsidiary, and there is a clear division of responsibility. There are other auditors, and we have to clearly say that these subsidiary or this amount of assets or this amount of liabilities or this amount of financial information or these number of subsidiaries have been audited by other auditor. That has to be clearly stated in the audit report. And principal auditor is responsible for his work. Of course, if there is any doubt, if there is any professional skepticism, then they will also be responsible for subsidiaries report as well, if that all there is any suspicion. Okay, so the question here is, how should they indicate in its report responsibility of their work and ABC? So they have to clearly say, we have audited Mars Limited. We have audited the consolidated financial statement. This includes one subsidiary called, what was the name? UA. This includes one, UA only, right? UBA, sorry. This includes the subsidiary called you don't mention the name of the subsidiary. This includes one subsidiary, and it includes financial information which has been audited by another auditor. Okay, so that is how you have to mention. And if at all there is a suspicion, then of course the principal auditor will also be liable. Now, one more aspect here which can be tested, which is that whether working papers can be asked. So who has the ownership of working paper? Can I ask the working papers? So we can say working papers are owned by the component auditor, right? So that is one more aspect. We can get information, but can we get working papers or not? That is one thing. Then confidentiality related aspects that can be tested. Of course, principal auditor, when they is reporting on the consolidated financial statement, they will also have, or they will need to have access to the other auditor work as well. So SS 600 using the work of another auditor is applicable. The provisions regarding division of responsibility between principal auditor and other auditor, as mentioned in SS 600, are as follows. Principal auditor would not be responsible in respect of work entrusted to other auditors, except in circumstances which would have aroused suspicion. When principal auditor has to base his opinion on the financial information of the entity as a whole, relying upon the statements and other reports of other auditors, his report should clearly state the division of responsibility for the financial information of the entity by indicating the extent to which financial information of components audited by other auditors have been included in the financial information of the entity. That is, number of division, branches, subsidiaries, components audited by other auditors, including the value of assets, liabilities, revenue, and all of those things. Okay. Sometimes what happens is the component may not be audited. So that also has to be disclosed, saying that this component we have not audited, or this number of subsidiaries accounting for so much of value has not been audited. Okay. The next question is on income tax, which will be covered subsequently. Pretty long. I don't expect such a long question, but still.
So next we move on to case study number 17. Case study number 17. Now, case study number 17, again, let's read one by one the MCQs that are available with us. Okay. So MCQ 1, 2, and 3 of case study 17 are related to company law. So we are going to read them. Okay. So as per which section of the Companies Act corresponding to companies audit and auditors rules, the company is required to pass a resolution at the meeting to remove the auditor from his office as an auditor. This is so simple. So simple. It just says, please quote this section. You have to find out the section. Let's say you don't know, the Companies Act has got 470 sections. You don't know where to find this section. They have given a hint also. See, companies audit and auditors rules. We know that rules are always related to chapters. So audit and auditors rules is relating to chapter 10, audit and auditors. So that means chapter 10, audit and auditors of the Companies Act. That is our relevant chapter here. Then again, here we have to find the section relating to removing the auditor. So in chapter number 10, relating to audit and auditor, find the section relating to removing the auditor. Accordingly, we'll have to select the correct option. So here I'll tell you the section is section number 140. So that means here option A or option C is correct. Okay, but to have further details, we have to read this section also just to be more clear so that we can select the correct option, A or C. Sikandar has already given the answer and correctly answered also, but we are still going to look at section number 140 for reference. So section number 140 talks about removal, resignation of the auditor by giving special notice. Only the related part I'm talking about. In order to remove the auditor before the expiry of the term, the company should take a special resolution, and before that, the company has to take previous approval of the central government. Okay, so first previous approval of the central government, then special resolution has to be taken. If you want to be more specific, then we can say that, see, first of all, board resolution will be taken. After board resolution, we'll be making an application to the central government within 30 days of the board resolution. This I'm reading just the underneath point which I've mentioned here. So after board resolution, within 30 days, an application has to be filed to the central government in form ADT2 form. Okay, and after that, in the next 60 days, special resolution has to be passed in a general meeting. This is the required procedure that has to be followed if we want to remove the auditor before the term. Now, accordingly, let's select the correct option. Let's read the first option. Section 141 of the Companies Act, read with rule number 7 and subject to the approval of the company at the general meeting, auditor of the company to be removed from his office as the auditor. So this is the option, this is A option. Option B, we are not even reading because section 139 is incorrect. Option C, let's read. Section 141 of the Companies Act, read with rule number 7, subject to approval of the company in the general meeting with corresponding previous approval of the central government, the auditor can be removed. So which is more accurate, A or C? Which is more accurate, A or C? A or C? C is more accurate because here we are talking about central government also, and we're talking about special resolution also. A, we are only talking about general meeting resolution, right? So this is half, not full. C is more accurate. So C is correct. Last option also, just for the sake of being more accurate, we can read it. No requirement to pass any resolutions to remove the auditor. This is incorrect. Okay. Let's move on. Question number 2. Question number 2 is also exactly relating to this provision. So we'll read and we'll try to solve. Okay. For which appropriate authority the company is required to sign E-form for making an application for approval to remove the auditor of the company under the Companies Act? Provide your answer with reference to notice 2. Okay, so here basically it's saying to which appropriate authority we have to send an application to remove the auditor, and then also what is this application to the auditor. So here again we're talking about section number 140 only. Just now we discussed removal of the auditor. To remove the auditor, first of all, board of directors will have to pass the resolution. Then within 30 days, they will have to file ADT2 form to the central government to get the approval. After that, in 60 days, special resolution has to be filed in a general meeting. So here, what are we talking about? We're talking about ADT2 form with the central government. That's the form that's required to be passed, to be filed, an application. Which authority? Central government. Right? Now here, there's a reference given to notice 2 also. So we can, if you want, we can just refer that notice also. Notice 1, notice 2. So what is this notice 2? Notice 2, the board resolves that in accordance with, okay, so this is a board resolution. Whenever this kind of language, further resolved that, the board resolves that. So this is basically a board resolution. Okay. If you want, you can give it a read. I'll just read the first 3 lines so that we have a reference, like we just have a context to what this is. The board resolves that accordance with section this of the Companies Act and subject to the approval of this, Mr. This, the chartered accountant, the auditor of the company, be removed. Be removed. So what is the section? As per which section? As per section number 140. With the approval of who? With the approval of, subject to the approval of central government. Okay. Accordingly, this Mr. Mrs. TRP is going to be removed. Got it? So let's select the correct option here. Option A, company is required to digitally sign e-form ADT1. No, it is incorrect. ADT1 is not our form. Here also ADT1 not our form. ADT2 is the correct form. So let's read this point. Company is required to digitally sign ADT2 form for making application to the registrar of companies for approval for the removal of the auditor. Next, company is required to digitally sign e-form ADT2 for making an application to the central government for approval for the removal of the auditor. So what is the correct option? C or D? Central government or registrar of companies? Both are same or what? No. Registrar of companies is separate authority. Central government is separate authority, and central government is relevant for us here. So D is our correct answer. Okay. Let's move on. Okay, so now we'll talk about MCQ 3, right? Under which section of the Companies Act? Again, which section? So they're directly asking us section number. The members are required to pass the resolution in the general meeting held on 30th September for the nature of business and agenda mentioned in notice 1. Okay. So we have to read notice 1. And then this notice 1 is covered under which section we have to find out. Let's say you don't know. Let's say you read notice number 1, you don't understand where is this coming from. Then directly just check these sections. Section 186, 180, 179 and 185. Randomly just keep checking these sections. One of them will be applicable. Okay. So we'll read notice number 1. Okay, notice number 1, that pursuant to the provisions of dash, this is what we have to find out, and in supersession of the dash resolution. 1 second. Just give me a second now. Okay. Some notification popped on my screen, so that's why. Okay. That pursuant to the provisions of section dash and in supersession of the dash passed by the members in the general meeting on 30th September 2022, the company hereby accords its consent to the board of directors, borrowing from time to time all such sums of money as it may deem requisite or proper for the purpose of the business of the company, notwithstanding that the money is to be borrowed together with the monies already borrowed by the company exceeds the aggregate of the paid up share capital of the company and its free reserves. That is to say, the reserves not set part of this. So here, if you want, you can read the whole thing, but just by reading this much also, what we can think about is that here members are giving resolution, and through the resolution they are giving the power to the board of directors to borrow the money as they require, more than exceeding the paid up share capital of the company and the free reserves. Okay, so here the board of directors are getting the power to borrow more than the paid up share capital and free reserves. Does this ring a bell? Like, is this, have you seen it somewhere? Okay, so just by this much information, we can find out which section is it. So if you want, you can randomly just go ahead and check section 186, 180, 179 or 185. But directly, if I tell you, we have to see 180 section talks about the powers of the board. Certain powers of the board that can be exercised only by special resolution. So that is the relevant section here. Okay. Section 180, it says that board can exercise certain powers only after they take a consent from the general meeting by passing special resolution. Subsection 1, subsection C says that if the company wants to borrow money more than the paid up share capital, free reserves and security premium, then they will have to take a special resolution. So that is exactly what is happening here. The company is borrowing money and the total borrowings is more than paid up share capital and free reserves. So accordingly, a special resolution is passed. So this is covered in your section number 180. Okay, so your correct answer here is going to be B, which is section 180. Okay, is this clear? So we have covered this one case study also. Do you have the stamina to do one more case study? Can we do one more case study? Yes or no? Yes, yes. Okay, very good. So we'll take up one more case study. Okay.
Hello, my dear friends. Very good evening. I hope I'm visible and audible. Please confirm. Thank you very much. Come on. So shall we start the discussion, my dear friends? Can I proceed to share the screen and we'll start the discussion? So let me start the discussion, my dear friends. Yeah, so my dear students, I hope the screen is visible and you're able to see the case study number 17. So from today onwards, next 4 to 5 sessions, it will be completely about taxation and we'll discuss a lot of interesting elements of taxation, especially related to direct tax and indirect taxes. A lot of special points will cover. And I'm sure that we are ready. Next 4 or 5 session, it's all about tax. Can I proceed? Please confirm. Yes, thank you very much. So friends, now please look at case study number 17, my dear friends. An interesting case study which has got some good concept of taxation. So please see that. Shivani is a newly qualified chartered accountant. After qualification, her interest was in consultancy. And so she decided to first gain exposure in consultancy firms and thereafter start her own practice. Very good. So she wanted to do job first and after that she wanted to get into her own practice. She has been approached by one of the consultancy firm ABC to work for it. And the ABC has also provided a flexibility to Shivani by allowing her to do her own independent assignments. So sweet of them. Next slide, you see. If she's able to grab it over a period of time. Next. ABC is showing Shivani as the consultant of the firm instead of being an employee. First of all, we know very clearly that whenever there is an employer-employee relationship, whatever income the employee gets will tax under salaries. But if there is no employer-employee relationship, then whatever consultancy income the person gets, it will be regarded as a business income. Let me give a small example. In the case of Shivateja, when Shivateja is providing services to IndigoLearn, while making payment to Shivateja, they do TDS under one section known as 194J, payment for professional services. So they do TDS under section 194J. So when they are doing TDS under section 194J, whatever consultancy income Shivateja is getting from IndigoLearn is obviously a business income for Shivateja. Do you all agree to that? Good. Next. Initially, the consulting firm ABC is paying 40,000 per month to Shivani and issuing Form 16A to her on regular basis. And let me make you understand one point here. Practically, there is something called TDS certificate in Form 16 and Form 16A. Form 16 is in case of salaries and Form 16A is in case of other than salaries. Next slide. After gaining exposure across various areas, Shivani was assigned a statutory audit in another assignment. The company to be audited is UBA Private Limited, which is subsidiary of its parent company, namely MAR Limited. And MAR Limited is listed on the stock exchange. The statutory auditors of MAR are XYZ, which is one of the top rated firms of the region. As the finance team of UBA Private Limited is unaware of the changes and latest developments in the field of accounting standards, they seek the guidance from Shivani for few matters for preparations of financials of UBA Private Limited as per the applicable financial reporting framework. Next. The registered office of UBA Private Limited has been shifted to a complex at the beginning of the year, which is taken on rent from the complex owner at a rent of 80,000 per month. So what is the rent that is being paid, my dear friends? The rent is 80,000 per month. Next. As per the rent agreement, company is also required to deposit amount of 1 lakh rupees as security to the landlord. That is very clearly a security deposit which is being paid. However, landlord would not pay any interest on the said amount of security. That means it is a interest-free security deposit. This clause has also been added in the rental agreement. The duration for which the agreement has been entered into between the company and landlord is for a period of 3 years. And the repayment of principal amount as well would be at the end of 3rd year. So at the end of 3rd year, principal amount also will be repaid. The interest rate for similar deposit in the market is 12%, my dear friends. And the accountant to the company initially recognized the security amount as deposit. At the end of the year also, its carrying value is standing as 1 lakh. That's in your accounting related adjustments related to your financial reporting. Next point. UBA Private Limited has provided following information about employee benefits. That's purely related to your accounting standard, Ind AS. Next. They have presented certain material liabilities as non-current. That is also related to your financial reporting. Next line. After completion of audit, they have asked ABC to bring principal auditor's immediate attention about significant findings. That's related to your audit. Then the provisions of so-and-so directors are making some borrowings and the loan shall not exceed 30 crores. That's also related to your corporate loss. And the board resolves in accordance with section so-and-so, TPR shall be removed from his office as auditor. Extraordinary general meeting is conducted and Amit Saxena is authorized to issue notice for EGM. Fine. Resolve further that Amit Saxena, secretary of the company, is authorized to inform the auditor of the decision of the board. Fine. Fine. This is also related to corporate loss. Next point. Now comes the real picture. Please see that. At the end of financial year 2022-23, Shivani has to file her return of income. Since she has not filed her own return of income in the past, she wants to corroborate it from her firm's partner regarding the selection of appropriate return of income to file. So basically, she's having a doubt which form to be used for her income received from consultancy firm ABC, as she is not interested in presumptive income scheme. I hope you all know this. You would have seen in articleship also, my dear friends, that in case of presumptive income, we file one form known as ITR 4. But if we do not want to go to presumptive income, in case of individual, we have got ITR 1, 2, and 3. 1 is in case of salary income, income from one house property, and total income is not more than 50 lakhs. ITR 2 is in case of any income but other than business or profession. But if a person has got business or profession income, then he has to file ITR 3. Now, in this case, my dear friends, Shivani, she is getting what income? She is getting consultancy income, which is nothing but in the nature of business income. So obviously, for that reason, my dear friends, Shivani has to file which form? Shivani has to file ITR 3, my dear friends. Assume that Shivani has not been able to receive any other source of income. So she has got only consultancy income and she obviously have to file ITR 3 because it is clearly a business income. Yeah, thank you. Next slide. Shivani files a return of income of her sister each year. She is filing a return of income of her sister every year, my dear friends. And this year too, as the deadline to file income tax return approaches, Shivani was called by Reena to file it within the due date. The particulars regarding the income and other information of her married sister, who is 35 years old and currently employed in MNC in Delhi, is as follows. Let's see what income she's having. She's having basic salary 6 lakh, DA 2 lakhs, HRA 4 lakhs, and she's paying 25,000 per month as rent to landlord. I hope most of you guys already know that in case of HRA, we have got some exemption given by section 1013A. And 1013A gives exemption in case of HRA, in case where employee stays in rented house and he pays rent. He can take exemption for HRA. And exemption point clearly says exemption is least of the following 3. Number 1, actual HRA received. Number 2, rent paid minus 10% of salary. Number 3, 50% of salary if house is in Delhi, Mumbai, Chennai, Kolkata, 40% of salary in other places. But in this case, my dear friends, he is in Delhi. Since she is employed in Delhi, we'll take it as 50% of salary. A student is telling 25. What is that 25, my dear friends? HRA is given by 1013A, and the limits are actual HRA received, rent paid minus 10% of salary, and the third limit is 50% of salary. If house is in Delhi, Mumbai, Chennai, Kolkata, any other place, 40% of salary. I think student is talking about deduction chapter. My dear friend, let me tell you, that is given by 80GG, rent paid. And that story will come only to those person who is not in receipt of HRA. If he is in receipt of HRA, then we'll not apply 80GG. Instead, we'll apply section 1013A. Are you clear with that point, my dear friend? Please confirm so that I can proceed. Good. Next point. Reena has given one of her owned houses on rent in Lucknow from where she belongs. She has been getting annual rent of 3,60,000 for 3 years from that house. Municipal tax is 24,000 for her owned house in Lucknow. She has taken a loan of 10 lakh for that house, against which annual interest is 90,000. And during the year, she repaid principal installment of loan amounting to 50,000. I am sure most of you guys already know that whatever interest we are paying on loan taken for purchase of the property, that interest we can take it as deduction under section 24B. And moreover, the principal repayment of housing loan we can take as deduction under section 80C. Very good. A lot of people are giving correct answer. Excellent, my dear friends. So let me tell you very clearly that one more time I'll repeat for the benefit of everybody. For interest on loan taken for purchase or construction of property, we will take deduction under section 24B. And for principal repayment, we can take deduction under section 80C. Good. And student is telling 2 lakhs. Very good, my dear friend. My dear friend, let me tell you one interesting point. 24B has got a limit of 2 lakh when 3 conditions are satisfied. Number 1, loan is taken on or after 1/4/1999. Number 2, loan is taken for the purpose of acquisition or construction. Number 3, such acquisition or construction is completed within 5 years from the end of financial year in which loan is taken. If all these conditions are satisfied, then we'll get the limit of 2 lakhs. If not, the limit is only 30,000. Very, very interesting points. Are you clear, my dear friends? See, conceptual clarity on multiple points is important when we discuss one point. Are you clear? Please reply. Very good. So in the question, this 90,000 will take 24B deduction and this 50,000 will take under section 80C. Then Reena has invested in public provident fund for 50,000. This also I'll take deduction under section 80C. 80C, my dear friends. 80C, my dear friends, has got a limit. I repeat once again, my dear friends. 80C, my dear friends, has got a limit of maximum 1,50,000. Good. And before I proceed, one student is asking one question. Salaried person can claim HRA and interest on house property both. Technically, no, because if you are staying in rented house and you are paying rent, only then you can take HRA exemption. Technically, answer is no. But this question answer is yes, because you have to get the logic very clearly that the job is in Delhi. The HRA exemption is taken for the house in Delhi. And this house which is given on rent is the house which is in Lucknow. So it is altogether located in a different place, my dear friends. That is why we can take both HRA and interest on borrowed capital both. Generally, we can't take. But this special case answer is yes, because the house is in Delhi, where the person is staying and taking HRA exemption. Getting the point? And the interest on borrowed capital is for the house which is in Lucknow. That's the reason why we can take it. Good. Very good. PPF innate interest is compounded on annual basis and the maturity period of the scheme is 15 years. That's how PPF works. Next. Reena has further invested in a fixed deposit of 2 lakhs, which is due to be repaid after 2 years along with interest. As per the agreement of fixed deposit policy, Reena can withdraw her fixed deposit balance within 2 years whenever she wants it to be. That means it is not a tax saver FD. There is a concept called tax saver FD where there is a lock-in period of 5 years. Good. Already student replied in the chat box, 5 years, very good. That is called tax saver FD. If it is tax saver FD, my dear friends, we can take deduction under section 80C. If it is not a tax saver FD, then whatever we deposit in the FD, that we can't take 80C deduction. Next slide. Interest from her savings bank account and interest from fixed deposit is 9,000 and 15,800 respectively. And the closing balance of her savings account at the year end is 1,25,000. Next. During the year, Reena took medical insurance. By the way, what happens to the savings account interest? Savings account interest, what will happen is savings account interest will be taxable under income from other sources. And we can also take something called deduction under section 80TTA. 80TTA gives deduction of interest or 10,000, whichever is lower. Can somebody tell me what is 80TTB? ATTTB gives deduction for interest on savings bank account and also for fixed deposits. But the point to be noted is that ATTTB is only for resident senior citizen. Keep that point in mind. In exam, they're playing a lot. This word is resident senior citizen. If a person is senior citizen but not a resident, then TTB will not apply. But you can still apply something called TTA. Clear? And TTB has got a deduction of interest or 50,000, whichever is lower. And TTB deduction is only and only for resident senior citizen. Excellent. Next. Reena took medical insurance for herself and her 2 children, amounted to 35,000. Very good. Medical insurance, we can take deduction under section. Come on, somebody reply. Medical insurance, which section will take deduction, my dear friends? Come on. Medical insurance, we can take deduction only and only under section 80D. 80D. But the point to be noted is very clear, my dear friends, that 80D clearly specifies that medical insurance can be taken as deduction. And in that, there are 2 categories covered, my dear friends. And let me tell you the 2 categories covered there are, number 1. I repeat once again, the 2 categories covered there are, number 1, self, spouse, and dependent children. Self, spouse, and dependent children. Number 2, what is covered is parents, my dear friends. And in the law, they clearly told that the parents need not be dependent. What do they tell in the law? The parents need not be dependent. Good. Should I ask him one question? TTA, TTB is only for residents, sir? Not necessary. TTA is for any person. TTB is only for a resident senior citizen. Good. Reena also donated the amount of 20,000 in cash to local religious group. But since it is donated in cash, I hope you already know that donations in cash, if it is more than 2,000 rupees, then we cannot take deduction. Reena has also given private tuition fees of 75,000 during the year for 2 children. If it is private tuition fees, that also we can't take deduction. Because I'm sure you guys know very clearly that ATC provides deduction for tuition fees for full-time education for 2 children. If it is only for full-time education for 2 children. But if it is private tuition fees, then we cannot take that deduction, my dear friends. Next point. Reena has also received a gift of 50,000 during the year from her father as a token gift for her affection and the care towards the family over the years. But we all know that, my dear friends, gift concept is given by section 56 to 10, and the gift concept clearly says that gift received from relative is exempt, and the relative of course covers parents of the individual. So the gift what she got from her father is straight away exempt. So there is no need to pay single rupee tax also on that. Next slide. Assume that TDS of 1,15,000 has been deducted from the income of Reena for 22-23 and it has been correctly reflected in corresponding TDS certificate. Very good. Then this TDS figure will reduce from whatever is the tax payable. Reena has asked her sister Shivani to help her ascertain the income of 22-23 and file the return thereon. Obviously, I'm sure they're definitely going to ask what is the total income, what is tax payable and all. Because this much information they have given related to income tax. Clear? Good. Fair enough. Come on. Let me proceed. Question number 1. Question number 1 is related to what, my dear friends? Come on, friends. What is question number 1 related to? Question number 1 is related to your corporate law. So let me not talk about it, my dear friends. Good. Next point. Second question, that is also related to your corporate law. Third question is again your corporate law. Fourth question, which form of income tax return Shivani is required to file for herself? Come on, my dear friends, tell me which form she will file. Already I discussed this answer with you. Straight away, my dear friends, answer is option B. She will definitely file the income in ITR 3, my dear friends. Somebody is telling 4. 4 is not the correct answer, my dear friends. You have to understand that 4 is only in case of presumptive income. 4 is only and only in case of presumptive income. So which form she will file is 100% without any second thought. ITR 3, my dear friends. Typing mistake. Okay, no problem. Good. Next. Other comprehensive income, that is your Ind AS. Then balance sheet, presentation, security deposit, past journal entries. How should chartered accountant indicates in its report for responsibilities of their work? That question is clearly related to your auditing, my dear friends. Next point. How much income tax is to be payable by Shivani's sister Reena, and calculate the taxable income of Reena to be shown in her income tax return as per information mentioned in the question, and calculate income tax thereon. Ignore calculation at 234 ABC. Wow, what a brilliant question, guys. If this kind of question comes, it's a jackpot for us to score the marks. Definitely it's a jackpot, no doubt about it. Clear? First of all, what all income she is having, my dear friends? She is having income from salaries. She is also having income from house property. Correct, my dear friends? Speak out. And she is also having, my dear friends, income from other sources. Note 1, note 2, and note 3. And all incomes put together, what do we get is called gross total income. From the gross total income, my dear friends, we will take deductions under chapter 6A. What are deductions we have got, my dear friends? Come on, ATC. What all we had in ATC, my dear friends? Come on, please tell me. ATC, we discussed that there is something called investment in PPF. There is principal repayment of housing loan. Investment in PPF, in the question they gave 50,000. Then principal repayment of housing loan, my dear friends, that is also 50,000. Then after that, ATD. That FD I did not take because it is not a taxable FD, my dear friends. Then ATD, my dear friends, ATD is for what? Medical insurance. How much they gave in the question, my dear friends? Let me check that. In the question, they gave the figure of 35,000, but we all know the fact that medical insurance premium, the maximum deduction what we can take is only 25,000, my dear friends. If anyone is senior citizen, then only we can take the figure of 50,000. And that too, resident senior citizen. Yeah. So I'll take the figure of 25,000. Then you also have ATTA, interest on savings account. Come on, friends. Interest on savings account. How much they gave in the question? How much they gave in the question? Interest on savings account. They gave the figure of 9,000 rupees, my dear friends. So I'll take the deduction of 9,000 only, because deduction is always interest or 10,000, whichever is lower. So after reducing that, what figure I get is called total income. Are we getting clarity, everybody? Now, how do I calculate income from salaries? Very clearly, the point is basic salary. Come on, friends. I'm going to take the basic salary. I'm going to take DA. I'm going to take HRA. Basic salary in the question, they gave a figure of 6 lakh rupees, my dear friends. And DA figure, how much they gave is 2 lakhs. HRA, I'll write note 4. And let me write here note 4 for HRA. Least of the following is exempt as per section 1013A. What is exempt, my dear friends? Least of the following is exempt as per section 1013A. And as per 1013A, what is exempt, my dear friends? Actual HRA received, rent paid minus 10% of salary, then 50% of salary for houses in Delhi, Mumbai, Chennai, Kolkata, any other place, 40% of salary. Number 1. Actual HRA received. How much we have received actually, my dear friends? Come on. How much actually received is, my dear friends? 4 lakh rupees. How much HRA actually we received is 4 lakhs. Second one, rent paid minus 10% of salary. What is the rent paid figure? Rent paid figure given in the question is how much, my dear friends? Let me check. So the rent paid figure is 25,000 per month. That means per annum it is 3 lakh rupees. 3 lakh minus 10% of salary. 3 lakh minus what, my dear friends? 3 lakh minus 10% of salary, which is equal to 3 lakh minus 10% of 8 lakhs, which comes to 2.2 lakhs. 10% of 8 lakhs I have taken because I have taken the basic and DA. DA I have taken as a part of salary. And the third point is, my dear friends, 50% of salary, which is equal to 50% of 8 lakhs, which comes to 4 lakhs. Hence, exempt HRA is equal to 2.2 lakhs. And the taxable HRA is equal to 1.8 lakhs. So the taxable HRA figure, what I'll get here is 1,80,000. My total figure will be gross salary. From that, I'll reduce standard deduction as per section 16(1)(a), which comes to 50,000. And taxable salary is after reducing the standard deduction, whatever figure we get, that becomes the taxable salary. Good. So I'll go ahead and I'll take the figure here as 9,30,000. Then what else I have, my dear friends? I've got income from house property. What is the figure of income from house property, my dear friends? GAV. What is the rent for rent income I have got? Come on, my dear friends, GAV. It is 3,60,000 per annum. Less municipal taxes paid by owner. How much they paid, my dear friends? The question, how much they get? In the question, they gave the figure of 24,000, my dear friends. And the net annual value will be 3,60,000 minus 24,000. From that, I'll reduce, my dear friends, deductions under section 24. In that, we have got 24A standard deduction at the rate of what percent, my dear friends? 30%. And 24B, I will get interest on borrowed capital. And how much is the interest on borrowed capital figure they get? Interest on borrowed capital figure is 90,000, my dear friends. And the income from house property will be this figure minus standard deduction minus interest figure. It is coming to 1,45,200. Come on, friends. How much is the income from house property? 1,45,200. 145, 200. Student is asking, we can't deduct municipal tax payable or paid by tenants. Right, sir? Only deduct if paid by owner. Absolutely correct, my dear friends. We'll always deduct the municipal tax paid by owner only, my dear friends. There is no doubt about it. And generally, if question is silent, we always assume that municipal tax is paid by owner only. That's a basic assumption what we always take. Moving further, income from other sources. Interest on savings account. How much, my dear friends? 9,000. Interest on savings account. What is the figure, my dear friends? 9,000. And there is also interest on fixed deposit. What is the interest he has got? He has got interest of 15,800. And he has got gift from father, which is not taxable since received from relative. Student is asking, sir, what type municipal tax is paid by tenant? If it is paid by tenant, we can't take deduction, because we can take deduction only when municipal tax is paid by owner. So income from other sources figure is, my dear friends, 24,800 rupees. I hope you're all getting this working, my dear friends. So once I get this 24,800, I'm ready with all heads of income, through which I'll get my gross total income, from which the moment I reduce my deductions, I will get my total income. So my total income figure is, my dear friends, 9,66,000. That is my total income. And one point is very clear, that is, when I've taken all the deduction, that means very clearly that I'm under optional tax regime. If it is default tax regime, I'll obviously not take any of this deduction. You know that, right? Default tax regime 115 BAC, we can't take any of this deduction. So what will be the tax liability, my dear friends? Up to 2,50,000. The answer is nil. 2,50,000 to 5 lakh at the rate of 5%, which is coming to 12,500. And 5 lakh to 9.66 lakh at the rate of 20%. Student asking one question. Let me check. Yeah. They're telling the tax working already. Good. Very good. Let me check. So this figure is 4,66,000 into 20%. So total figure will come like this. To that I will add HEC at the rate of 4%. Total tax including HEC. The figure will be this plus this, 109, 928. And already in the question they told there is already some TDS that is being done. What was the TDS figure? The TDS figure that is given in the question is, assume that 1,15,000 TDS is done. So TDS figure they gave in the question is, my dear friends, 1,15,000. So since TDS is already more than tax payable, my dear friends, he is definitely going to claim refund. There is no doubt about it. Because if the tax payable is more and TDS is less, he will pay something to the government from his own pocket. But if TDS is already more, but the tax payable is less, he'll obviously claim refund. So that's the end of story of this beautiful one, my dear friends. And that's the end of story of this wonderful case study, which actually makes a lot of meaningful sense. And I strongly believe that you got very good clarity on this case study, my dear friends. An interesting case study. In fact, if this kind of question comes, you should feel lucky enough that we can comfortably do this kind of questions. Are you all fully clear? Can I proceed? Come on, my dear friends. Any doubts? Still you can ask. If not, I'll happily proceed. proceed. Thank you very much.
Now, coming to case study 18. In this case study, there is only one question which we have already discussed yesterday. Calculate the previous class share-based payment under Ind AS 102. So this is the same question where you have to apply 102 and 103, and you can do it as a practice on your own. Okay. So I'll not be it's the same thing. So I don't need to discuss the same thing again. Okay, especially that question.
Okay, let's move on to case study 18. This has got 3-4 questions. 2 are MCQs, 2 are descriptive. So let's look at these questions. First is multiple choice question number 1. Let's read this question. Okay. With reference to the information given in para 1, the previous question was quite difficult than other questions. Yeah. With reference to the information given in para 1, whether the meeting held by the board of directors of Aspan Limited with respect to approval of the matter relating to amalgamation considered valid or not. Okay, so we are reading case study 18 MCQ 1. So this question says we have to read para 1. We'll read para 1. It says that there is a meeting held for the board of directors. There's a board meeting that was held. The agenda of the board meeting was they were discussing amalgamation. And we have to check whether the meeting held was valid or not. So we have to just check whether that meeting was valid or not. Okay, let's look at para 1 to see the details of the meeting to understand. Okay, so para 1. I'll have to rub everything off. So we are reading particularly the relevant part, which is the second paragraph in para 1. Okay. So this particular company, Aspan Limited, it is an unlisted public company, which is in Chennai, and it has got 13 total directors. Okay. Now, for approval of the matter relating to amalgamation, a meeting of the board of directors was held, which was attended by 7 directors, out of which 5 of the directors, they were physically present and they were able to attend such meeting through like physical presence. 2 of the directors, they came by video conferencing. Thereafter, the application was made to the tribunal. So these are the details which are given to us. Total, there are 13 directors. 7 of them attended. 5 of them physically attended. 2 of them were attending by video call. So here we have to check whether quorum was present or not. If quorum is present, then this meeting is valid. If quorum is not present, then meeting is invalid. Okay, so quorum is covered in our section number 174. Let's look at section 174. By the way, we have discussed this provision yesterday also. So section number 174 talks about quorum of the board meeting. Quorum of the board meeting is 1/3 of the total strength of directors or 2 directors, whichever is higher. Okay, so in our case, there are total number of 15 directors. Okay, so we have to calculate 1/3 of 15, which comes to 5 directors or 2 directors, whichever is higher. So 5 is our quorum. If there's any fraction, we have to round it off to 1. So 5 is our quorum, but 7 people have attended already. But let's read what else is there. Some have attended by video conference and some have physically attended. So what does the section talk about? Video call attendance. See, the section says that directors can attend in person also, or they can attend through video conferencing. But there are some matters that cannot be attended by video conference. There are 5 matters that should be attended by the board members only by physical presence and not by video conference. First matter is annual financial statement approval, then board report approval, then approval of prospectus, then audit committee meetings considering the financial statement, and lastly, any amalgamation, merger, demerger, acquisition, or takeover. So if amalgamation, merger, demerger is done, then quorum should be physically present, not by video conference. So if any members are present by video conference, we will not consider them in quorum. Got it? So now in our given case, 5 members are physically present, 2 are by video call. Okay, so 5 are any which way physically present. Our quorum is also coming to 5. Can we say that the quorum is present in this meeting? Is this meeting valid? Yes or no? Yes or no? Yes. Sikandar is saying yes. What about others? Yes. Yes. Perfect. So let's look at the options. We'll select the correct option here. So question reads whether the meeting is valid or not. Option 1, no, as such matters cannot be dealt by video conference. No. Only for quorum's sake, we cannot have video conference attendance. No, as the requisite quorum of the meeting is not present. See, quorum is 5 and 5 directors are present physically. So quorum is actually present. No, as a prior approval of registrar is required to deal with this matters. Again, wrong. Yes, as a requisite quorum of the meeting was present through physical presence of directors. So D is our correct option, just like you said. Let's move on. Next, we have MCQ 2. Let's read. I'm reading MCQ 2. With reference to the information which is given in para 2 and para 3, what shall be considered as the effective date for the scheme of amalgamation? And creditors holding what minimum value of debt would have been agreed and confirmed through the scheme of amalgamation? Okay, so if you remember the company law provisions for amalgamation, for compromise arrangement, see, for amalgamation, merger, etc., there was always a scheme that was prepared. Now, this scheme had to be approved by members also, had to be approved by creditors also, right? 90%, you're right. Okay. Now, we'll have to calculate two things here. One, we have to calculate how many creditors minimum should approve this scheme. And second, we have to see the effective date of application of this scheme as per para 2 and para 3. Okay, so let's look at the para 2 and para 3 to understand more details of this scheme. Okay. We are reading this para. Let's see. Para 2. On receipt of such application, the tribunal ordered a meeting of the members for both the companies to be held. The tribunal dispensed with the calling of the meeting of the creditors of Aspan Limited as the creditors with requisite value of debt in aggregate out of total outstanding debt of 1,50,000 agreed. Okay, so here we have the details of the creditors. It says the total debt in aggregate of that company was 1,50,000. It says that creditors have already agreed and confirmed. So tribunal dispensed with calling of the meeting. It says that tribunal did not call the meeting of the creditors. Why? Because before they called the meeting of the creditors, the majority that is required, they have already agreed and confirmed. So this is relevant for us. Okay, we'll have to refer to section 232 and 230 to see what is the value of creditors that should approve so that even the meeting is not required. Okay, so this is the first part. Now we have to see the date on which this scheme was approved. Okay, these facts you have understood. We'll read the section also. Just understand the facts what are here. See, tribunal was supposed to call the meeting for the creditors. It was supposed to call the meeting of the members. But before it called the meeting, the creditors in total that were 150 lakh rupees, majority of these creditors as per the company law, they have already approved. So tribunal did not call the meeting also. What is that maximum limit? We'll have to check. Now, okay, now para 3. Tribunal made an order dated 20th September sanctioning the said scheme of amalgamation, which was received by both the companies on 23rd September. And then it was filed with the registrar of companies on 5th October by both of them. The appointed date indicated in the scheme was 1st October. So we are given so many dates. Which date is applicable for the effectiveness of the scheme? Okay, see what happened. Tribunal sanctioned the scheme of amalgamation on 20th September. It sent it to the companies and the companies received it on 23rd September. It was filed with the registrar of companies on 5th of October. And in the scheme, it was written that the appointed date is 1st October. Now, which of these dates is relevant for us? when will the scheme be applicable? When will the scheme be applicable? When it is sanctioned, or when it is sent to the company, or when it is filed with the registrar, or the date which is mentioned in the scheme. So let's look at the relevant provisions here. So let's look at the provisions. See, section 132 talks about merger and amalgamation. It says that where the scheme will clearly indicate the appointed date for the application of the scheme, then it will be applicable from that appointed date. Okay, so section 132 clearly says that whenever in the scheme it is mentioned that this is the appointed date, then that appointed date will be the effective date when the scheme will be applicable. So in this particular case, none of these dates are relevant for us. What is relevant for us is the appointed date. Appointed date is 1st October. So 1st October is the date when this scheme will be applicable. Now let's look at the creditor part. See, section 230 says that whenever there is a scheme of compromise or arrangement, then a meeting has to be held. The meeting will be held for members also, will be held by creditors also. For both of these meetings, the requirement is that majority of the persons that are coming in the meeting, they should approve, and also they should be holding 3/4 of value. Okay. So majority of persons representing 3/4 of the value of the creditors or the class of creditors or members, etc., voting in person or by proxy or by postal ballot should agree. Okay. However, there is another provision which is stated in section 230, which says tribunal may dispense with calling the meeting of the creditors if 90% or more of the creditors in value agree and confirm the scheme. So generally speaking, there is a meeting held of the creditors, and majority of the people who are voting, if they approve and they are also holding 3/4 of the value, then we will consider that the scheme is approved by the creditors. But it may happen that before the meeting only, 90% of value of creditors or more than 90% of value of creditors, they have given approval. They are okay with the scheme. If they have already approved, then the tribunal need not call the meeting. Need not call the meeting. So this is what is relevant for us. See, in this given case, what happened? 150. One second. So in this given case, we know that. Okay, one second. One second. What is happening? Just give me a second. Okay. So what we read was that on receipt, the tribunal dispensed with calling of the meeting of the creditors of this company as creditors of requisite value of debt in aggregate out of total outstanding of 150 lakh agreed and confirmed by way of affidavit. So the total debt was 150 lakh, and probably more than equal to 90% of them, they have agreed in writing before the meeting only. Therefore, the tribunal did not call the meeting. So we simply have to calculate 90% of 150. That will be the minimum number of creditors that should approve this particular scheme, so that even the meeting is not required. So what is 90% of 150? What is 90% of 150? It's 135, I think. Okay. So let's look at the correct answer. See, according to our discussion, out of 150 lakh, 90%, that means 135 lakh rupees, that means value of creditors should approve. And also, what is the effective date? Effective date of application of the scheme is the appointed date. What was the appointed date? Appointed date was 1st of October, which was mentioned. Appointed date was 1st of October. So what is going to be our correct option here? 1st October 22. Effective date will be 1st October and creditors with date of at least 112 point. This amount is incorrect. Second effective date will be 1st October. Amount will be 135. This seems like the right answer. Effective date will be 20th September. Amount will be 135 lakh. This is incorrect. Effective date will be 5th October. Amount will be 112.5. This is incorrect. So correct answer will be B. Okay. Now we'll move on to next question. Question 6. Let's read this question. Question 6, first part and second part. Question 6, first part, with reference to information given in para 2, explain how the scheme of amalgamation was approved by required majority of members. Okay, you simply have to explain how the scheme of amalgamation is approved by required majority of only members, not creditors. Only they're talking about members. So we have to read para 2. Then we will write down the provisions. The relevant provisions we have to see of section 230. Just now, we discussed majority in number and 3/4 in value. So that is what we have to explain, and we have to calculate also here. So let's read para 2. Okay. So we are reading para 2. The tribunal dispensed with calling the meeting of the creditors, as this part we have already discussed. Now, the meeting of members of Aspan Limited was then convened as per the order of the tribunal for the purpose of considering the scheme of amalgamation. The meeting was attended by 200 members. They were holding 6 lakh shares, out of which 95 members holding to 4,30,000 shares in aggregate, they voted in favor, and 80 members holding 1,40,000 shares in aggregate voted against the scheme, and 25 members holding 30,000 shares abstained from voting. Is this scheme approved by the members? Yes or no? We'll have to see as per section 230. What does section 230 say? So section 230 simply says, one second, that when a meeting is held for the members or the creditors, then majority of the persons who are also attending the meeting and also voting in the meeting. Okay, not necessarily attending the meeting, just voting. We'll have to count based on the people who are voting in the meeting. Okay, it may be possible that they are voting by proxy or by postal ballot. It's okay. Attending is not necessary. Voting is what we have to count. Majority of persons who are voting representing 3/4 of the value. That is what we have to check. They may vote in person or by proxy or by postal ballot. It doesn't matter. So we have to only check voting members. If this is available with us, majority of persons voting and representing 3/4 of the value, then we can see that the scheme is approved. Okay, so let's do the calculation. Okay, so in this meeting, what is happening is it is attended by total 200 members. Members that are attending is 200, but actually all of them are not voting. 95% voted in favor, and 85 of them they voted against. 25 they did not even vote. So actually the people who are voting in the meeting, it is 95 plus 80, that is 175. So actually the voting members are 175. We have to check whether majority of the voting members have voted in favor of the scheme. So how many people have voted in favor? 95 people have voted in favor. So 95 divided by 175 will come to 54%. That means majority of the people who have voted in favor of the scheme. So first part of the condition is satisfied. Majority of the members present and voted, majority of the members who are voting, they have voted in favor. Now we have to check the second part of the condition, which is whether 3/4 value, whether they represent 3/4 value or not. Okay, so for that we have to see total shares are 6 lakh shares. But all 6 lakh shares holders are not voting. 95 shareholders who voted in favor, they held 4 lakh 30,000 shares. Then 80 shareholders who voted against, they hold 1 lakh 40,000 shares. So actually, the shares which were held by the audience, that means the members who actually voted, is 4 lakh 30,000 plus 1 lakh 40,000. That is 5 lakh 70,000. So the members who voted, they represent only 5 lakh 70,000 shares. So that is the relevant figure for us. Now, what about the members who voted in favor? The members who voted in favor, they held 4 lakh 50,000 shares. So is it 3/4 in value? 5 lakh 70,000 and 4 lakh 30,000. Is it 3/4 in value? If you calculate, yes, it is more than 75%. So it is 3/4 in value. Even the second condition is satisfied. So the members who are voting, okay, they are majority of the voting members, and they also represent 3/4 of the value of the shares held by the people who are voting. Got it? Both of these conditions are satisfied. You have to show this calculation. Based on that, can we say that the approval by the member is granted? Is the approval by the members granted? Yes or no? Yes or no? So yes, the approval is granted. Okay. One more question we have to do. Descriptive question 6 ka second part. And this is also the last question of today. Okay. Let's read the second part of question 6. With reference to the information which is given in para 3, to what amount of compensation Mr. Rohit will be eligible to get from Aspan? So Mr. Rohit is somebody. Mr. Rohit is getting some compensation from Aspan. We have to calculate the amount, maximum amount. So we'll have to read para 3 to understand who is Mr. Rohit. Let's go to the facts of the case. Okay. So let's read. Now, due to such amalgamation, Mr. Rohit, who's a whole-time director of Aspan, was removed from his office on the condition that he will get compensation for early vacation of office. Now, Mr. Rohit has vacated on 31st May, and his original tenure was up to 31st October 2024. The remuneration that he was drawing from office for the past years was 55 lakhs, 62 lakhs, and 13 lakhs. This 13 lakh is for little bit of the period of the year. That is from 1st April till 31st May. This is only for April and May, 2 months. Okay. These above two are for 12 months. The last one is only for 2 months. So this is the remuneration that Mr. Rohit was getting in the previous 2-3 years. Now what happens here, Mr. Rohit, because of this amalgamation that is happening between the companies, he is being asked to go. Okay, he is removed from his position. Now he holds the position of whole-time director. He is being removed. Now, because he's being removed from his office early before his tenure, he's been given some compensation. Now, what is the maximum amount of compensation? We have to calculate that. So, what is the relevant provision here? The relevant provision is section 202, which talks about compensation for loss of office of managing director or whole-time director or the manager. Okay. So, this section says that compensation can be given to the whole-time director, the managing director or the manager. It can be given if there is a loss of office or if they are retired or etc. But basically, it should not be their fault. They should not be at fault. They should not be quitting. They should not be vacating. Otherwise, it will not be allowed. But if genuinely the company is removing them and they want to pay them compensation, they can make the compensation. It's up to the company. It's not compulsory. It's up to the company. That is what section 202 says. But this section 202 lays down a limit to the compensation. It says the payment should not exceed what this person would have earned if he has been in office for the remaining period or 3 years, whichever is shorter. If this person would have stayed in office for the remaining term or 3 years, whichever is less. then whatever compensation he would have received, that much is the maximum we can give. We cannot give more than that. Okay. So we'll have to calculate. Okay. So, and we have to see the way of calculation. Okay. So let's say a director is removed and his remaining term was 4 years. Then we will have to do the calculation for remaining period 4 years or 3 years, whichever is less. So that means 3 years. 3 years is less. So we have to calculate his remuneration based on lesser period, which is 3 years. Another example, let's say the managing director, the whole-time director or managing director up to, it's okay. If let's say their remaining tenure was 2 years, then what will be the calculation? Remaining period 2 years or 3 years, whichever is less. So 2 years or 3 years, whichever is less, 2 years. Right? So we have to calculate based on this time, remaining period or 3 years, whichever is less. Now, how will we calculate the salary? How will we calculate the remuneration? For that, this section says that we have to calculate average remuneration for the last 3 years or shorter period. Then we have to multiply it with remaining period or 3 years, whichever is shorter. So that is how the calculation is done. Okay. First, we have to calculate average remuneration for past 3 years, or if less than 3 years he was there, then less than 3 years. Based on that, we will multiply from the remaining period or 3 years. Okay. So in the given case,
Hello. Audible?
please tell me, am I audible? Yes, now? Okay, good. So for the past 26 months, the remuneration received was 55 lakhs plus 62 lakhs plus 13 lakhs. So that is a total, if you do the average per month, it will come to 5 lakh per month. So this Mr. Rohit was so far receiving an average of 5 lakh per month. How did I calculate? I added these 3 salaries, divided it by 26 months. It comes to 5 lakh per month. So can we calculate the remuneration that he should be getting? By the way, he has worked for 26 months. We have to check the remaining tenure or 3 years, whichever is less, right? So 3 years means 36. 1 second. Okay, so he has so far worked, 1 second. My bad. See the facts of the case. Let's look at the facts of the case. He has so far worked for 26 months. Now, if we look at the facts of the case, it says the office of Mr. Rohit was vacated on 31st May 2022 and his original tenure was till 31st of October 24. So what is the remaining period? From 31st May 2022 till 31st October 24, we have to calculate how many months are there. If you count the total number of months, the remaining time will come to 29 months. Okay, 29 months is the remaining time. Now we have to check 29 months or next 3 years, whichever is less. For that, the compensation will be calculated. See, we have calculated the average remuneration. Average remuneration is 5 lakh per month. Now, average remuneration into what? Into how much time? Remaining period or 3 years, whichever is less. Remaining period is between 31st May 2022 till 31st October. That is 29 months. 29 months or 3 years, whichever is less. 3 years is 36 months. So that means lesser period is 29 months. So we will multiply 29 months with 5 lakh rupees. That will come to 1.45 crores. Okay. So 1.45 crores is the maximum compensation that the company can pay to Mr. Rohit. Understood? Understood? Yes or no? Give me a yes or no in the chat. You understood this section? Understood this question? Yes? Okay, very good. So with this, we have completed today's session, and with this, we have also completed all the cases relating to company law. Okay. So, okay. I'll be sharing this, like all of these pages and all of these questions and details also with you. Like I'll be sharing with the team and they will be sending it to you. Okay. ठीक है. Chalo, we'll end the session now. Okay. Good night. Take care. Bye-bye.
Friends, now look at an interesting case study, my dear friends. Case study number 18. Study asking how much marks for this question. I am sure you already know the weightage, how the case studies are divided in the examination. They generally give 25 marks or 20 marks case studies. 25 marks case studies they give 4 case studies. 20 marks case studies they give 5 case studies. Anyways, you'll have one case study for choice. Don't worry. Yeah, thank you very much. Student asking, will they repeat? You mean to say repeating the case studies which already came in the previous attempts you are talking? If that is the case, then it's not compulsory that they'll repeat. But sometimes there is a possibility that some similar pattern question may come and some points may be captured. See, ultimately, whatever they capture is all will be the part of your syllabus only, right? So sometimes there is a possibility that some case studies may be repeated in the examination. IBS is huge. I cannot talk anything about IBS now. I'll proceed with taxation. Come on, next. I know your situation. Please, thank you. Aspan Limited is an unlisted public company located in Chennai, Tamil Nadu, with 13 directors engaged in the business of manufacturing and steel trading. Chular Private Limited is another company with 5 shareholders as directors engaged in the business of exploration, mining, and processing of iron ore. Very good. Iron ore is a mineral. Don't tell iron ore is a metal. I hope you know that iron ore is a mineral. Iron is a metal. Next. In order to have business synergies, it was proposed to amalgamate Truller Private Limited Transferor Company with Aspan Limited Transferee Company. Next. For approval of the matter, I repeat once again, for approval of the matter relating to such amalgamation, a meeting of Board of Directors of Aspan was held, which was attended by 7 directors, out of which 5 attended through physical presence, and 2 of them through video conferencing. Fine. On receipt of application, tribunal ordered a meeting of members of both companies. Total debt is this much, this many people came, this much told yes, this much told no. That's all related to corporate law. Next. Tribunal made order on 20th September, sanctioning the scheme of amalgamation. Very good. Which was received by both the companies on 23rd September 2022. And then it was filed with ROC on 5th October 2022 by the advocate appointed for the amalgamation procedure by Aspan for the 2 companies. Appointed date indicated in the scheme was 1st October 22. Due to the amalgamation, he was removed from office, remuneration and all. That is your direct remuneration, sir. And para 4 is all your India story. But now comes our territory, that is your GST and income tax. Aspan Limited, GST registered in Tamil Nadu, got a contract from public sector undertaking. The moment in the question you see the word got a contract from Department of Government, got a contract from public sector undertaking, got a contract from society established by government. The moment you see that word government, your brain should tell you that TDS under GST will apply. TDS under GST concept is given by section 51, which clearly says that, I'll explain the concept first, then I'll proceed further. Whenever we make a supply to any department of central government or state government or governmental entity or to a local authority or to public sector undertaking or a society established by the government where the contract value is more than 2,50,000. Contract value always means value excluding GST. If that figure is more than 2,50,000, government, while paying to us, they will do TDS at the rate of 1% plus 1%. Effectively 2%, they'll do TDS and make the payment to us. Let me tell you very clearly, this is not income tax TDS. This is very clearly a GST TDS given by section 51. And GST TDS section 51 also has got one special point which says that if the location of supplier, what did I say? Come on. If the location of supplier and place of supply, if the location of supplier and place of supply both are in one state and the location of recipient is in another state, then the provisions of TDS will not apply. So friends, which case provisions of TDS will not apply? If the location of supplier and the location of recipient both are in one state but the location of recipient is in different state. Location of supplier, place of supply, both are in one state, but the location of recipient is in different state. Then the provisions of TDS will not apply. Very, very important point. Keep in mind. Next. For supply of TMT bars worth 22 lakhs, excluding taxes. Student is asking one question. Sir, sorry to interrupt you. I think best first read the question, then find the paragraph related to the question. What do you think, sir? Or read the whole case study first, then read the question. You can do any of the manner, but the whole point is that if you see the question first, then you get a clarity as to what kind of questions are being asked in the case study. See, this case study where it is 1-2 pages, that is not a problem. If it is 2-page, 3-page case study, I suggest you go through the case study and then start the MCQs. That's not a problem. But where the case study size is huge, like 7-page, 8-page case study and all, then it becomes very difficult for you to read the entire case study. In that case, it's always better to read the questions first and then find the paragraph where that content is given. You got my answer, my dear friend? Yeah, done. Thank you. Where the case study is big, that is always the best option. But if the case study is only 2-3 pages, I humbly suggest that first go through the case study, then look at the question. But if it is more than 5-6 pages, then don't waste your time. Directly proceed to questions. And then find the paragraph in the case study, what is relevant for you. Got it, my dear friends? Can I proceed? Thank you. So price of steel TMT bars is 22 lakh rupees. Freight is 1 lakh. Insurance on freight is 10,000. Loading and handling charges incurred after removal from factory. What is that like, my dear friends? Loading and handling charges incurred after removal from the factory. That figure is 70,000. Packing charges 20,000 rupees. Come on, see next. A cash discount of 5% was allowed on the price of steel TMT bars, as the full payment was received in advance from the PSU on 31st December. And invoice was raised against the same on dated 6th January 23. Very good point. Next point. It was an over-dimensional cargo. Over-dimensional cargo means where the size of the cargo is exceeding the size of vehicle. That's why we call it as over-dimensional cargo. You'll find sometimes big trucks you will find where the tires are only up to this much, but the container on the top of tire will be this much. Container is so big, but tires are so little. Generally, when they transport cars, bikes in the big containers, which you will find on the big highways. Yeah. Removed from the factory in Chennai on 9th Jan 2023 and was delivered at the customer site in Coimbatore on 6th February after traveling a distance of 540 kilometers. E-way bill was generated on 12 p.m. on 9th of January. So first of all, my dear friends, generally when we generate e-way bill, if the validity is 1 day means, for example, today 10 a.m. we generated, then next day up to 12 a.m. midnight, till that time it is valid. And generally the limit is up to 200 kilometers, the validity is 1 day. But in case of over-dimensional cargo, it is not 200 kilometers, it is 20 kilometers. Got the point? Done. So how much distance we are traveling here? 540 kilometers. 540 divided by 20 kilometers will come to 27 days. So validity of this e-way bill will be for 27 days. When was it generated? It was generated on 12 p.m. It was generated at 12 p.m. on 9th January 23. 9th January means January we have got more, how many days more in Jan? Jan we have got more, 22 days in Jan. 22 days in Jan. Because 9th don't count, start from 10th. So 22 days in Jan. Plus 5 days in February. Because 27 days is validity. So up to 5th of February midnight. 5th of February midnight. Till that time, this e-way bill is valid. Got it? Got it. PSU deducted tax at the time of payment to Aspan on 31st December, which was deposited on 16th February. That's not okay. Because generally, whatever TDS is deducted under section 51, that has to be paid to the government by 10th of next month. A student is telling 7th of next month, but let me tell you, my dear friends, 7th is not correct answer. 7th is only income tax TDS. But this question is GST TDS. GST TDS due date is not 7th, the due date is 10th of next month. See, small point. But our brain always tells TDS means 7th of next month. But the answer is 10th of next month. 7th is only in case of income tax TDS. Got it, my dear friend? Can I proceed? No, don't show tears and all. Feel happy that you're getting clarity and perfection. See, one way you have to feel happy that you're getting perfect now itself, right? So stay positive, my dear friend. Now smile. Don't put that sad face. Yeah. Thank you so much for the smile. Next point. Multiple choice question. First one is related to your meeting, then related to your amalgamation. With reference to information given under para 5, what amount of tax would have been deducted by PSU under GST law and by what date it should have been remitted? The due date is obviously 10th of next month. See, now your brain will tell 10th only because 7th option only is not there. But we will start thinking that 7th option only is not there. Question is only wrong. Not at all, my dear friends. Clear? But the question is all about whether it is, what is the amount? First of all, what is the amount? PSU deducted tax at the time of payment itself on 31st of December. If it is 31st of December, then they should deposit that TDS by which date, my dear friends? By 10th of February. By 10th of February. And TDS is supposed to be done at the rate of 2%, my dear friends. But 2% is on what value? That is a question. 2% is on what value means? The point is very clear, my dear friends. 2% we have to do on the value of supply. But the big question is, what is value of supply? 22 lakhs is okay. 1 lakh is okay. 23 lakhs. 23 lakh 10,000. 23 lakh 80,000. Plus 20,000, which comes to 24 lakhs, my dear friends. What is the total figure? 24 lakhs, my dear friends. So by 10th of January, he has to deposit TDS at the rate of 2% on 24 lakhs. 2% on 24 lakhs will come to how much, my dear friends? Come on, friends. 2% on 24 lakhs is how much? 2% on 24 lakhs is 48,000 rupees. So very clearly the answer is 48,000, which has to be deposited by 10th of January. Student asking, cash discount will not be considered, sir? Definitely not be considered. Because you have to understand that in GST law, there are only two types of discount. Number one, discount recorded in the invoice. Number two, discount given after supply is made based on agreement existing at the time of supply and it is linked to the invoice and credit is reversed by the recipient. In the question they told cash discount is given. Correct? As the full payment was received in advance on 31st December. But they have not clearly given whether the discount is mentioned in the invoice or not. If the discount is recorded in the invoice, then definitely will reduce. Sir, section 15.3, my dear friends. 15.3 clearly talks about the discount concept, sir. I believe that we are getting clarity on this point. Everyone. But one point you have to understand, which is a special point, my dear friends, that discount will not be considered only if it is recorded, only if it is what, my dear friends? Recorded in the invoice. Student is telling, should be deposited in Jan? No, sir. Obviously, Jan. That is what I told you, no? TDS is deducted at the time of payment on 31st of December. That means TDS has to be paid to the government by 10th of Jan. Yeah. But one more point, let me tell you here. A cash discount of 5% was allowed on the price of steel bars as the full payment was received in advance from the PSU on 31st December 2022. You may also assume one point that discount is recorded in the invoice and you can reduce the discount. That possibility is always there. That possibility is always there, my dear friends. But if you assume that discount is recorded in the invoice, then what will happen? 5% you have to reduce on 22 lakhs. 5% if you reduce on 22 lakhs, it becomes 1,10,000. And 1,10,000 if you reduce, my dear friends, it becomes 22,90,000. 22,90,000, 2% will nowhere match with any of your option. Will nowhere match with any of the option what they gave in the question. So your answer is obviously option A, 48,000 to be remitted by 10th of January. 10th January is definitely perfect answer, and it is 48,000 for a simple reason because we will take 2% on 24 lakhs. You're getting what I'm talking? And moreover, you have to understand that this is a cash discount, my dear friends. If you assume that it is recorded in the invoice, that can be reduced, no doubt about it. But since there is no clarity about the point of cash discount in the question, we are directly taking 2% on the entire value of 24 lakhs, my dear friends. But nevertheless, you can always take it as discount is recorded in the invoice and reduce that. Clear? But since the only problem I did not consider that is payment is issued on 31st December, TDS is deducted on 31st December at the time of payment. So clarity is not given whether it is mentioned in the invoice or not. That's the only reason why I did not consider that. Done. Student is asking what question? So kindly explain dimensional cargo and over-dimensional cargo. So normally e-way validity is up to 200 kilometers per day. 200 kilometers one day. For any additional kilometer, extra one day will come. Over-dimensional cargo means those big trucks where the tires are up to here, but on the tires, the container is up to here. In a lot of big movies they show, no? A lot of movies they show these containers and all taken on big vehicles, big container trucks and all they show. They are called as over-dimensional cargo. Name only says over-dimensional cargo. Student is asking, sir, how do we treat subsidy in valuation of goods? Subsidy, if it is linked to price, we'll always reduce that. Except subsidy from central, subsidy linked to the price is always included in the value of supply, except subsidy from central government or state government. So subsidy is coming from government, that is not included in the value of supply. But if subsidy is coming from other than government, that is definitely included in the value of supply, my dear friends. There is no doubt about it. Got the point? Good. Can I proceed? Thank you very much. Next bit. With reference to information given under para 5, my dear friends, what shall be the interest liability for late deposit of TDS? So interest rate is 18% per annum, my dear friends. And the TDS amount is 48,000, which was supposed to be paid by 10th of January. Instead of paying on 10th of January, they deposited on 16th of February. If it is 16th of February, my dear friends, interest will come for a period of 37 days. By 37 days, 21 days in January, 16 days in February. Totally for 37 days. Come on, please calculate that. 48,000 into 18% into 37 divided by 365. You will get your answer. 48,000 into 18% into 37 divided by 365. Please tell me what figure you are getting. Somebody is telling 729. Is it correct? Please check. 48,000 into 18% into 37 divided by 365. Friends, come on, guys. What is the answer you're getting? I'll only calculate. Wait. I will calculate in my Excel. Hold on. 48,000 into 18% into 37 divided by 365. So the answer is coming to 875.8356. So I'll take it as 876, my dear friends. So without any second thought, my dear friends, come on, tell me what is the answer. The answer is very clearly option A, my dear friends. That's it. Next question. With reference to information given under para 5, till what date UAL will be valid? Already I told you, till 12 midnight of 5th February to 6th February. You got 27 days. Will be that validity time? 540 kilometers. Correct, friends? Very, very interesting question. And of course, a very, very interesting answer. I strongly believe that you got clarity on this point, my dear friends. Good, fair enough. Thank you. Next point. This is your amalgamation, index. Next. With reference to information given under para 5, what should be the place of supply and time of supply with respect to supply of steel TMT bars in over-dimensional cargo? Come on, let's check and go back to the question. They're asking about place of supply and time of supply. What is that point, my dear friends? Aspan Limited GST registered in Tamil Nadu got a contract from PSU GST registered in Karnataka, my dear friends. Then they asked for supplying the material to its site of construction in Coimbatore, Tamil Nadu. Tell me, my dear friends, we're talking about a case where there is a movement of goods. In case where there is movement of goods, my dear friends, if the location of supplier, and the place of supply both are in one state, the location of supplier, both the location, sorry, wait a second. What is that we're talking about? Place of supply, right? Sir, section 10(1)(a) clearly talks about place of supply in case where there is movement of goods. In case where there is movement of goods, my dear friends, what will be the place of supply? Come on, tell me, guys. What will be the place of supply? The place of supply will very clearly be, what is the answer? Tamil Nadu. Because as per section 10(1)(a), place of supply is the place where movement of goods terminates. Movement of goods terminates for delivery to the recipient. Getting the point, everybody? So in this particular question, applying the provisions of section 10(1)(a), the answer will be Tamil Nadu, my dear friends. Should I ask him one question? Sir, how TDS is applicable? Location of supply, place of supply, both are in one state. Recipient is in different state. Technically, that is what I was also just looking at the question. That location of supplier is in Tamil Nadu. Place of supply is also Tamil Nadu. But the location of recipient is ideally Karnataka. So technically, in this particular question, ideally, TDS should not apply at all. Strictly speaking, in this particular question, TDS only should not apply. The reason because location of supplier and place of supply is in one state, but the location of recipient is in another state. If you see very clearly, supplier is in Tamil Nadu, place of supply is Tamil Nadu, and recipient is in Karnataka. So ideally, in this particular question, TDS only should not apply. But in the answer, they gave different options. You're getting my point? So that's how they try to play at times. But you have to be very, very cautious. You got the point what I'm trying to tell you, my dear friends? Friends, come on, please reply. You have to play with ICA ground. True, my dear friend. True, very true. You have to be very cautious. Yeah. Next point. What else? Yeah, they also ask about time of supply, right? What is the time of supply? Let's check. Cargo is removed from the factory on 9th of February. Sir, straight answer is related to goods. Time of supply for goods is what? Time of supply for goods is what? Come on, tell me, my dear friends. Time of supply for goods is always what, my dear friends? Time of supply for goods is very clearly, my dear friends, always the answer is date of invoice. And date of invoice means actual date of invoice or last date when invoice is ought to have been issued under section 31, whichever is earlier. In the question, if you see, invoice is supposed to be issued on 9th January whenever there is a movement of goods. On or before a date of removal, invoice must be issued. Correct? Which is nothing but 9th of January. But invoice is actually issued when it is actually issued on 6th of January. So straight answer, my dear friends, time of supply will be 6th of January. Good. Student is asking one point. Sir, for site construction, they might have registered office in Tamil Nadu. Maybe. Possible. There is a possibility that they might be having some registered office in Tamil Nadu. If they have registered office in Tamil Nadu, in that case, location of supplier, place of supply, location of recipient, all three are in same state, then definitely TDS will apply, if that is the case. But generally, what logic you told will work practically also, because wherever we have a site construction going on, there we always take registration done, because we want input tax credit. I hope you know very clearly that if one person registered in one state is paying CGST, SGST in another state, he can't take credit. That's why wherever site or construction work is going on, there he always take registration. So there's a high possibility. Whatever assumption student told is very logical actually. Yeah. Moving ahead, what else is there in this case study? One more point, with reference to information given under para 5, what will be the value of supply? Already I discussed that with you, my dear friends. Value of supply is very clearly that 24 lakh rupees. From that, you can reduce the cash discount of 5%. Then you'll get your answer. And the cash discount we will reduce, assuming very clearly that if discount has been recorded in the invoice. If discount is recorded in the invoice, only then, my dear friends, that cash discount can be reduced, because the cash discount, the discount as per section 15(3)(a), it can be reduced only and only when the discount is recorded in the invoice. If not, there is no question of reducing that discount. Getting the point, everybody? Very, very, very interesting case study. I strongly believe that you got the point. Kindly please reply, my dear friends. Thank you very much. Very good.